1. Understanding investor psychology. 1.1 Introduction to investor psychology. Investor psychology plays a crucial role in the world of finance and investing. Understanding the psychological factors that influence investment decisions is essential for investors to make informed choices and achieve their financial goals. This chapter will provide an introduction to investor psychology, exploring the various aspects that shape investors' behavior and decision-making processes. Investor psychology refers to the study of how individuals perceive, interpret, and react to financial information and market conditions. It encompasses a wide range of psychological factors, including emotions, cognitive biases, social influences, and personality traits. By understanding these factors, investors can gain insights into their own behavior and make more rational and effective investment decisions. 1.1.1 The importance of investor psychology. Investor psychology is crucial because it helps explain why financial markets behave the way they do. It sheds light on the irrationality and unpredictability often observed in market movements. By understanding the psychological factors that drive market behavior, investors can better navigate the complexities of the financial world and potentially capitalize on market inefficiencies. Moreover, investor psychology is essential for individual investors to manage their own emotions and biases. Emotions such as fear, greed, and overconfidence can significantly impact investment decisions and lead to suboptimal outcomes. By recognizing and managing these emotions, investors can make more rational and objective choices, increasing their chances of success in the market. 1.1.2 The evolution of investor psychology. The study of investor psychology has evolved significantly over the years. Traditionally, financial theories assumed that investors were rational and made decisions based on logical analysis of available information. However, empirical evidence has shown that investors often deviate from rationality due to various psychological biases and emotions. The field of behavioral finance emerged as a response to these deviations from rationality. Behavioral finance combines principles from psychology and economics to understand how individuals make financial decisions. It recognizes that investors are not always rational and seeks to explain the psychological factors that influence their behavior. 1.1.3 The role of emotions in investment decisions. Emotions play a significant role in investment decisions. Fear and greed are two primary emotions that can drive investors' behavior. Fear can lead to panic selling during market downturns, while greed can result in speculative bubbles and excessive risk-taking. Understanding and managing emotions is crucial for investors to avoid making impulsive and irrational decisions. Emotional intelligence, which involves recognizing and regulating one's emotions, can help investors make more objective choices. By developing emotional intelligence, investors can maintain a balanced and disciplined approach to investing. 1.1.4 Cognitive biases and their impact on investing. Cognitive biases are systematic errors in thinking that can lead to irrational decision-making. These biases are a result of the brain's attempt to simplify complex information processing. While they can be useful in certain situations, they can also lead to errors and suboptimal choices in the investment context. Some common cognitive biases include confirmation bias, where individuals seek information that confirms their existing beliefs, and anchoring bias, where individuals rely too heavily on the first piece of information they encounter. These biases can distort investors' perception of reality and lead to poor investment decisions. 1.1.5 The influence of social factors on investor behavior. Investor behavior is not only influenced by individual factors but also by social factors. Social influences, such as herd behavior and peer pressure, can significantly impact investment decisions. Investors often look to others for guidance and reassurance, leading to a herd mentality where individuals follow the actions of the crowd. Understanding the influence of social factors is crucial for investors to avoid making decisions solely based on the actions of others. By maintaining an independent perspective and conducting thorough research, investors can make more informed choices that align with their own investment goals and risk tolerance. In conclusion, investor psychology is a critical aspect of the investment process. By understanding the psychological factors that influence investment decisions, investors can make more rational and informed choices. This chapter has provided an introduction to investor psychology, highlighting the importance of emotions, cognitive biases, and social influences in shaping investor behavior. In the following chapters, we will delve deeper into these topics and explore strategies for overcoming biases and improving investment decision-making. 1.2 The role of emotions in investment decisions. Emotions play a significant role in investment decisions. While many investors believe that their decisions are solely based on rational analysis and objective data, research has shown that emotions often drive our investment choices more than we realize. Understanding the role of emotions in investment decisions is crucial for investors to make informed and rational choices. 1.2.1 The emotional roller coaster of investing. Investing can be an emotional roller coaster. The stock market is known for its volatility, and this volatility can trigger a range of emotions in investors, such as fear, greed, and excitement. These emotions can significantly impact investment decisions and potentially lead to irrational behavior. Fear is one of the most powerful emotions that can influence investment decisions. During market downturns or periods of uncertainty, fear can drive investors to sell their investments hastily, often resulting in significant losses. On the other hand, greed can lead investors to take excessive risks in pursuit of high returns, often ignoring the potential downsides. 1.2.2 The impact of fear and greed on investment decisions. Fear and greed are two emotions that can have a profound impact on investment decisions. When fear takes hold, investors may become overly cautious and sell their investments prematurely, missing out on potential gains. This behavior is often driven by a desire to avoid losses and protect capital. Conversely, when greed takes over, investors may become overly optimistic and take on excessive risks. This behavior is driven by a desire for high returns and can lead to impulsive and irrational investment decisions. Both fear and greed can cloud judgment and prevent investors from making rational choices based on sound analysis and long-term goals. 1.2.3 The role of cognitive biases in emotional decision-making. Emotions are closely intertwined with cognitive biases, which are systematic errors in thinking that can lead to irrational decision-making. These biases can influence how investors perceive and interpret information, leading to biased judgments and suboptimal investment decisions. One common cognitive bias is confirmation bias, which is the tendency to seek out information that confirms pre-existing beliefs and ignore information that contradicts them. This bias can lead investors to make decisions based on selective information, rather than considering the full picture. Another cognitive bias is anchoring bias, which occurs when investors rely too heavily on the first piece of information they receive when making decisions. This bias can lead to an overemphasis on initial prices or values, causing investors to hold onto investments longer than they should or make decisions based on outdated information. 1.2.4 Emotional contagion and herding behavior. Emotions can also be contagious in the investment world. When investors observe others making certain investment decisions based on emotions, they may be influenced to follow suit, leading to herding behavior. This behavior can create market bubbles or crashes, as investors collectively make irrational decisions based on emotions rather than rational analysis. During periods of market euphoria, such as the dot-com bubble in the late 1990s, investors were driven by the fear of missing out (FOMO) and the excitement of quick profits. This led to a surge in investment in technology stocks, ultimately resulting in a market crash when the bubble burst. Conversely, during market downturns, fear can spread rapidly, leading to panic selling and further exacerbating market declines. This herd mentality can amplify market volatility and create opportunities for contrarian investors who can detach themselves from the emotional frenzy. 1.2.5 Managing emotions for better investment decisions. Recognizing and managing emotions is essential for making rational investment decisions. Here are some strategies to help investors navigate the emotional aspects of investing. Self-awareness. Understanding your own emotional triggers and biases can help you make more rational decisions. Take the time to reflect on your emotions and how they may be influencing your investment choices. Education and research. Stay informed about the fundamentals of investing and the factors that drive market behavior. This knowledge can help you make more informed decisions based on objective analysis rather than emotions. Long-term perspective. Adopting a long-term perspective can help you ride out short-term market fluctuations and avoid making impulsive decisions based on emotions. Focus on your investment goals and the fundamentals of the companies or assets you are investing in. Diversification. Building a diversified portfolio can help mitigate the impact of emotional decision-making. By spreading your investments across different asset classes and sectors, you can reduce the risk of significant losses from individual investments. Seek professional advice. Consulting with a financial advisor can provide an objective perspective and help you make more rational investment decisions. A professional can help you navigate market volatility and provide guidance based on your individual financial goals. In conclusion, emotions play a significant role in investment decisions. Understanding the impact of emotions and cognitive biases can help investors make more rational choices and avoid common pitfalls. By managing emotions, staying informed, and adopting a long-term perspective, investors can improve their chances of achieving their investment goals and building long-term wealth. 1.3 Cognitive biases and their impact on investing. Cognitive biases are inherent mental shortcuts or patterns of thinking that can lead to irrational decision-making. These biases are a result of our brain's attempt to simplify complex information processing and make quick judgments. While they can be helpful in certain situations, they can also have a significant impact on investment decisions. 1.3.1 Anchoring bias. Anchoring bias refers to the tendency of individuals to rely too heavily on the first piece of information they receive when making decisions. In the context of investing, this bias can lead investors to anchor their decisions to a specific price or value, even if it is not rational or supported by market conditions. For example, an investor may anchor their decision to buy a stock at a certain price, even if the stock's value has significantly changed. This bias can be particularly dangerous when it comes to setting price targets or determining the value of an investment. Investors who are anchored to a specific price may be reluctant to sell a stock even when it is overvalued, or they may miss out on buying opportunities if they are waiting for a stock to reach a certain price. 1.3.2 Confirmation bias. Confirmation bias is the tendency to seek out information that confirms our existing beliefs or opinions while ignoring or dismissing information that contradicts them. In the context of investing, confirmation bias can lead investors to selectively interpret information in a way that supports their preconceived notions about an investment. For example, an investor who believes that a particular stock is undervalued may only pay attention to positive news or research that supports their belief, while ignoring negative information or alternative viewpoints. This bias can prevent investors from objectively evaluating the risks and potential downsides of an investment, leading to poor decision-making. To overcome confirmation bias, investors should actively seek out diverse perspectives and consider alternative viewpoints. By challenging their own beliefs and seeking out information that contradicts their initial assumptions, investors can make more informed and unbiased investment decisions. 1.3.3 Availability bias. Availability bias refers to the tendency to rely on readily available information or examples when making decisions, rather than considering a broader range of data. In the context of investing, this bias can lead investors to overweight recent or easily accessible information, while neglecting historical data or less accessible information. For example, if a particular sector or asset class has recently performed well, investors may be more likely to invest in that sector without considering the long-term performance or potential risks. This bias can lead to herd behavior and the formation of investment bubbles, as investors chase recent trends without fully evaluating the underlying fundamentals. To mitigate the impact of availability bias, investors should strive to gather a wide range of information from diverse sources and consider historical data and long-term trends. By taking a more comprehensive and balanced approach to information gathering, investors can make more rational and informed investment decisions. 1.3.4 Overconfidence bias. Overconfidence bias refers to the tendency of individuals to overestimate their own abilities or knowledge. In the context of investing, this bias can lead investors to believe that they have superior skills or insights compared to others, leading to excessive risk-taking or overtrading. Overconfident investors may be more likely to engage in speculative investments or make impulsive decisions based on their own perceived expertise. This bias can be particularly dangerous during periods of market volatility or uncertainty when investors may be more prone to making irrational decisions based on their own overconfidence. To overcome overconfidence bias, investors should regularly evaluate their investment performance objectively and seek feedback from trusted advisors or professionals. By acknowledging the limitations of their own knowledge and expertise, investors can make more rational and disciplined investment decisions. 1.3.5 Loss aversion bias. Loss aversion bias refers to the tendency of individuals to feel the pain of losses more strongly than the pleasure of gains. In the context of investing, this bias can lead investors to hold on to losing investments for longer than they should, in the hope of avoiding the pain of realizing a loss. This bias can prevent investors from cutting their losses and reallocating their capital to more promising opportunities. It can also lead to a reluctance to take on appropriate levels of risk, as investors may be more focused on avoiding losses rather than maximizing potential gains. To overcome loss aversion bias, investors should develop a disciplined approach to risk management and establish clear exit strategies for their investments. By setting predefined stop-loss levels or profit targets, investors can mitigate the impact of this bias and make more rational and objective investment decisions. 1.3.6 Conclusion. Cognitive biases can significantly impact investment decisions and lead to suboptimal outcomes. By understanding and recognizing these biases, investors can take steps to mitigate their impact and make more rational and informed investment decisions. It is important for investors to be aware of their own biases and to actively seek out diverse perspectives and information to counteract the influence of cognitive biases. 1.4 The influence of social factors on investor behavior. Social factors play a significant role in shaping investor behavior and decision-making. As humans, we are inherently social beings, and our actions and choices are often influenced by the people around us. This holds true in the world of investing as well, where social factors can have a profound impact on how individuals perceive and approach investment opportunities. 1.4.1 Herd mentality and groupthink. One of the most prominent social factors that influence investor behavior is the phenomenon of herd mentality. Herd mentality refers to the tendency of individuals to follow the actions and decisions of the majority, often without critically evaluating the information or considering alternative viewpoints. This behavior is driven by the fear of missing out and the desire to conform to the actions of others. In the investment world, herd mentality can lead to the formation of investment bubbles and market inefficiencies. When a large number of investors start buying or selling a particular asset based on the actions of others, it can create an artificial demand or supply, driving the prices of the asset to unsustainable levels. This behavior was evident during the dot-com bubble in the late 1990s and the housing bubble in the mid-2000s. Groupthink is another social phenomenon that can influence investor behavior. It occurs when a group of individuals conform to a particular viewpoint or decision without critically evaluating the alternatives. In the context of investing, groupthink can lead to a lack of diversity in investment strategies and a failure to consider different perspectives. This can result in suboptimal investment decisions and a higher susceptibility to market downturns. 1.4.2 Social proof and information cascades. Social proof is a psychological concept that suggests people tend to rely on the actions and opinions of others to determine the correct course of action. In the investment world, social proof can manifest in the form of following the investment decisions of successful investors or seeking validation from peers and experts. When investors observe others making successful investment decisions, they may feel more confident in following suit. This can create a positive feedback loop, where the actions of successful investors attract more investors, further driving up the prices of the assets. However, it is important to note that blindly following the actions of others without conducting proper due diligence can be risky and lead to poor investment outcomes. Information cascades are another social phenomenon that can influence investor behavior. An information cascade occurs when individuals base their decisions on the actions and choices of others, rather than on their own independent analysis. This can lead to a situation where individuals ignore their own information and instead rely on the actions of others, even if those actions are based on limited or flawed information. In the investment world, information cascades can result in the spread of misinformation and the amplification of market trends. For example, if a few influential investors start buying a particular stock based on incomplete or inaccurate information, others may follow suit, leading to a surge in demand for the stock. This can create an artificial price increase, which may not be sustainable in the long run. 1.4.3 Social networks and social media. The advent of social media has revolutionized the way information is disseminated and shared. Social networks and online communities have become platforms for investors to exchange ideas, share investment strategies, and discuss market trends. While these platforms can provide valuable insights and opportunities for collaboration, they can also contribute to the amplification of biases and the spread of misinformation. On social media platforms, investors are exposed to a wide range of opinions and viewpoints, which can influence their decision-making process. The fear of missing out, FOMO, can be heightened when investors see others profiting from certain investments or when they perceive a particular trend gaining momentum. This can lead to impulsive investment decisions driven by the desire to conform and avoid being left behind. Moreover, social media platforms can also be a breeding ground for rumors and false information. The rapid spread of information on these platforms can create a sense of urgency and panic, leading to irrational investment decisions. It is crucial for investors to critically evaluate the information they come across on social media and verify its credibility before making any investment decisions. 1.4.4 Social influence and cultural factors. Social influence and cultural factors can also significantly impact investor behavior. People's investment decisions are often influenced by their social circles, family, and cultural norms. For example, individuals from cultures that prioritize saving and conservative investment strategies may be more risk-averse compared to those from cultures that encourage entrepreneurial risk-taking. Additionally, social influence can play a role in shaping investment preferences. If an individual's peers or family members have had successful experiences with a particular investment, they may be more inclined to follow a similar path. On the other hand, negative experiences shared by others can create a sense of caution and skepticism. Understanding the influence of social factors on investor behavior is crucial for investors and financial professionals alike. By recognizing the impact of herd mentality, social proof, social networks, and cultural factors, investors can make more informed decisions and avoid falling prey to irrational behavior. It is important to critically evaluate information, seek diverse perspectives, and maintain an independent thought process when making investment decisions. 2. The psychology of risk and reward. 2.1 Risk perception and risk tolerance. Understanding risk perception and risk tolerance is crucial for investors to make informed decisions and manage their portfolios effectively. Risk perception refers to how individuals perceive and evaluate the potential risks associated with an investment, while risk tolerance refers to an individual's willingness to take on risk in pursuit of potential returns. 2.1.1 The nature of risk. Before delving into risk perception and risk tolerance, it is important to understand the nature of risk itself. In the context of investing, risk refers to the possibility of losing some or all of the invested capital. Every investment carries a certain level of risk, and it is essential for investors to assess and manage this risk effectively. Investors face various types of risks, including market risk, inflation risk, interest rate risk, credit risk, and liquidity risk, among others. Market risk, for example, refers to the potential for investments to decline in value due to factors such as economic conditions, market volatility, or geopolitical events. Inflation risk, on the other hand, refers to the possibility that the purchasing power of money will decrease over time, eroding the value of investments. 2.1.2 Risk perception. Risk perception is subjective and varies from individual to individual. It is influenced by a range of factors, including personal experiences, knowledge, beliefs, and emotions. Two investors may perceive the same investment differently based on their unique perspectives and biases. One factor that influences risk perception is the familiarity of an investment. Investors tend to perceive familiar investments as less risky compared to unfamiliar ones. This familiarity bias can lead to a false sense of security and potentially overlook the actual risks associated with an investment. Another factor that affects risk perception is the framing of information. The way information is presented can significantly impact how individuals perceive risk. For example, if an investment is presented as having a 90% chance of success, individuals may perceive it as less risky compared to an investment presented as having a 10% chance of failure, even though the underlying probabilities are the same. Additionally, individuals tend to be more sensitive to potential losses than gains, a phenomenon known as loss aversion. Loss aversion can lead to a heightened perception of risk and a reluctance to take on investments that have the potential for losses, even if the potential gains outweigh the potential losses. 2.1.3 Risk tolerance. Risk tolerance refers to an individual's willingness to take on risk in their investment portfolio. It is influenced by various factors, including financial goals, time horizon, investment knowledge, and personal circumstances. Financial goals play a significant role in determining an individual's risk tolerance. Investors with long-term goals, such as retirement planning, may have a higher risk tolerance as they have more time to recover from potential losses. On the other hand, investors with short-term goals, such as saving for a down payment on a house, may have a lower risk tolerance as they cannot afford significant fluctuations in their investment value. Time horizon is another crucial factor in determining risk tolerance. Investors with a longer time horizon can afford to take on more risk as they have more time to ride out market fluctuations and benefit from the potential long-term growth of their investments. Conversely, investors with a shorter time horizon may opt for more conservative investments to protect their capital. Investment knowledge and experience also influence risk tolerance. Investors who have a deep understanding of financial markets and investment strategies may have a higher risk tolerance as they feel more confident in their ability to navigate market volatility. Conversely, novice investors may have a lower risk tolerance as they are less familiar with investment concepts and may be more risk-averse. Personal circumstances, such as income stability and financial obligations, also impact risk tolerance. Individuals with stable income and minimal financial obligations may have a higher risk tolerance as they have a greater capacity to absorb potential losses. Conversely, individuals with unstable income or significant financial obligations may have a lower risk tolerance as they need to prioritize capital preservation. 2.1.4 Balancing risk perception and risk tolerance. Balancing risk perception and risk tolerance is essential for investors to make sound investment decisions. It is crucial to align investment strategies with individual risk tolerance to ensure that investors can stay committed to their investment plans during periods of market volatility. To achieve this balance, investors should assess their risk tolerance objectively and consider their financial goals, time horizon, investment knowledge, and personal circumstances. It is also important to regularly review and reassess risk tolerance as circumstances and goals may change over time. Diversification is another strategy that can help manage risk perception and risk tolerance. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce the impact of individual investment losses and potentially enhance returns. Diversification can help mitigate the perception of risk by reducing the reliance on a single investment or asset class. Lastly, seeking professional advice from financial advisors can provide valuable insights and guidance in managing risk perception and risk tolerance. Financial advisors can help investors assess their risk tolerance objectively, develop appropriate investment strategies, and provide ongoing support and advice to navigate market fluctuations. In conclusion, understanding risk perception and risk tolerance is crucial for investors to make informed investment decisions. Risk perception is subjective and influenced by various factors, including familiarity bias, framing of information, and loss aversion. Risk tolerance, on the other hand, is influenced by financial goals, time horizon, investment knowledge, and personal circumstances. Balancing risk perception and risk tolerance is essential for investors to develop effective investment strategies and achieve their financial goals. 2.2 The fear of missing out, FOMO, and its effects on investment decisions. The fear of missing out, FOMO, is a powerful psychological phenomenon that can significantly impact investment decisions. FOMO refers to the anxiety or unease that individuals experience when they believe others are participating in a rewarding opportunity or experience, and they are not. In the context of investing, FOMO can lead investors to make impulsive and irrational decisions driven by the fear of missing out on potential gains. The nature of FOMO. FOMO is deeply rooted in human nature and has been amplified in the digital age. With the rise of social media and instant access to information, investors are constantly bombarded with news about successful investments, market trends, and stories of overnight wealth accumulation. This constant exposure to others' successes can trigger feelings of envy, insecurity, and the fear of being left behind. The impact on investment decisions. The fear of missing out can have a profound impact on investment decisions. When investors experience FOMO, they may feel compelled to jump into an investment without conducting proper research or analysis. They fear that if they don't act quickly, they will miss out on significant returns. This impulsive behavior can lead to poor investment choices and increased risk exposure. FOMO can also create a herd mentality among investors. When individuals see others profiting from a particular investment, they may feel pressured to follow suit, even if they do not fully understand the investment or its potential risks. This herd behavior can lead to market bubbles and subsequent crashes when the investment's true value is not supported by fundamentals. Emotional and cognitive biases. FOMO is closely linked to several emotional and cognitive biases that can cloud investors' judgment. One such bias is the availability heuristic, which causes individuals to overestimate the importance or likelihood of an event based on how easily they can recall similar events. When investors constantly hear success stories and see others profiting, they may overestimate the probability of achieving similar results. Confirmation bias is another cognitive bias that can be exacerbated by FOMO. Investors tend to seek out information that confirms their pre-existing beliefs or desires. When experiencing FOMO, investors may selectively focus on positive news or opinions about an investment, ignoring or downplaying any negative information that could challenge their decision to invest. Overcoming FOMO. Recognizing and managing FOMO is crucial for making rational investment decisions. Here are some strategies to help investors overcome the fear of missing out. 1. Set clear investment goals. Having clear investment goals can help investors stay focused and avoid impulsive decisions driven by FOMO. By defining their objectives and time horizon, investors can evaluate potential investments based on their alignment with these goals, rather than succumbing to the fear of missing out on short-term gains. 2. Conduct thorough research. Before making any investment, it is essential to conduct thorough research and analysis. Investors should evaluate the fundamentals of the investment, assess its risk-reward profile, and consider its fit within their overall investment strategy. By taking the time to gather information and make informed decisions, investors can reduce the influence of FOMO on their investment choices. 3. Practice patience and discipline. Investing is a long-term endeavor, and success often comes from patient and disciplined decision-making. Investors should resist the urge to chase short-term gains driven by FOMO and instead focus on their long-term investment objectives. By maintaining discipline and sticking to their investment strategy, investors can avoid making impulsive decisions based on the fear of missing out. 4. Diversify your portfolio. Diversification is a key risk management strategy that can help mitigate the impact of FOMO-driven investment decisions. By spreading investments across different asset classes and sectors, investors can reduce their exposure to the performance of a single investment. This diversification can provide a sense of security and reduce the fear of missing out on a single opportunity. 5. Seek professional advice. Working with a qualified financial advisor can provide valuable guidance and help investors navigate the emotional challenges associated with FOMO. A financial advisor can provide an objective perspective, help investors assess their risk tolerance, and develop a personalized investment strategy that aligns with their goals and values. Conclusion. The fear of missing out, FOMO, can have a significant impact on investment decisions. It can lead to impulsive and irrational behavior, herd mentality, and increased risk exposure. Recognizing and managing FOMO is crucial for making rational investment choices. By setting clear goals, conducting thorough research, practicing patience and discipline, diversifying their portfolio, and seeking professional advice, investors can overcome the fear of missing out and make informed investment decisions based on their long-term objectives. 2.3 The illusion of control and overconfidence in investing. Investing in the financial markets can be a complex and unpredictable endeavor. It requires careful analysis, research, and decision-making. However, despite the inherent uncertainty, many investors fall victim to the illusion of control and overconfidence in their investment abilities. This cognitive bias can have significant implications for their investment outcomes. The illusion of control. The illusion of control refers to the tendency of individuals to believe that they have more control over outcomes than they actually do. In the context of investing, this bias manifests when investors believe that they can accurately predict and control the performance of their investments. They may engage in excessive trading, trying to time the market or make quick profits based on their perceived ability to control the outcome. This illusion can be fueled by various factors, such as past successes, overestimation of one's knowledge and skills, or a desire for certainty in an uncertain environment. Investors may develop a false sense of confidence in their abilities, leading them to take on excessive risks or make impulsive investment decisions. However, the reality is that the financial markets are influenced by a multitude of factors, including economic conditions, geopolitical events, and investor sentiment, which are beyond an individual investor's control. The illusion of control can lead to overtrading, higher transaction costs, and ultimately, poor investment performance. Overconfidence in investing. Overconfidence is another cognitive bias that can significantly impact investment decisions. It refers to the tendency of individuals to overestimate their abilities and the accuracy of their judgments. In the context of investing, overconfidence can lead investors to believe that they possess superior skills or information compared to others in the market. Overconfident investors may take on excessive risks, trade more frequently, and fail to adequately diversify their portfolios. They may also ignore or downplay the importance of objective data and analysis, relying instead on their own intuition or gut feelings. Research has consistently shown that overconfident investors tend to underperform the market over the long term. This is because their overestimation of their abilities can lead to poor investment decisions, such as holding on to losing positions for too long or selling winning positions too early. The impact on investment performance. The illusion of control and overconfidence can have detrimental effects on investment performance. When investors believe they have control over outcomes and possess superior skills, they may take on excessive risks or engage in speculative trading strategies. This can result in significant losses and erode their investment capital. Moreover, the illusion of control and overconfidence can lead to a lack of diversification in investment portfolios. Overconfident investors may concentrate their investments in a few assets or sectors, believing that they have identified the best opportunities. However, this lack of diversification exposes them to higher levels of risk, as their portfolios become more susceptible to the performance of a limited number of investments. Furthermore, the illusion of control and overconfidence can hinder investors' ability to adapt to changing market conditions. They may be resistant to new information or alternative viewpoints, leading to a reluctance to adjust their investment strategies when necessary. Mitigating the illusion of control and overconfidence. Recognizing and addressing the illusion of control and overconfidence is crucial for investors who seek to improve their investment outcomes. Here are some strategies to mitigate these biases. Objective analysis. Rely on objective data, analysis, and research rather than relying solely on intuition or gut feelings. Consider multiple perspectives and seek out diverse sources of information. Diversification. Maintain a well-diversified portfolio across different asset classes, sectors, and geographic regions. Diversification helps to reduce the impact of individual investment performance on the overall portfolio. Risk management. Implement risk management strategies, such as setting stop-loss orders or using trailing stops, to limit potential losses. Establishing clear risk tolerance levels can help prevent impulsive and emotionally driven investment decisions. Continuous learning. Stay informed about market trends, economic indicators, and investment strategies. Continuously educate yourself to enhance your investment knowledge and skills. Seek feedback. Regularly seek feedback from trusted advisors or professionals in the field. Engaging in constructive discussions and considering alternative viewpoints can help challenge and refine your investment decisions. Maintain realistic expectations. Recognize that investing involves inherent uncertainty and that no one can consistently predict market movements. Set realistic expectations for investment returns and avoid chasing unrealistic gains. By addressing the illusion of control and overconfidence, investors can make more rational and informed investment decisions. This can lead to improved investment performance and long-term financial success. 2.4 The relationship between risk and return. Understanding the relationship between risk and return is crucial for investors. It is a fundamental concept in finance that helps investors make informed decisions about their investments. In this section, we will explore the concept of risk and return, how they are related, and the implications for investment strategies. 2.4.1 Defining risk and return. Before delving into the relationship between risk and return, it is important to understand what these terms mean in the context of investing. Risk refers to the uncertainty or variability of returns associated with an investment. It represents the possibility of losing some or all of the invested capital. Different investments carry different levels of risk. For example, stocks are generally considered riskier than bonds because their returns are more volatile. Return is the gain or loss generated from an investment over a specific period. It is usually expressed as a percentage of the initial investment. Returns can come in the form of capital appreciation, dividends, or interest payments. 2.4.2 The risk-return trade-off. The relationship between risk and return can be summarized by the risk-return trade-off. This concept suggests that higher returns are generally associated with higher levels of risk, and vice versa. In other words, investors must be willing to accept more risk if they want the potential for higher returns. This trade-off arises from the fact that riskier investments have a higher probability of experiencing negative returns or even losses. To compensate investors for taking on this additional risk, these investments offer the potential for higher returns. Conversely, less risky investments tend to offer lower returns as they provide a higher level of capital preservation. 2.4.3 Types of risk. To fully understand the relationship between risk and return, it is important to consider the different types of risk that investors face. Market risk is the risk that an investment's value will decline due to factors affecting the overall market, such as economic conditions, political events, or changes in interest rates. This type of risk cannot be eliminated through diversification. Credit risk refers to the risk of default by the issuer of a bond or other fixed income security. It is the risk that the issuer will not be able to make interest payments or repay the principal amount. Liquidity risk is the risk that an investment cannot be easily bought or sold without causing a significant impact on its price. Investments with low liquidity may be difficult to sell quickly, potentially resulting in a loss. Inflation risk is the risk that the purchasing power of an investment's returns will be eroded over time due to inflation. Inflation can reduce the real value of investment returns, especially if the returns do not keep pace with the rate of inflation. 2.4.4 Diversification and risk return. Diversification is a risk management strategy that involves spreading investments across different asset classes, sectors, or geographic regions. By diversifying their portfolios, investors aim to reduce the overall risk without sacrificing potential returns. Diversification works on the principle that different investments have different risk-return profiles. By combining investments with low or negative correlations, the overall risk of the portfolio can be reduced. This means that if one investment performs poorly, the impact on the overall portfolio will be minimized. However, it is important to note that diversification does not eliminate all risk. It cannot protect against systematic risks that affect the entire market, such as a global economic downturn. It can only mitigate unsystematic risks, which are specific to individual investments or sectors. 2.4.5 Assessing risk and return. When evaluating investment opportunities, investors must consider both the potential return and the associated risk. This assessment involves analyzing various factors, including the investment's historical performance, volatility, and correlation with other assets. Historical performance provides insights into how an investment has performed in the past. It helps investors gauge the potential return and risk associated with the investment. However, past performance is not a guarantee of future results. Volatility measures the degree of fluctuation in an investment's returns. Higher volatility indicates a greater potential for both gains and losses. Investors with a lower risk tolerance may prefer investments with lower volatility. Correlation measures the relationship between the returns of two or more investments. Investments with a high positive correlation tend to move in the same direction, while those with a negative correlation move in opposite directions. Diversification is most effective when investments have low or negative correlations. 2.4.6 Balancing risk and return. Finding the right balance between risk and return is a key consideration for investors. The optimal balance depends on various factors, including an investor's financial goals, time horizon, and risk tolerance. Financial goals differ from one investor to another. Some investors may prioritize capital preservation and a steady income stream, while others may seek aggressive growth. The risk-return trade-off should align with an investor's specific financial goals. Time horizon refers to the length of time an investor plans to hold an investment. Generally, longer time horizons allow for a higher tolerance for risk, as there is more time to recover from potential losses. Shorter time horizons may require a more conservative approach to minimize the risk of capital loss. Risk tolerance is an investor's ability to withstand fluctuations in the value of their investments. It is influenced by factors such as age, income, investment experience, and personal circumstances. Investors with a higher risk tolerance may be more comfortable with investments that offer higher potential returns but also higher levels of risk. Conclusion. The relationship between risk and return is a fundamental concept in investing. Investors must understand the trade-off between the two and find the right balance that aligns with their financial goals, time horizon, and risk tolerance. Diversification and careful assessment of risk and return are essential tools for managing investment portfolios effectively. By considering these factors, investors can make informed decisions and increase their chances of achieving their investment objectives. 3. Behavioral finance and market anomalies. 3.1 An introduction to behavioral finance. Behavioral finance is a field of study that combines principles of psychology with traditional finance to understand and explain the behavior of investors in financial markets. It recognizes that investors are not always rational and that their decisions are often influenced by cognitive biases, emotions, and social factors. By examining these psychological factors, behavioral finance seeks to provide insights into why investors make certain decisions and how these decisions impact market outcomes. 3.1.1 The evolution of behavioral finance. Traditional finance theory assumes that investors are rational and make decisions based on all available information. However, behavioral finance challenges this assumption by highlighting the role of psychological biases in investment decision-making. The field of behavioral finance emerged in the late 20th century as researchers began to question the rationality assumption and explore the psychological factors that influence investor behavior. 3.1.2 The role of heuristics and biases. One of the key concepts in behavioral finance is the idea that investors often rely on heuristics, or mental shortcuts, when making investment decisions. These heuristics can lead to biases that result in suboptimal investment choices. For example, the availability heuristic leads investors to rely on readily available information when making decisions, even if it is not representative of the overall market. This can lead to overreaction to recent news or events, causing prices to deviate from their fundamental values. Another common bias is the anchoring bias, which occurs when investors rely too heavily on a specific piece of information when making decisions. For example, an investor may anchor their valuation of a stock to its recent high price, leading them to overvalue the stock and potentially make poor investment choices. 3.1.3 Prospect theory and loss aversion. Prospect theory is a fundamental concept in behavioral finance that explains how individuals make decisions under conditions of uncertainty. According to prospect theory, individuals are more sensitive to losses than gains, and they weigh potential losses more heavily than potential gains. This phenomenon, known as loss aversion, can lead investors to make irrational decisions, such as holding on to losing investments for too long or selling winning investments too soon. Loss aversion can also contribute to the occurrence of market anomalies, such as the disposition effect. The disposition effect refers to the tendency of investors to sell winning investments too soon in order to lock in gains, while holding on to losing investments in the hope of a future recovery. This behavior can lead to suboptimal investment outcomes and is driven by the desire to avoid the pain of realizing a loss. 3.1.4 Behavioral biases and market efficiency. One of the key debates in behavioral finance is the impact of psychological biases on market efficiency. Traditional finance theory assumes that markets are efficient and that prices reflect all available information. However, behavioral finance argues that psychological biases can lead to market inefficiencies and mispricings. For example, the presence of herding behavior, where investors follow the actions of others rather than making independent decisions, can lead to market bubbles and crashes. When investors herd, they often ignore fundamental information and rely on the actions of others as a signal for their own investment decisions. This can result in the formation of speculative bubbles, where asset prices become detached from their intrinsic values. 3.1.5 The role of behavioral finance in investment decision-making. Understanding the principles of behavioral finance can be valuable for investors in making more informed investment decisions. By recognizing the influence of psychological biases, investors can take steps to mitigate their impact and make more rational choices. One approach is to develop a disciplined investment strategy that is based on a thorough analysis of fundamental factors rather than short-term market trends. By focusing on long-term goals and avoiding impulsive decisions driven by emotions, investors can reduce the impact of biases such as the fear of missing out (FOMO) or the temptation to chase short-term gains. Additionally, investors can benefit from diversification, which helps to reduce the impact of individual investment decisions on overall portfolio performance. By spreading investments across different asset classes and sectors, investors can minimize the impact of any single investment's performance on their overall portfolio. In conclusion, behavioral finance provides valuable insights into the psychology of investors and the factors that influence their decision-making. By understanding the role of heuristics, biases, and emotions, investors can make more rational and informed investment choices. While it is impossible to completely eliminate the influence of psychological factors, being aware of them can help investors navigate the complexities of financial markets and improve their long-term investment outcomes. 3.2 Market anomalies and their explanations. Market anomalies are phenomena that deviate from the traditional assumptions of efficient markets. These anomalies challenge the notion that markets are always rational and efficient in processing information. Instead, they suggest that investor behavior is influenced by psychological biases and emotions, leading to predictable patterns in market prices and returns. In this section, we will explore some of the most well-known market anomalies and their explanations from the perspective of behavioral finance. 3.2.1 The January effect. The January effect is a market anomaly that refers to the historical pattern of stock prices experiencing a significant increase during the month of January. This phenomenon has been observed across various stock markets around the world. One possible explanation for the January effect is tax loss selling. Investors tend to sell their losing stocks at the end of the year to offset capital gains taxes. As a result, these stocks experience a temporary decrease in demand, leading to lower prices. In January, when the tax selling pressure subsides, these stocks may rebound, causing an increase in prices. Another explanation for the January effect is investor psychology. The start of a new year often brings renewed optimism and enthusiasm among investors. This positive sentiment may lead to increased buying activity, driving up stock prices. Additionally, institutional investors may reallocate their portfolios at the beginning of the year, which can also contribute to the January effect. 3.2.2 The size effect. The size effect is a market anomaly that suggests that smaller companies tend to outperform larger companies over the long term. This contradicts the traditional belief that larger companies are safer and more stable investments. One explanation for the size effect is the risk premium associated with investing in smaller companies. Smaller companies are generally considered riskier due to their limited resources and higher volatility. As a result, investors may require a higher return to compensate for the additional risk, leading to higher long-term returns for smaller companies. Another explanation for the size effect is the mispricing of smaller companies. Behavioral finance suggests that investors may have a bias towards larger, well-known companies, leading to an underestimation of the value of smaller companies. This underestimation can create opportunities for investors to capitalize on the undervalued stocks of smaller companies, resulting in higher returns. 3.2.3 The value effect. The value effect is a market anomaly that suggests that stocks with low price-to-earnings (PE) ratios or other value metrics tend to outperform stocks with high PE ratios or growth stocks. This contradicts the traditional belief that high-growth companies should generate higher returns. One explanation for the value effect is investor overreaction to short-term news and earnings announcements. Investors may become overly optimistic about high-growth companies, leading to inflated stock prices. Conversely, they may become overly pessimistic about value stocks, causing their prices to be undervalued. Over time, as the market corrects these mispricings, value stocks tend to outperform growth stocks. Another explanation for the value effect is the behavioral bias of anchoring. Anchoring refers to the tendency of investors to rely too heavily on a specific piece of information when making investment decisions. In the case of value stocks, investors may anchor their valuation on the low price or low PE ratio, leading to a bias towards undervalued stocks. This bias can create opportunities for investors to earn higher returns by investing in undervalued stocks. 3.2.4 The momentum effect. The momentum effect is a market anomaly that suggests that stocks that have performed well in the past tend to continue to perform well in the future, while stocks that have performed poorly tend to continue to underperform. This contradicts the traditional belief that stock prices follow a random walk and are not predictable. One explanation for the momentum effect is investor herding behavior. When a stock's price starts to rise, investors may perceive it as a signal of positive news or strong performance. This perception attracts more investors, leading to a further increase in price. Similarly, when a stock's price starts to decline, investors may perceive it as a signal of negative news or poor performance, leading to a further decrease in price. Another explanation for the momentum effect is the behavioral bias of availability bias. Availability bias refers to the tendency of investors to rely on readily available information when making investment decisions. When a stock's recent positive performance is easily accessible and memorable, investors may overweight this information and expect the trend to continue. This bias can create momentum in stock prices, leading to the continuation of the trend. 3.2.5 The overreaction effect. The overreaction effect is a market anomaly that suggests that stock prices tend to overreact to new information, leading to temporary mispricings. This creates opportunities for investors to earn abnormal returns by taking advantage of the market's overreaction. One explanation for the overreaction effect is investor cognitive biases, such as the representativeness bias and the confirmation bias. The representativeness bias refers to the tendency of investors to rely on stereotypes or mental shortcuts when evaluating new information. When new information aligns with their preconceived notions or expectations, investors may overreact and push stock prices to extreme levels. The confirmation bias refers to the tendency of investors to seek out information that confirms their existing beliefs and ignore information that contradicts them. This bias can amplify the market's overreaction to new information. Another explanation for the overreaction effect is the role of institutional investors. Institutional investors, such as mutual funds and pension funds, often have strict investment guidelines and performance benchmarks. When new information is released, these institutional investors may be forced to buy or sell stocks to align their portfolios with their guidelines or benchmarks. This buying or selling pressure can lead to overreactions in stock prices. Market anomalies provide valuable insights into the irrational behavior of investors and the limitations of traditional finance theories. By understanding these anomalies and their explanations from the perspective of behavioral finance, investors can make more informed investment decisions and potentially capitalize on the predictable patterns in market prices and returns. 3.3 The role of herding behavior in financial markets. In the world of finance, the behavior of investors can often be influenced by the actions of others. One such behavior that has a significant impact on financial markets is herding behavior. Herding behavior refers to the tendency of individuals to follow the actions and decisions of a larger group, rather than making independent judgments based on their own analysis and information. The nature of herding behavior. Herding behavior is a natural human instinct that stems from our desire to conform and avoid making decisions that may be perceived as different or risky. In the context of financial markets, herding behavior occurs when investors follow the crowd, buying or selling assets based on the actions of others, rather than on their own analysis of the underlying fundamentals. This behavior can be observed in various forms, such as when investors rush to buy a particular stock because they see others doing the same, or when they panic and sell their holdings during a market downturn because they see others doing so. Herding behavior can lead to the formation of market bubbles and crashes, as well as the amplification of market volatility. The causes of herding behavior. There are several factors that contribute to the prevalence of herding behavior in financial markets. One of the primary causes is the availability of information. In today's digital age, investors have access to a vast amount of information and news that can influence their decision-making process. However, this abundance of information can also lead to information overload and cognitive biases, making it easier for investors to rely on the actions of others rather than conducting their own analysis. Another factor that contributes to herding behavior is the influence of social networks and media. People tend to seek validation and reassurance from others, and this need for social approval can drive them to follow the crowd. Social media platforms and financial news outlets play a significant role in shaping investor sentiment and can create a sense of urgency or fear of missing out (FOMO) that drives investors to join the herd. The impact of herding behavior. Herding behavior can have both positive and negative consequences in financial markets. In some cases, herding behavior can lead to the efficient pricing of assets, as the collective wisdom of the crowd can help identify mispriced securities. However, herding behavior can also lead to market inefficiencies and irrational price movements. One of the main risks associated with herding behavior is the formation of market bubbles. When investors collectively rush to buy a particular asset, driven by the fear of missing out on potential gains, the price of that asset can become detached from its underlying value. This can create an unsustainable price bubble that eventually bursts, leading to significant losses for those who joined the herd late. Herding behavior can also contribute to market crashes. During periods of market stress or uncertainty, investors may panic and sell their holdings, fearing further losses. This selling pressure can trigger a chain reaction, as other investors observe the downward trend and also decide to sell, leading to a rapid decline in prices. This herd mentality can exacerbate market volatility and make it difficult for rational investors to make informed decisions. Strategies to mitigate herding behavior. Recognizing and understanding the impact of herding behavior is crucial for investors who aim to make rational and informed decisions. Here are some strategies that can help mitigate the negative effects of herding behavior. 1. Independent analysis. Investors should conduct their own analysis and research before making investment decisions. Relying solely on the actions of others can lead to poor investment choices. By conducting independent analysis, investors can make more informed decisions based on their own assessment of the underlying fundamentals. 2. Diversification. Diversification is a key strategy to reduce the impact of herding behavior. By spreading investments across different asset classes and sectors, investors can minimize the risk of being overly exposed to the actions of a single group or market segment. Diversification helps to protect against the potential losses that can occur if a particular asset or sector experiences a sudden downturn due to herding behavior. 3. Long-term perspective. Taking a long-term perspective can help investors avoid the short-term fluctuations and noise caused by herding behavior. By focusing on the underlying value and fundamentals of an investment, rather than short-term market sentiment, investors can make more rational decisions that align with their long-term goals. 4. Education and awareness. Investors should educate themselves about the psychological biases and behaviors that can influence decision-making. By being aware of the potential pitfalls of herding behavior, investors can better recognize when they are being influenced by the actions of others and make more independent choices. 5. Contrarian investing. Contrarian investing involves taking positions that are opposite to the prevailing market sentiment. By going against the herd, contrarian investors aim to capitalize on market inefficiencies and mispriced assets. However, contrarian investing requires careful analysis and a strong conviction in one's own analysis. Conclusion. Herding behavior is a prevalent phenomenon in financial markets, driven by the natural human instinct to conform and seek validation from others. While herding behavior can sometimes lead to efficient pricing and collective wisdom, it can also contribute to market bubbles, crashes, and irrational price movements. Recognizing the impact of herding behavior and implementing strategies to mitigate its negative effects is crucial for investors who aim to make rational and informed decisions. By conducting independent analysis, diversifying investments, taking a long-term perspective, and staying educated and aware, investors can navigate the challenges posed by herding behavior and increase their chances of investment success. 3.4 The impact of anchoring and framing on investment decisions. Anchoring and framing are two cognitive biases that significantly influence investment decisions. These biases can lead investors to make irrational choices based on irrelevant or misleading information. Understanding how anchoring and framing affect our decision-making process is crucial for investors to make informed and rational investment choices. 3.4.1 Anchoring bias. Anchoring bias refers to the tendency of individuals to rely heavily on the first piece of information they receive when making decisions. In the context of investing, this bias occurs when investors anchor their decisions to a specific reference point, such as the initial price they paid for a stock or the highest price the stock has ever reached. For example, imagine an investor purchases a stock at $50 per share. The stock price subsequently drops to $40 per share. Instead of objectively evaluating the current value of the stock, the investor may anchor their decision-making process to the initial purchase price of $50. This anchoring bias may prevent the investor from selling the stock at $40, even if it is a rational decision based on the current market conditions. Anchoring bias can also be observed in the way investors interpret financial news and market trends. If a stock is consistently portrayed as a high-performing investment, investors may anchor their expectations to this positive framing. As a result, they may be reluctant to sell the stock even when its performance starts to decline. 3.4.2 Framing bias. Framing bias refers to the way information is presented or framed, which can significantly influence decision-making. The same information presented in different ways can lead to different investment choices. This bias highlights the importance of how information is communicated and perceived by investors. For example, consider a scenario where an investment opportunity is presented as having a 90% success rate. This positive framing may lead investors to perceive the opportunity as highly favorable and increase their willingness to invest. On the other hand, if the same opportunity is framed as having a 10% failure rate, investors may perceive it as risky and be less inclined to invest. Framing bias can also be observed in the way investment options are presented to investors. For instance, if a financial advisor presents two investment options, one is low risk, and the other is high risk, investors may be more likely to choose the low risk option due to the positive framing. However, this framing may not accurately reflect the potential returns and risks associated with each option. 3.4.3 The influence of anchoring and framing on investment decisions. Both anchoring and framing biases can have a significant impact on investment decisions. These biases can lead investors to make irrational choices based on irrelevant or misleading information, rather than objectively evaluating the current market conditions and investment opportunities. Anchoring bias can prevent investors from adjusting their investment decisions based on new information. By anchoring their decisions to a specific reference point, investors may hold on to investments that are no longer favorable or fail to take advantage of new opportunities. Framing bias can influence investors' perception of risk and reward. Positive framing may lead investors to underestimate the risks associated with an investment, while negative framing may lead to an overestimation of risks. This bias can result in suboptimal investment choices and missed opportunities for growth. 3.4.4 Overcoming anchoring and framing biases. Recognizing and overcoming anchoring and framing biases is essential for investors to make rational and informed investment decisions. Here are some strategies to mitigate the impact of these biases. Awareness and mindfulness. Being aware of the existence of anchoring and framing biases is the first step towards overcoming them. By consciously considering alternative perspectives and information, investors can avoid being solely influenced by initial reference points or biased framing. Diversification. Building a diversified investment portfolio can help mitigate the impact of anchoring and framing biases. By spreading investments across different asset classes and sectors, investors can reduce their reliance on specific reference points or biased framing associated with individual investments. Objective analysis. Conducting thorough research and analysis is crucial for making informed investment decisions. By evaluating investments based on their intrinsic value and market conditions rather than relying solely on initial purchase prices or biased framing, investors can make more rational choices. Seeking diverse opinions. Engaging with a diverse range of perspectives and seeking advice from professionals can help investors overcome anchoring and framing biases. By considering different viewpoints, investors can gain a more comprehensive understanding of investment opportunities and make more objective decisions. Regular review and adjustment. Regularly reviewing investment portfolios and adjusting strategies based on new information can help investors overcome anchoring bias. By actively monitoring investments and being open to adjusting decisions, investors can avoid being anchored to outdated reference points. Education and self-awareness. Continuously educating oneself about behavioral finance and investor psychology can enhance self-awareness and help investors recognize and overcome biases. By understanding the impact of anchoring and framing biases, investors can develop strategies to mitigate their influence on decision-making. By implementing these strategies, investors can reduce the impact of anchoring and framing biases on their investment decisions. Overcoming these biases is crucial for making rational choices based on objective analysis and maximizing long-term investment success. 3.5 The power of loss aversion in investor behavior. Loss aversion is a fundamental concept in investor psychology that plays a significant role in shaping investment decisions. It refers to the tendency of individuals to feel the pain of losses more intensely than the pleasure of gains. In other words, people are more motivated to avoid losses than to achieve equivalent gains. This cognitive bias has a profound impact on how investors perceive and react to risk, leading to certain patterns of behavior that can influence investment outcomes. 3.5.1 Understanding loss aversion. Loss aversion is deeply rooted in human nature and has been extensively studied in the field of behavioral finance. The pioneering work of psychologists Daniel Kahneman and Amos Tversky shed light on the asymmetrical way individuals respond to gains and losses. According to their research, the emotional impact of a loss is approximately twice as powerful as the joy derived from an equivalent gain. This aversion to losses can be traced back to our evolutionary history. In primitive times, avoiding losses was crucial for survival. The fear of losing resources, such as food or shelter, was a powerful motivator that helped our ancestors navigate a challenging environment. This instinctual response has carried over into modern society and manifests itself in various aspects of our lives, including investing. 3.5.2 The impact on investment decisions. Loss aversion has a profound impact on investment decisions, often leading to suboptimal outcomes. Investors tend to be more risk-averse when faced with potential losses, even if the potential gains outweigh the risks. This aversion to losses can result in several behavioral patterns that can hinder investment success. 3.5.2.1 Reluctance to sell losing investments. One common manifestation of loss aversion is the reluctance to sell losing investments. Investors often hold on to losing positions in the hope that they will eventually recover and avoid realizing the loss. This behavior, known as the disposition effect, can lead to a phenomenon called the fallacy of sunk costs, where investors continue to hold on to losing investments based on past decisions rather than objective analysis of future prospects. 3.5.2.2 Overemphasis on short-term performance. Loss aversion can also lead to an overemphasis on short-term performance. Investors may become overly concerned with avoiding short-term losses, leading them to make impulsive decisions based on market fluctuations. This short-term focus can prevent investors from taking a long-term perspective and benefiting from the potential growth of their investments. 3.5.2.3 Herding behavior. Loss aversion can contribute to herding behavior in financial markets. When investors see others selling their investments and avoiding potential losses, they may feel compelled to do the same, even if it goes against their long-term investment strategy. This herd mentality can amplify market volatility and lead to irrational investment decisions. 3.5.3 Mitigating the impact of loss aversion. While loss aversion is a deeply ingrained cognitive bias, there are strategies that investors can employ to mitigate its impact on investment decisions. 3.5.3.1 Diversification. Diversification is a powerful tool for managing the impact of loss aversion. By spreading investments across different asset classes and sectors, investors can reduce the potential impact of individual losses. Diversification helps to smooth out the overall portfolio performance and provides a buffer against the emotional impact of individual investment losses. 3.5.3.2 Long-term perspective. Taking a long-term perspective can help investors overcome the short-term focus caused by loss aversion. By focusing on the fundamental value and long-term prospects of investments, investors can avoid making impulsive decisions based on short-term market fluctuations. A long-term perspective allows investors to ride out temporary market downturns and benefit from the potential growth of their investments over time. 3.5.3.3 Rational decision-making. Developing a rational decision-making process is crucial for mitigating the impact of loss aversion. Investors should base their decisions on objective analysis and research rather than emotional reactions to potential losses. By employing a systematic approach to investment decision-making, investors can reduce the influence of loss aversion and make more informed choices. 3.5.3.4 Seeking professional advice. Seeking professional advice can also help investors navigate the impact of loss aversion. Financial advisors can provide objective guidance and help investors make rational decisions based on their individual financial goals and risk tolerance. By working with a trusted advisor, investors can gain a broader perspective and avoid making impulsive decisions driven by loss aversion. 3.5.4 Conclusion. Loss aversion is a powerful force in investor behavior that can significantly impact investment decisions. Understanding the influence of loss aversion and its associated behavioral patterns is crucial for investors seeking to make informed choices and achieve long-term investment success. By recognizing the impact of loss aversion and employing strategies to mitigate its effects, investors can overcome this cognitive bias and make rational decisions that align with their financial goals. 3.6 The influence of availability bias on investment choices. Availability bias is a cognitive bias that affects the way investors make decisions. It refers to the tendency of individuals to rely on information that is readily available to them when making judgments or decisions, rather than considering all relevant information. This bias can have a significant impact on investment choices and can lead to suboptimal decision-making. 3.6.1 Understanding availability bias. Availability bias occurs when individuals base their judgments or decisions on information that is easily accessible or that comes to mind quickly. This bias is influenced by various factors, including the frequency and recency of information, personal experiences, media exposure, and the vividness of certain events or examples. For example, investors may be more likely to invest in a particular stock if they have recently seen or heard positive news about it, even if there is other relevant information that suggests otherwise. Similarly, investors may be more inclined to avoid certain investments if they have heard stories of others losing money in similar ventures, even if there is evidence to support their potential profitability. 3.6.2 The impact on investment choices. Availability bias can have a significant impact on investment choices. When investors rely heavily on information that is readily available, they may overlook or underestimate other relevant factors that could affect the performance of their investments. This bias can lead to a narrow focus on recent or easily accessible information, which may not accurately represent the overall market conditions or the long-term prospects of an investment. For example, during periods of market volatility, investors may be more likely to sell their investments based on the availability of negative news or the fear of potential losses. This knee-jerk reaction can result in selling at a low point in the market, missing out on potential gains when the market eventually recovers. On the other hand, availability bias can also lead to overconfidence in certain investments. If investors have experienced recent success with a particular stock or asset class, they may become overly optimistic about its future performance, ignoring other relevant information that suggests a more cautious approach. 3.6.3 Overcoming availability bias. Recognizing and overcoming availability bias is crucial for making informed investment decisions. Here are some strategies that can help investors mitigate the influence of availability bias. 3.6.3.1 Diversify your information sources. To counter the effects of availability bias, it is essential to seek out a wide range of information sources. Relying solely on mainstream media or a single source of information can limit your perspective and increase the likelihood of bias. By diversifying your sources, you can gain a more comprehensive understanding of the investment landscape and make more informed decisions. 3.6.3.2 Conduct thorough research. Investors should conduct thorough research before making investment decisions. This includes analyzing financial statements, studying market trends, and considering the opinions of experts in the field. By taking a systematic approach to gathering information, investors can reduce the influence of availability bias and make more rational investment choices. 3.6.3.3 Consider the long-term perspective. Availability bias often leads investors to focus on short-term information or recent events. To counteract this bias, it is important to consider the long-term perspective. By analyzing historical data, understanding market cycles, and evaluating the fundamental factors that drive investment performance, investors can make more informed decisions that align with their long-term goals. 3.6.3.4 Seek professional advice. Working with a financial advisor or investment professional can help investors overcome availability bias. These professionals have experience and expertise in analyzing market trends, evaluating investment opportunities, and providing objective advice. By seeking professional guidance, investors can benefit from a more balanced and informed perspective, reducing the impact of availability bias on their investment choices. 3.6.4 Conclusion. Availability bias can significantly influence investment choices and lead to suboptimal decision-making. By understanding the impact of this cognitive bias and implementing strategies to mitigate its effects, investors can make more rational and informed investment decisions. Diversifying information sources, conducting thorough research, considering the long-term perspective, and seeking professional advice are all essential steps in overcoming availability bias and improving investment outcomes. 4. Overcoming biases and emotions in investing. 4.1 Recognizing and managing cognitive biases. Cognitive biases are inherent tendencies or patterns of thinking that can lead investors to make irrational decisions. These biases are a result of the way our brains process information and can significantly impact investment outcomes. Recognizing and managing these biases is crucial for investors to make informed and rational decisions. 4.1.1 Understanding cognitive biases. Cognitive biases are mental shortcuts that our brains use to simplify decision-making processes. While these shortcuts can be helpful in certain situations, they can also lead to errors in judgment and decision-making. Understanding the different types of cognitive biases can help investors recognize when they are influencing their investment decisions. One common cognitive bias is confirmation bias, which is the tendency to seek out information that confirms our existing beliefs and ignore information that contradicts them. This bias can lead investors to make decisions based on incomplete or biased information, rather than considering all available evidence. Another common bias is anchoring bias, which occurs when investors rely too heavily on the first piece of information they receive when making decisions. This bias can lead to overvaluing or undervaluing investments based on initial information, rather than considering all relevant factors. Loss aversion is another cognitive bias that can significantly impact investment decisions. This bias refers to the tendency to feel the pain of losses more strongly than the pleasure of gains. As a result, investors may be more inclined to hold on to losing investments in the hope of recovering their losses, rather than cutting their losses and moving on. 4.1.2 The impact of cognitive biases on investment decisions. Cognitive biases can have a profound impact on investment decisions. They can lead investors to make impulsive and irrational choices, which can result in poor investment performance. By understanding the impact of cognitive biases, investors can take steps to mitigate their effects and make more rational decisions. One way cognitive biases can impact investment decisions is by influencing risk perception. For example, the availability bias can lead investors to overestimate the likelihood of events that are easily recalled from memory, such as recent market crashes. This bias can cause investors to make overly conservative investment decisions based on the fear of potential losses. Cognitive biases can also affect investment decisions by influencing the evaluation of information. For instance, the framing bias can lead investors to make different decisions based on how information is presented to them. By presenting information in a positive or negative light, individuals may be swayed to make different investment choices, even if the underlying facts remain the same. 4.1.3 Strategies for managing cognitive biases. While cognitive biases are inherent in human thinking, there are strategies that investors can employ to recognize and manage these biases. By implementing these strategies, investors can make more rational and informed investment decisions. One effective strategy is to seek out diverse perspectives and opinions. By actively seeking out alternative viewpoints, investors can challenge their own biases and gain a more comprehensive understanding of the investment landscape. This can help mitigate the impact of confirmation bias and encourage more objective decision-making. Another strategy is to establish a systematic decision-making process. By creating a set of predefined criteria and guidelines, investors can reduce the influence of cognitive biases on their investment decisions. This can help ensure that decisions are based on objective factors rather than subjective biases. Additionally, it is important for investors to regularly review and reassess their investment decisions. By periodically evaluating the performance of their investments and the rationale behind their decisions, investors can identify and correct any biases that may have influenced their choices. 4.1.4 Seeking professional guidance. Recognizing and managing cognitive biases can be challenging, especially for individual investors. Seeking professional guidance from financial advisors or investment professionals can provide valuable insights and help mitigate the impact of cognitive biases. Financial advisors are trained to recognize and manage cognitive biases in investment decision-making. They can provide objective advice and help investors navigate through the complexities of the market. By working with a professional, investors can benefit from their expertise and reduce the influence of cognitive biases on their investment decisions. In conclusion, recognizing and managing cognitive biases is essential for investors to make rational and informed investment decisions. By understanding the different types of cognitive biases and their impact on decision-making, investors can implement strategies to mitigate their effects. Seeking professional guidance can also be beneficial in navigating the complexities of the market and reducing the influence of cognitive biases. Ultimately, by managing cognitive biases, investors can improve their investment outcomes and achieve long-term financial success. 4.2 Emotional intelligence and its importance in investing. Emotional intelligence plays a crucial role in the field of investing. It refers to the ability to recognize, understand, and manage our own emotions, as well as the emotions of others. In the context of investing, emotional intelligence is essential for making rational decisions, managing risk, and achieving long-term financial success. 4.2.1 Understanding emotional intelligence. Emotional intelligence encompasses several key components, including self-awareness, self-regulation, empathy, and social skills. Let's explore each of these components and their relevance to investing. 4.2.1.1 Self-awareness. Self-awareness is the foundation of emotional intelligence. It involves recognizing and understanding our own emotions, strengths, weaknesses, and biases. In the context of investing, self-awareness allows us to identify our emotional triggers and biases that may influence our investment decisions. By being aware of our emotions, we can better manage them and make more rational choices. 4.2.1.2 Self-regulation. Self-regulation refers to the ability to control and manage our emotions, impulses, and behaviors. In investing, self-regulation is crucial for avoiding impulsive decisions driven by fear or greed. It allows us to stay disciplined and stick to our investment strategy, even during periods of market volatility. By practicing self-regulation, we can avoid making irrational decisions that may lead to financial losses. 4.2.1.3 Empathy. Empathy is the ability to understand and share the feelings of others. In the context of investing, empathy allows us to consider the perspectives and emotions of other market participants. By understanding the motivations and behaviors of others, we can gain valuable insights into market trends and make more informed investment decisions. Empathy also helps us build strong relationships with other investors and financial professionals, fostering collaboration and learning. 4.2.1.4 Social skills. Social skills refer to the ability to effectively communicate, collaborate, and build relationships with others. In investing, social skills are essential for networking, seeking advice, and learning from experienced investors. By developing strong social skills, we can leverage the knowledge and expertise of others to enhance our investment strategies. Additionally, social skills enable us to navigate the complexities of the financial markets and negotiate favorable outcomes. 4.2.2 The importance of emotional intelligence in investing. Emotional intelligence is crucial for successful investing for several reasons. 4.2.2.1 Managing emotions. Investing can be an emotional roller coaster, with market fluctuations and unexpected events triggering fear, anxiety, and excitement. Emotional intelligence helps investors manage these emotions effectively. By recognizing and understanding their emotions, investors can make rational decisions based on sound analysis rather than being driven by impulsive reactions. Emotional intelligence allows investors to stay calm during market downturns and avoid making hasty decisions that may lead to significant losses. 4.2.2.2 Overcoming cognitive biases. Cognitive biases are inherent mental shortcuts that can lead to irrational investment decisions. Emotional intelligence helps investors recognize and overcome these biases. By being self-aware and regulating their emotions, investors can mitigate the impact of biases such as confirmation bias, anchoring bias, and overconfidence bias. Emotional intelligence enables investors to approach investment decisions with a rational mindset, considering all available information and avoiding common cognitive pitfalls. 4.2.2.3 Building resilience. Investing is not without its challenges and setbacks. Emotional intelligence helps investors develop resilience in the face of adversity. By managing their emotions and maintaining a positive mindset, investors can bounce back from losses and learn from their mistakes. Emotional intelligence allows investors to view setbacks as learning opportunities rather than failures, enabling them to adapt and improve their investment strategies over time. 4.2.2.4 Enhancing decision-making. Investment decisions require careful analysis and evaluation of various factors. Emotional intelligence enhances decision-making by enabling investors to consider both rational and emotional aspects. By understanding their own emotions and empathizing with others, investors can make more informed decisions that align with their long-term goals. Emotional intelligence also helps investors navigate complex market dynamics, interpret market trends, and identify investment opportunities. 4.2.2.5 Building strong relationships. Investing is not a solitary endeavor. Emotional intelligence plays a vital role in building strong relationships with other investors, financial advisors, and professionals in the industry. By demonstrating empathy, active listening, and effective communication, investors can establish trust and collaboration. These relationships provide valuable insights, support, and opportunities for learning and growth. 4.2.3 Developing emotional intelligence in investing. Developing emotional intelligence is an ongoing process that requires self-reflection, practice, and continuous learning. Here are some strategies to enhance emotional intelligence in the context of investing. 4.2.3.1 Self-reflection. Engage in regular self-reflection to understand your own emotions, biases, and triggers. Reflect on past investment decisions and their outcomes, identifying patterns and areas for improvement. By understanding your emotional tendencies, you can develop strategies to manage them effectively. 4.2.3.2 Education and awareness. Invest in financial education to enhance your knowledge of investing and behavioral finance. Stay updated on the latest research and insights into investor psychology. By increasing your awareness of cognitive biases and emotional factors, you can make more informed investment decisions. 4.2.3.3 Practice mindfulness. Incorporate mindfulness practices into your daily routine. Mindfulness helps you stay present, observe your emotions without judgment, and make conscious decisions. By practicing mindfulness, you can develop greater self-regulation and reduce impulsive reactions. 4.2.3.4 Seek feedback and support. Seek feedback from trusted mentors, financial advisors, or fellow investors. Their perspectives can provide valuable insights and help you identify blind spots or areas for improvement. Surround yourself with a supportive network that encourages personal and professional growth. 4.2.3.5 Learn from experience. Reflect on your investment successes and failures. Learn from your mistakes and identify strategies that have worked well for you. By continuously learning from experience, you can refine your investment approach and enhance your emotional intelligence. Conclusion. Emotional intelligence is a critical factor in successful investing. By developing self-awareness, self-regulation, empathy, and social skills, investors can make rational decisions, manage risk effectively, and build long-term wealth. Enhancing emotional intelligence requires self-reflection, education, practice, and learning from experience. By incorporating emotional intelligence into your investment approach, you can navigate the complexities of the financial markets with confidence and achieve your financial goals. 4.3 Developing a rational decision-making process. Developing a rational decision-making process is crucial for investors to navigate the complex and often unpredictable world of financial markets. By understanding and managing their emotions and biases, investors can make more informed and rational investment decisions. In this section, we will explore the key steps involved in developing a rational decision-making process. 4.3.1 Setting clear investment goals. The first step in developing a rational decision-making process is to set clear investment goals. Without a clear understanding of what you want to achieve, it becomes difficult to make rational decisions that align with your objectives. Take the time to define your short-term and long-term investment goals, whether it's saving for retirement, buying a house, or funding your children's education. By having specific and measurable goals, you can better evaluate investment opportunities and make decisions that are in line with your financial aspirations. 4.3.2 Conducting thorough research. Once you have established your investment goals, the next step is to conduct thorough research. This involves gathering relevant information about potential investment opportunities, such as stocks, bonds, mutual funds, or real estate. Take the time to analyze the historical performance, financial health, and future prospects of the investments you are considering. By conducting thorough research, you can make more informed decisions based on facts and data rather than emotions or hearsay. 4.3.3 Evaluating risk and return. Evaluating the risk and return of an investment is a critical aspect of developing a rational decision-making process. Every investment carries a certain level of risk, and it is important to assess whether the potential return justifies the risk involved. Consider factors such as the volatility of the investment, the market conditions, and your own risk tolerance. By carefully evaluating the risk and return, you can make decisions that align with your investment goals and risk appetite. 4.3.4 Creating a diversified portfolio. Diversification is a key strategy for managing risk and developing a rational decision-making process. By spreading your investments across different asset classes, sectors, and geographical regions, you can reduce the impact of any single investment on your overall portfolio. This helps to mitigate the risk of significant losses and increases the likelihood of achieving consistent returns over the long term. Consider diversifying your portfolio through a mix of stocks, bonds, real estate, and other investment vehicles that align with your risk tolerance and investment goals. 4.3.5 Developing an investment plan. An investment plan is a roadmap that outlines your investment strategy and guides your decision-making process. It should include details such as your asset allocation, investment timeline, and rebalancing strategy. By having a well-defined investment plan, you can avoid making impulsive decisions based on short-term market fluctuations or emotional reactions. Stick to your plan and make adjustments only when necessary based on changes in your financial situation or investment goals. 4.3.6 Seeking professional advice. Seeking professional advice can be beneficial in developing a rational decision-making process. Financial advisors can provide valuable insights and guidance based on their expertise and experience. They can help you assess your risk tolerance, evaluate investment opportunities, and create a personalized investment plan. However, it is important to choose a reputable and trustworthy advisor who has your best interests at heart. Do your due diligence and research potential advisors before making a decision. 4.3.7 Monitoring and reviewing. Developing a rational decision-making process is an ongoing endeavor. It requires regular monitoring and reviewing of your investments to ensure they are aligned with your goals and risk tolerance. Stay informed about market trends, economic indicators, and any changes that may impact your investments. Regularly review your portfolio performance and make adjustments as needed. By staying proactive and vigilant, you can make rational decisions based on the current market conditions and your evolving financial situation. 4.3.8 Practicing emotional discipline. Emotional discipline is a crucial aspect of developing a rational decision-making process. Emotions such as fear, greed, and impatience can cloud judgment and lead to irrational investment decisions. It is important to recognize and manage these emotions by staying focused on your investment plan and long-term goals. Avoid making impulsive decisions based on short-term market fluctuations or the opinions of others. Instead, rely on your research, analysis, and rational thinking to guide your investment decisions. 4.3.9 Learning from mistakes. Investing is a learning process, and it is inevitable that you will make mistakes along the way. The key is to learn from these mistakes and use them as opportunities for growth and improvement. Reflect on your past investment decisions and identify any patterns or biases that may have influenced your choices. By learning from your mistakes, you can develop a more rational decision-making process and make better informed investment decisions in the future. 4.3.10 Staying disciplined and patient. Developing a rational decision-making process requires discipline and patience. It is important to stay committed to your investment plan and resist the temptation to make impulsive decisions based on short-term market fluctuations. Remember that investing is a long-term endeavor, and it takes time for your investments to grow and generate returns. Stay focused on your goals, stick to your plan, and trust in the power of compounding over time. In conclusion, developing a rational decision-making process is essential for investors to navigate the complexities of financial markets. By setting clear goals, conducting thorough research, evaluating risk and return, creating a diversified portfolio, and seeking professional advice, investors can make more informed and rational investment decisions. Practicing emotional discipline, learning from mistakes, and staying disciplined and patient are also crucial aspects of developing a rational decision-making process. By following these steps, investors can increase their chances of achieving long-term investment success. 4.4 Strategies for controlling emotions and impulsive behavior. Controlling emotions and impulsive behavior is crucial for successful investing. Emotions such as fear, greed, and excitement can cloud judgment and lead to impulsive decisions that may result in financial losses. In this section, we will explore strategies that can help investors manage their emotions and make rational investment choices. 4.4.1 Developing self-awareness. The first step in controlling emotions and impulsive behavior is developing self-awareness. Investors need to recognize their emotional triggers and understand how these emotions can influence their decision-making process. By being aware of their emotions, investors can take steps to manage them effectively. One strategy for developing self-awareness is keeping a trading journal. This journal allows investors to record their thoughts and emotions before, during, and after making investment decisions. By reviewing these entries, investors can identify patterns and gain insights into their emotional responses. This self-reflection can help investors become more aware of their emotions and make more rational decisions in the future. 4.4.2 Setting clear investment goals. Setting clear investment goals is another effective strategy for controlling emotions and impulsive behavior. When investors have a clear understanding of their financial objectives, they are less likely to be swayed by short-term market fluctuations or impulsive investment opportunities. Investors should establish both short-term and long-term goals that align with their risk tolerance and investment time horizon. By focusing on these goals, investors can stay disciplined and avoid making emotional decisions based on market noise or external influences. 4.4.3 Implementing a diversification strategy. Diversification is a key strategy for managing emotions and impulsive behavior. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce the impact of individual investment performance on their overall portfolio. A well-diversified portfolio can help mitigate the emotional roller coaster that comes with investing in individual stocks or sectors. When one investment underperforms, the impact on the overall portfolio is minimized. This can help investors stay calm and avoid making impulsive decisions based on short-term market movements. 4.4.4 Following a systematic investment approach. Following a systematic investment approach is another effective strategy for controlling emotions and impulsive behavior. Systematic investing involves setting predetermined rules for buying and selling investments based on a set of criteria, such as asset allocation or market indicators. By removing emotions from the investment decision-making process, systematic investing helps investors avoid impulsive decisions driven by fear or greed. Instead, investors can rely on a disciplined approach that is based on a well-defined investment strategy. 4.4.5 Practicing patience and discipline. Practicing patience and discipline is crucial for controlling emotions and impulsive behavior in investing. Markets can be volatile, and short-term fluctuations are a normal part of the investment journey. Investors who can remain patient and disciplined during these periods are more likely to achieve long-term investment success. One way to practice patience and discipline is to avoid constantly monitoring investment portfolios. Checking portfolio performance too frequently can lead to emotional reactions to short-term market movements. Instead, investors should focus on their long-term goals and trust in their investment strategy. 4.4.6 Seeking professional advice. Seeking professional advice can be beneficial for investors who struggle with controlling their emotions and impulsive behavior. Financial advisors can provide objective guidance and help investors stay focused on their long-term goals. A financial advisor can help investors develop a personalized investment plan based on their risk tolerance, financial goals, and time horizon. They can also provide reassurance during market downturns and help investors avoid making impulsive decisions based on short-term market movements. 4.4.7 Practicing emotional regulation techniques. Emotional regulation techniques can be helpful for investors who want to control their emotions and impulsive behavior. These techniques involve managing and redirecting emotions to make more rational decisions. Some common emotional regulation techniques include deep breathing exercises, meditation, and mindfulness practices. These techniques can help investors calm their minds and reduce the impact of emotions on their decision-making process. By incorporating these practices into their daily routine, investors can develop a more balanced and rational approach to investing. 4.4.8 Learning from past mistakes. Learning from past mistakes is an essential strategy for controlling emotions and impulsive behavior. Every investor is bound to make mistakes at some point, but it is important to reflect on these mistakes and learn from them. By analyzing past investment decisions and their outcomes, investors can identify patterns of behavior that led to impulsive or emotional decisions. This self-reflection can help investors develop strategies to avoid repeating these mistakes in the future. 4.4.9 Building a supportive network. Building a supportive network of like-minded investors can provide valuable emotional support and help control impulsive behavior. Surrounding oneself with individuals who share similar investment philosophies and goals can provide a sense of community and reassurance during challenging times. Investors can join investment clubs, attend seminars or workshops, or participate in online forums to connect with other investors. Sharing experiences, discussing investment strategies, and seeking advice from others can help investors stay focused and disciplined in their investment journey. 4.4.10 Taking breaks from the market. Taking breaks from the market can be a helpful strategy for controlling emotions and impulsive behavior. Sometimes, stepping away from the constant stream of market news and updates can provide a fresh perspective and reduce emotional reactions to short-term market movements. Investors can set specific periods of time, such as a week or a month, where they intentionally avoid checking their investment portfolios or engaging with market-related news. This break can help investors gain clarity and maintain a long-term perspective on their investment goals. In conclusion, controlling emotions and impulsive behavior is essential for successful investing. By developing self-awareness, setting clear investment goals, implementing a diversification strategy, following a systematic investment approach, practicing patience and discipline, seeking professional advice, practicing emotional regulation techniques, learning from past mistakes, building a supportive network, and taking breaks from the market, investors can improve their decision-making process and achieve long-term investment success. 5. The role of personality in investment success. 5.1 Different personality types and their investment styles. Investing is not only influenced by external factors such as market conditions and economic trends but also by the unique characteristics and traits of individual investors. Each person has their own personality, which plays a significant role in shaping their investment style and decision-making process. Understanding the different personality types and their corresponding investment styles can provide valuable insights into how individuals approach investing and manage their portfolios. 5.1.1 The conservative investor. The conservative investor is characterized by a cautious and risk-averse approach to investing. These individuals prioritize the preservation of capital and are more inclined towards low-risk investments such as bonds, fixed deposits, and blue-chip stocks. They tend to have a long-term investment horizon and are less likely to make impulsive decisions based on short-term market fluctuations. The conservative investor values stability and security, and their investment strategy focuses on capital preservation rather than aggressive growth. 5.1.2 The aggressive investor. In contrast to the conservative investor, the aggressive investor is willing to take on higher levels of risk in pursuit of higher returns. These individuals have a higher tolerance for volatility and are more likely to invest in growth-oriented assets such as stocks, mutual funds, and alternative investments. The aggressive investor seeks opportunities for capital appreciation and is comfortable with short-term market fluctuations. They are often proactive in their investment decisions and may actively trade or rebalance their portfolios to capitalize on market trends. 5.1.3 The balanced investor. The balanced investor seeks a middle ground between the conservative and aggressive approaches. These individuals aim to achieve a balance between risk and reward by diversifying their portfolios across different asset classes. The balanced investor typically holds a mix of low-risk and high-risk investments, such as a combination of stocks, bonds, and real estate. They prioritize both capital preservation and growth, seeking to generate consistent returns while managing risk effectively. The balanced investor takes a long-term perspective and adjusts their portfolio allocation based on their risk tolerance and market conditions. 5.1.4 The value investor. The value investor focuses on identifying undervalued assets and investing in them with the expectation of long-term appreciation. These individuals analyze fundamental factors such as earnings, cash flow, and book value to determine the intrinsic value of a security. The value investor looks for opportunities where the market price of an asset is lower than its intrinsic value, indicating potential for future growth. They tend to have a patient and disciplined approach to investing, often holding onto investments for an extended period to realize their full value. 5.1.5 The growth investor. The growth investor prioritizes investing in companies or sectors with high growth potential. These individuals seek out companies that are expected to experience rapid earnings growth and capitalize on market trends. The growth investor is willing to take on higher levels of risk and may invest in emerging industries or technology-driven companies. They often have a long-term investment horizon and are willing to tolerate short-term volatility in pursuit of substantial capital appreciation. 5.1.6 The passive investor. The passive investor takes a hands-off approach to investing and relies on index funds or exchange-traded funds, ETFs, to gain exposure to broad market indices. These individuals believe in the efficient market hypothesis, which suggests that it is difficult to consistently outperform the market. The passive investor aims to match the performance of the overall market rather than trying to beat it. They prioritize low-cost investing and long-term wealth accumulation through diversified portfolios. 5.1.7 The active investor. In contrast to the passive investor, the active investor takes a more hands-on approach to investing. These individuals actively research and analyze investment opportunities, seeking to outperform the market through active trading and portfolio management. The active investor may engage in frequent buying and selling of securities, attempting to capitalize on short-term market inefficiencies. They often have a higher level of involvement in their investment decisions and may rely on technical analysis, market trends, and financial news to inform their trading strategies. Understanding the different personality types and their corresponding investment styles can help investors align their investment approach with their individual characteristics and goals. It is important to note that these investment styles are not mutually exclusive, and individuals may exhibit a combination of traits from different styles. By recognizing their own personality type and investment preferences, investors can make more informed decisions and develop a personalized investment strategy that suits their unique needs and risk tolerance. 5.2 The impact of self-confidence and self-efficacy on investment performance. Self-confidence and self-efficacy play a crucial role in the world of investing. These psychological factors can significantly influence an investor's decision-making process, risk tolerance, and overall investment performance. In this section, we will explore the importance of self-confidence and self-efficacy in investing and how they can impact an investor's success. The power of self-confidence. Self-confidence refers to an individual's belief in their own abilities, skills, and knowledge. In the context of investing, self-confidence plays a vital role in shaping an investor's behavior and decision-making process. When investors have a high level of self-confidence, they are more likely to take calculated risks, make informed investment decisions, and stick to their investment strategies even during challenging times. One of the key benefits of self-confidence in investing is the ability to stay calm and composed during market fluctuations. Confident investors are less likely to panic and make impulsive decisions based on short-term market movements. Instead, they have the conviction to stay focused on their long-term investment goals and ride out market volatility. Moreover, self-confidence enables investors to trust their own judgment and resist the influence of external factors such as media hype or market noise. They are more likely to rely on their own research and analysis, leading to more independent and informed investment decisions. The role of self-efficacy. Self-efficacy refers to an individual's belief in their ability to successfully execute specific tasks or achieve desired outcomes. In the context of investing, self-efficacy plays a crucial role in an investor's ability to execute their investment strategies effectively and achieve their financial goals. Investors with high self-efficacy are more likely to take proactive steps to educate themselves about the financial markets, seek out expert advice when needed, and continuously improve their investment skills. They have a strong belief in their ability to navigate the complexities of the market and make sound investment decisions. Self-efficacy also influences an investor's ability to handle setbacks and failures. Investors with high self-efficacy are more resilient and are better equipped to bounce back from losses or mistakes. They view setbacks as learning opportunities and are more likely to adapt their strategies and make necessary adjustments to improve their future performance. The relationship between self-confidence, self-efficacy, and investment performance. The relationship between self-confidence, self-efficacy, and investment performance is complex and multifaceted. While high levels of self-confidence and self-efficacy can be beneficial, excessive levels can lead to overconfidence and irrational decision-making. Overconfidence can lead investors to underestimate risks, overestimate their abilities, and engage in speculative or reckless investment behaviors. It can also lead to a failure to diversify their portfolios adequately, resulting in increased vulnerability to market downturns. On the other hand, low levels of self-confidence and self-efficacy can hinder an investor's ability to make informed decisions and take calculated risks. Investors with low self-confidence may be more prone to fear and anxiety, leading to a reluctance to enter the market or make necessary adjustments to their investment strategies. Finding the right balance between self-confidence and self-efficacy is crucial for investment success. It requires self-awareness, continuous learning, and a willingness to adapt to changing market conditions. Investors should strive to develop a realistic assessment of their abilities and limitations, while also recognizing the importance of seeking expert advice and staying informed about market trends. Building self-confidence and self-efficacy in investing. Building self-confidence and self-efficacy in investing is a gradual process that requires effort and dedication. Here are some strategies that can help investors enhance their self-confidence and self-efficacy. Education and knowledge. Continuously educate yourself about the financial markets, investment strategies, and economic trends. The more knowledge you acquire, the more confident and competent you will feel in making investment decisions. Goal setting. Set clear and achievable investment goals. Break them down into smaller milestones and celebrate your achievements along the way. Accomplishing your goals will boost your self-confidence and reinforce your belief in your abilities. Track record. Keep a record of your investment decisions and their outcomes. Reviewing your successes and failures can help you identify patterns, learn from your mistakes, and improve your decision-making process. Seek expert advice. Consult with financial advisors or experts in the field to gain insights and perspectives. Their guidance can help you make more informed decisions and enhance your self-efficacy. Start small. Begin with smaller investments and gradually increase your exposure as you gain confidence and experience. This approach allows you to learn from your mistakes without risking significant capital. Embrace failure. Accept that losses and setbacks are part of the investment journey. Instead of dwelling on failures, focus on learning from them and using them as stepping stones for future success. Surround yourself with supportive networks. Engage with like-minded investors or join investment clubs where you can share experiences, learn from others, and gain support. Being part of a supportive community can boost your self-confidence and provide valuable insights. Remember, building self-confidence and self-efficacy in investing is an ongoing process. It requires continuous learning, self-reflection, and a willingness to adapt to changing market conditions. By developing these psychological attributes, investors can improve their decision-making process, manage risks effectively, and increase their chances of long-term investment success. 5.3 The importance of discipline and patience in investing. Investing in the financial markets can be an exciting and potentially lucrative endeavor. However, it is important for investors to understand that successful investing requires discipline and patience. These two qualities are often overlooked but are crucial for long-term investment success. 5.3.1 The role of discipline in investing. Discipline is the ability to stick to a predetermined investment strategy and follow it consistently, regardless of market conditions or short-term fluctuations. It involves making rational decisions based on research and analysis rather than succumbing to emotional impulses or following the crowd. One of the key aspects of discipline in investing is having a well-defined investment plan. This plan should outline your investment goals, risk tolerance, and the strategies you will use to achieve those goals. By having a clear plan in place, you can avoid making impulsive decisions based on short-term market movements. Discipline also involves staying focused on your long-term investment objectives. It is easy to get swayed by short-term market trends or the fear of missing out on potential gains. However, successful investors understand that investing is a marathon, not a sprint. They have the discipline to stay committed to their investment plan even during periods of market volatility. Another important aspect of discipline is the ability to control your emotions. Emotions such as fear and greed can cloud your judgment and lead to irrational investment decisions. Disciplined investors understand the importance of keeping emotions in check and making decisions based on logic and analysis rather than gut feelings. 5.3.2 The benefits of patience in investing. Patience is another crucial quality for successful investing. It is the ability to wait for the right opportunities and not rush into making impulsive investment decisions. Patience allows investors to take a long-term view and avoid getting caught up in short-term market fluctuations. One of the key benefits of patience is the ability to ride out market downturns. Financial markets are inherently volatile, and it is not uncommon for investments to experience temporary declines. However, patient investors understand that market downturns are often followed by periods of recovery and growth. By staying patient and not panicking during market downturns, investors can avoid making hasty decisions that could negatively impact their long-term returns. Patience also allows investors to take advantage of compounding returns. Compounding is the process by which the returns on an investment generate additional earnings over time. However, compounding requires time to work its magic. Patient investors understand that the longer they stay invested, the greater the potential for compounding to significantly grow their wealth. Furthermore, patience enables investors to conduct thorough research and analysis before making investment decisions. Rushing into investments without proper due diligence can lead to poor outcomes. Patient investors take the time to research and understand the fundamentals of the investments they are considering, allowing them to make more informed decisions. 5.3.3 Developing discipline and patience. Developing discipline and patience in investing is not always easy, but it is certainly achievable with practice and self-awareness. Here are some strategies to help you cultivate these qualities. 5.3.3.1 Set clear investment goals. Having clear investment goals is essential for developing discipline and patience. Define your long-term objectives and break them down into smaller, achievable milestones. This will help you stay focused and committed to your investment plan. 5.3.3.2 Stick to your investment plan. Once you have a well-defined investment plan in place, stick to it. Avoid making impulsive decisions based on short-term market movements or the latest investment fads. Trust in your plan and have the discipline to follow it consistently. 5.3.3.3 Control your emotions. Emotional discipline is crucial in investing. Learn to recognize and control your emotions, especially during periods of market volatility. Avoid making decisions based on fear or greed and instead rely on rational analysis and research. 5.3.3.4 Practice patience. Patience is a skill that can be developed over time. Practice patience by avoiding the temptation to constantly monitor your investments or make frequent changes to your portfolio. Instead, take a long-term view and trust in the power of compounding. 5.3.3.5 Learn from mistakes. Investing is a learning process, and everyone makes mistakes. Instead of dwelling on past mistakes, use them as learning opportunities. Analyze what went wrong and how you can improve your decision-making process in the future. This will help you become a more disciplined and patient investor. Conclusion. Discipline and patience are essential qualities for successful investing. They allow investors to stay focused on their long-term goals, make rational decisions, and avoid succumbing to emotional impulses. By developing discipline and patience, investors can increase their chances of achieving long-term investment success and building wealth over time. 5.4 Building a personalized investment strategy based on personality traits. When it comes to investing, there is no one-size-fits-all approach. Each individual has their own unique personality traits that influence their decision-making process and risk tolerance. Understanding your own personality and how it relates to investing can help you build a personalized investment strategy that aligns with your goals and preferences. 5.4.1 Identifying your personality traits. Before you can build a personalized investment strategy, it is important to identify your personality traits and how they may impact your investment decisions. There are several well-known personality frameworks that can help you gain insight into your own tendencies and preferences. One popular framework is the Myers-Briggs Type Indicator (MBTI), which categorizes individuals into 16 different personality types based on their preferences for extraversion or introversion, sensing or intuition, thinking or feeling, and judging or perceiving. Another widely used framework is the Big Five personality traits, which assesses individuals on 5 dimensions: openness to experience, conscientiousness, extraversion, agreeableness, and neuroticism. By understanding your own personality traits, you can gain insight into how you may approach investing. For example, if you are more risk-averse and prefer stability, you may be more inclined to invest in low-risk assets such as bonds or dividend-paying stocks. On the other hand, if you are more adventurous and open to taking risks, you may be more comfortable investing in high-growth stocks or alternative investments. 5.4.2 Matching your personality traits with investment styles. Once you have identified your personality traits, the next step is to match them with investment styles that align with your preferences. Different investment styles have different risk profiles and strategies, and finding the right fit for your personality can help you stay committed to your investment strategy over the long term. For example, if you are a conservative investor who values stability and prefers a more hands-off approach, a passive investment strategy such as index fund investing may be a good fit. Index funds aim to replicate the performance of a specific market index, providing broad market exposure with low fees. On the other hand, if you are a more active and risk-tolerant investor who enjoys researching and analyzing individual stocks, a more hands-on approach such as value investing or growth investing may be more suitable. Value investing focuses on finding undervalued stocks with the potential for long-term growth, while growth investing focuses on investing in companies with high growth potential. It is important to note that there is no right or wrong investment style. The key is to find a style that aligns with your personality, risk tolerance, and investment goals. By matching your personality traits with the appropriate investment style, you can increase your chances of sticking to your investment strategy and achieving your financial objectives. 5.4.3 Incorporating risk management techniques. Regardless of your personality traits and investment style, it is crucial to incorporate risk management techniques into your investment strategy. Risk management helps protect your portfolio from potential losses and ensures that you are not taking on more risk than you can handle. One effective risk management technique is diversification. Diversifying your portfolio involves spreading your investments across different asset classes, sectors, and geographic regions. By diversifying, you can reduce the impact of any single investment on your overall portfolio performance. This can help mitigate risk and potentially increase returns over the long term. Another risk management technique is setting clear investment goals and establishing a disciplined approach to investing. By setting specific goals, you can focus on the long term and avoid making impulsive investment decisions based on short-term market fluctuations. Additionally, establishing a disciplined approach, such as regular portfolio rebalancing or dollar-cost averaging, can help you stay on track and avoid emotional decision-making. 5.4.4 Seeking professional advice. Building a personalized investment strategy based on your personality traits can be a complex process. If you are unsure about how to align your personality traits with investment styles or need guidance on risk management techniques, it may be beneficial to seek professional advice. A financial advisor or investment professional can help you assess your personality traits, understand your investment goals, and develop a personalized investment strategy that suits your needs. They can provide valuable insights and expertise to help you navigate the complexities of the financial markets and make informed investment decisions. When choosing a financial advisor, it is important to consider their qualifications, experience, and track record. Look for professionals who have a deep understanding of investor psychology and can tailor their advice to your unique personality traits and investment goals. Conclusion. Building a personalized investment strategy based on your personality traits is a powerful way to align your investments with your preferences and increase your chances of long-term success. By identifying your personality traits, matching them with appropriate investment styles, incorporating risk management techniques, and seeking professional advice when needed, you can create a strategy that reflects your individuality and helps you achieve your financial goals. Remember, investing is a journey, and understanding yourself is a crucial step towards building a successful investment strategy. 6. The psychology of market bubbles and crashes. 6.1 Understanding market bubbles and their causes. Market bubbles are a fascinating phenomenon that has captured the attention of investors and economists alike. These bubbles occur when the prices of certain assets, such as stocks, real estate, or cryptocurrencies, rise to unsustainable levels driven by speculation and irrational exuberance. Eventually, these bubbles burst, leading to a sharp decline in prices and significant financial losses for those caught in the frenzy. 6.1.1 The nature of market bubbles. Market bubbles are characterized by a rapid and excessive increase in the prices of assets, often fueled by investor optimism and the fear of missing out on potential gains. During a bubble, investors become increasingly convinced that the price of the asset will continue to rise indefinitely, leading to a self-reinforcing cycle of buying and further price increases. One of the key features of market bubbles is the detachment of asset prices from their underlying fundamental value. Investors become less concerned with the intrinsic worth of the asset and more focused on the potential for quick profits. This detachment from reality creates a speculative environment where prices are driven by investor sentiment rather than rational analysis. 6.1.2 Causes of market bubbles. Understanding the causes of market bubbles is crucial for investors to navigate these volatile periods successfully. While each bubble is unique, there are several common factors that contribute to their formation. 6.1.2.1 Herd mentality. Herd mentality plays a significant role in the formation of market bubbles. When investors observe others making substantial profits from a particular asset, they often feel compelled to join the crowd and invest as well. This fear of missing out can lead to a rapid influx of capital into the asset, driving up prices even further. As more investors join the frenzy, the bubble continues to inflate until it becomes unsustainable. 6.1.2.2 Easy credit and speculative borrowing. Easy access to credit and speculative borrowing can fuel market bubbles. When interest rates are low, investors are more likely to borrow money to invest in assets, hoping to take advantage of the rising prices. This increased demand for assets further drives up prices, creating a feedback loop of borrowing and speculation. However, when the bubble bursts, investors who borrowed heavily to invest often face significant financial losses and may struggle to repay their debts. 6.1.2.3 Overvaluation and irrational exuberance. Market bubbles often occur when investors become overly optimistic about the future prospects of an asset. This optimism can lead to a disconnect between the asset's price and its underlying value. Investors may ignore warning signs and rationalize the inflated prices based on unrealistic expectations of future growth. This irrational exuberance can sustain the bubble for a period but eventually gives way to a correction as reality sets in. 6.1.2.4 Lack of regulation and oversight. In some cases, a lack of regulation and oversight can contribute to the formation of market bubbles. When there are minimal restrictions on financial markets, investors may engage in risky and speculative behavior without adequate safeguards. This lack of oversight can exacerbate the impact of herd mentality and speculative borrowing, making the bubble more pronounced and its burst more severe. 6.1.3 Examples of market bubbles. Throughout history, there have been numerous examples of market bubbles that have had a significant impact on the global economy. Some notable examples include 6.1.3.1 Dot-com bubble, 1997-2000. The dot-com bubble, also known as the Internet bubble, occurred in the late 1990s when investors became overly optimistic about the potential of Internet-based companies. Stock prices of Internet-related companies soared to astronomical levels, despite many of these companies having little or no profits. When the bubble burst in 2000, billions of dollars were lost, and many Internet companies went bankrupt. 6.1.3.2 Housing bubble, 2002-2008. The housing bubble, which led to the global financial crisis in 2008, was fueled by a combination of easy credit, speculative borrowing, and overvaluation of real estate. Housing prices skyrocketed, driven by subprime mortgage lending and the securitization of these risky loans. When the bubble burst, it triggered a wave of foreclosures, bank failures, and a severe economic downturn. 6.1.3.3 Cryptocurrency bubble, 2017-2018. The cryptocurrency bubble of 2017-2018 saw a surge in the prices of various cryptocurrencies, most notably Bitcoin. Investors were drawn to the potential for massive returns, driven by media hype and the fear of missing out. However, the bubble burst in early 2018, leading to a significant decline in cryptocurrency prices and substantial losses for many investors. 6.1.4 The impact of market bubbles. Market bubbles can have far-reaching consequences for both individual investors and the broader economy. When a bubble bursts, investors who bought into the inflated prices often experience substantial financial losses. This can lead to a loss of confidence in the financial markets and a decrease in consumer spending, which can have a negative impact on economic growth. Additionally, market bubbles can create systemic risks within the financial system. When the bubble bursts, it can trigger a chain reaction of defaults, bankruptcies, and a tightening of credit conditions. This can lead to a credit crunch, as banks become more cautious about lending, further exacerbating the economic downturn. Conclusion. Understanding market bubbles and their causes is essential for investors to navigate the volatile nature of financial markets successfully. By recognizing the signs of a bubble and avoiding speculative behavior driven by irrational exuberance, investors can protect themselves from significant financial losses. Additionally, regulators and policymakers play a crucial role in implementing measures to prevent the formation of bubbles and mitigate their impact on the economy. 6.2 The role of investor sentiment in market crashes. Investor sentiment plays a crucial role in the occurrence and severity of market crashes. It refers to the overall attitude and emotions of investors towards the market and its future prospects. Investor sentiment can be influenced by a variety of factors, including economic conditions, news events, and market trends. When investor sentiment becomes excessively positive or negative, it can lead to irrational decision-making and contribute to the formation of market bubbles and subsequent crashes. 6.2.1 The impact of positive sentiment. Positive investor sentiment is characterized by optimism, confidence, and a belief that the market will continue to rise. During periods of positive sentiment, investors tend to exhibit a herd mentality, where they follow the crowd and invest in popular assets or sectors without conducting thorough analysis. This behavior can lead to the formation of market bubbles, where asset prices become detached from their underlying fundamentals. In a bubble, investors become overly optimistic and believe that prices will continue to rise indefinitely. This optimism fuels demand, driving prices even higher. However, as the bubble expands, it becomes increasingly vulnerable to a sudden reversal. When investor sentiment shifts from positive to negative, it can trigger a market crash as investors rush to sell their overvalued assets, causing prices to plummet. 6.2.2 The influence of negative sentiment. Negative investor sentiment, on the other hand, is characterized by fear, pessimism, and a belief that the market will decline. During periods of negative sentiment, investors tend to become risk-averse and may sell their investments in anticipation of further losses. This behavior can exacerbate market downturns and lead to panic selling, which can trigger a cascade of selling pressure and result in a market crash. Negative sentiment can be fueled by various factors, such as economic recessions, geopolitical tensions, or unexpected events that shake investor confidence. When investors perceive a high level of risk in the market, they may rush to exit their positions, causing prices to plummet rapidly. This behavior is often driven by fear and a desire to protect capital, but it can contribute to a self-fulfilling prophecy, where the market crash becomes a reality due to widespread selling. 6.2.3 The role of behavioral biases. Investor sentiment is closely linked to behavioral biases, which are systematic errors in decision-making that arise from cognitive and emotional factors. These biases can significantly impact investor sentiment and contribute to market crashes. One such bias is herd mentality, where investors tend to follow the actions of the majority without critically evaluating the information or market conditions. This behavior can lead to the formation of market bubbles and subsequent crashes when sentiment shifts. Another bias is overreaction, where investors tend to overestimate the impact of new information on asset prices. This can lead to exaggerated market movements and contribute to the volatility that precedes a crash. Additionally, loss aversion bias can cause investors to panic and sell their investments at the first sign of losses, further exacerbating market downturns. 6.2.4 The role of media and information. Media and information dissemination play a significant role in shaping investor sentiment. News outlets, social media platforms, and financial analysts can influence how investors perceive market conditions and make investment decisions. Positive or negative news can create a feedback loop, reinforcing existing sentiment and potentially amplifying market movements. During periods of market exuberance, the media often highlights success stories and positive economic indicators, fueling optimism among investors. Conversely, during market downturns, negative news and pessimistic forecasts can intensify fear and contribute to a downward spiral in sentiment. It is important for investors to be aware of the potential biases in media reporting and to critically evaluate the information they receive. Relying solely on media sources for investment decisions can lead to herd behavior and irrational decision-making, which can contribute to market crashes. 6.2.5 The role of government and central banks. Government policies and actions by central banks can also influence investor sentiment and contribute to market crashes. Monetary policy decisions, such as interest rate changes or quantitative easing measures, can have a significant impact on market conditions and investor behavior. For example, during periods of economic downturn, central banks may implement expansionary monetary policies to stimulate the economy. While these measures can provide short-term relief, they can also create a sense of artificial optimism and encourage excessive risk-taking. When these policies are eventually reversed or their effectiveness diminishes, it can lead to a sudden shift in sentiment and trigger a market crash. Government regulations and interventions can also impact investor sentiment. Sudden changes in regulations or unexpected government actions can create uncertainty and fear among investors, leading to a decline in sentiment and potentially triggering a market crash. 6.2.6 Managing investor sentiment. Managing investor sentiment is a challenging task, as it is influenced by a complex interplay of psychological, economic, and social factors. However, there are strategies that investors can employ to mitigate the impact of sentiment on their investment decisions. One approach is to maintain a long-term perspective and focus on the underlying fundamentals of the assets in their portfolio. By conducting thorough research and analysis, investors can make informed decisions based on objective criteria rather than being swayed by short-term sentiment fluctuations. Diversification is another key strategy for managing investor sentiment. By spreading investments across different asset classes and sectors, investors can reduce their exposure to the volatility of any single investment. This can help mitigate the impact of market crashes and provide a more stable long-term investment strategy. Additionally, investors can benefit from developing emotional intelligence and self-awareness. By understanding their own biases and emotions, investors can make more rational and disciplined decisions. This includes recognizing the influence of sentiment on their decision-making process and taking steps to counteract its potential negative effects. In conclusion, investor sentiment plays a significant role in market crashes. Positive sentiment can lead to the formation of market bubbles, while negative sentiment can trigger panic selling and exacerbate market downturns. Behavioral biases, media influence, and government actions can all contribute to shifts in investor sentiment. By understanding these dynamics and employing strategies to manage sentiment, investors can make more informed and rational investment decisions. 6.3 The psychology of panic selling and herding behavior during crises. During times of financial crises or market downturns, investors often experience heightened emotions and irrational behavior. One of the most prevalent psychological phenomena observed during these periods is panic selling and herding behavior. These behaviors can have a significant impact on market volatility and can lead to further market declines. 6.3.1 Understanding panic selling. Panic selling refers to the rapid and widespread selling of investments due to fear and uncertainty. It is driven by a strong desire to avoid further losses and protect one's capital. When investors panic, they tend to make impulsive decisions without considering the long-term consequences. This behavior is often fueled by negative news, market rumors, and a general sense of fear and anxiety. The role of fear and loss aversion. Fear plays a crucial role in panic selling. Investors are afraid of losing their hard-earned money and witnessing the value of their investments plummet. This fear triggers a strong emotional response, leading to impulsive selling decisions. Additionally, loss aversion, a cognitive bias where individuals feel the pain of losses more strongly than the pleasure of gains, intensifies the fear of losing money. Investors become more focused on avoiding losses rather than making rational investment decisions. Overreaction to market news. During times of crisis, the media often amplifies negative news and highlights the potential risks and uncertainties. This constant bombardment of negative information can lead investors to overreact and make hasty decisions. They may believe that the situation is worse than it actually is, leading to panic selling. The fear of missing out on potential gains also plays a role, as investors worry that they will miss the opportunity to sell before the market declines further. 6.3.2 Herding behavior. Herding behavior refers to the tendency of individuals to follow the actions and decisions of the majority. During crises, investors often look to others for guidance and reassurance. They assume that if everyone else is selling, it must be the right thing to do. This behavior is driven by the fear of being left behind or making a wrong decision. The influence of social proof. Social proof, a psychological phenomenon where individuals assume the actions of others in an attempt to reflect correct behavior, plays a significant role in herding behavior. Investors believe that if others are selling, they must have access to information or insights that they do not. This leads to a follow the crowd mentality, where individuals abandon their own analysis and blindly follow the actions of others. Amplification of market volatility. Herding behavior can amplify market volatility during crises. As more investors sell, the market experiences a downward spiral, leading to further panic and more selling. This creates a self-reinforcing cycle where fear and uncertainty drive the market lower. The collective actions of investors can have a significant impact on market prices, often leading to exaggerated market movements. 6.3.3 The consequences of panic selling and herding behavior. Panic selling and herding behavior can have severe consequences for individual investors and the overall market. Missed opportunities. When investors panic sell, they often miss out on potential market recoveries. Market downturns are often followed by periods of growth and recovery. By selling at the bottom, investors lock in their losses and miss the opportunity to benefit from the subsequent market upswing. This can have a detrimental impact on long-term investment returns. Increased market volatility. Panic selling and herding behavior contribute to increased market volatility. When a large number of investors sell simultaneously, it creates a domino effect, leading to sharp declines in market prices. This volatility can make it challenging for investors to make rational decisions and can create an environment of uncertainty and fear. Market manipulation. Herding behavior can also create opportunities for market manipulation. Unscrupulous individuals or institutions may take advantage of the panic and artificially manipulate market prices for their own gain. This can further exacerbate the market downturn and lead to significant losses for individual investors. 6.3.4 Strategies to overcome panic selling and herding behavior. To mitigate the negative impact of panic selling and herding behavior, investors can employ several strategies. Maintain a long-term perspective. Investors should focus on their long-term investment goals and maintain a disciplined approach. By understanding that market downturns are a normal part of the investment cycle, investors can avoid making impulsive decisions based on short-term market fluctuations. Diversify your portfolio. Diversification is a key strategy to reduce the impact of market volatility. By spreading investments across different asset classes and sectors, investors can minimize the risk associated with individual investments. This can help protect against the negative effects of panic selling and herding behavior. Stay informed but avoid overreacting. While it is essential to stay informed about market developments, investors should avoid overreacting to every piece of news. It is crucial to evaluate information critically and consider the long-term implications before making any investment decisions. Relying on a well-thought-out investment strategy can help investors avoid knee-jerk reactions. Seek professional advice. During times of crisis, seeking professional advice can provide valuable guidance and help investors navigate through turbulent markets. Financial advisors can provide objective insights and help investors make rational decisions based on their individual circumstances and long-term goals. Conclusion. Understanding the psychology behind panic selling and herding behavior is crucial for investors to make informed decisions during times of crisis. By recognizing the role of fear, loss aversion, and social proof, investors can develop strategies to overcome these biases and avoid making impulsive decisions. Maintaining a long-term perspective, diversifying portfolios, staying informed without overreacting, and seeking professional advice are essential steps to mitigate the negative impact of panic selling and herding behavior. 6.4 Learning from historical market crashes and applying lessons to future investments. Market crashes are a recurring phenomenon in the world of investing. Throughout history, there have been numerous instances where financial markets experienced significant downturns, resulting in substantial losses for investors. These market crashes serve as valuable lessons for understanding investor psychology and can provide insights into how to navigate future investments. 6.4.1 Understanding the causes of market crashes. Before delving into the lessons we can learn from historical market crashes, it is crucial to understand the underlying causes of these events. Market crashes are often triggered by a combination of economic, political, and psychological factors. Economic factors such as recessions, financial imbalances, or excessive speculation can create a fragile market environment. Political events, such as policy changes or geopolitical tensions, can also contribute to market instability. However, it is the psychological factors that play a significant role in exacerbating market crashes. 6.4.2 The role of investor sentiment in market crashes. Investor sentiment, or the overall attitude and emotions of investors towards the market, can have a profound impact on market crashes. During periods of optimism, investors tend to exhibit irrational exuberance, driving asset prices to unsustainable levels. This euphoria can create a speculative bubble, where investors ignore fundamental valuations and instead rely on the belief that prices will continue to rise indefinitely. However, when sentiment shifts, fear and panic can quickly take hold, leading to a rapid and severe market downturn. 6.4.3 The psychology of panic selling and herding behavior during crises. One of the most significant psychological phenomena observed during market crashes is panic selling and herding behavior. When investors witness a sharp decline in asset prices, fear and uncertainty can overwhelm rational decision-making. As a result, many investors succumb to the temptation to sell their investments in a panic, fearing further losses. This mass selling can exacerbate market downturns and create a self-fulfilling prophecy. Additionally, herding behavior, where investors follow the actions of others rather than making independent decisions, can intensify market crashes. When investors see others selling, they may feel compelled to do the same, assuming that others possess superior information. This herd mentality can amplify market volatility and lead to a cascading effect of selling. 6.4.4 Lessons from historical market crashes. While market crashes can be devastating for investors, they also provide valuable lessons that can be applied to future investments. By studying historical market crashes, investors can gain insights into the psychological biases and behaviors that contribute to these events. Here are some key lessons we can learn. 6.4.4.1 The importance of diversification. One of the most crucial lessons from historical market crashes is the importance of diversification. Diversifying investments across different asset classes, industries, and geographical regions can help mitigate the impact of a market crash. By spreading investments across various sectors, investors can reduce their exposure to any single market downturn. 6.4.4.2 Avoiding herd mentality. Another lesson is the need to avoid herd mentality and make independent investment decisions. During market crashes, it is essential to remain calm and rational, rather than succumbing to panic selling. By conducting thorough research and analysis, investors can make informed decisions based on their own investment goals and risk tolerance. 6.4.4.3 Long-term perspective. Market crashes often create short-term volatility and uncertainty. However, it is crucial to maintain a long-term perspective and not be swayed by short-term market fluctuations. By focusing on long-term investment goals and staying committed to a well-defined investment strategy, investors can ride out market downturns and potentially benefit from subsequent recoveries. 6.4.4.4 Risk management. Market crashes highlight the importance of effective risk management. Investors should regularly assess their risk tolerance and ensure that their investment portfolios are aligned with their risk appetite. Implementing risk management strategies such as stop-loss orders or diversifying across different asset classes can help mitigate potential losses during market downturns. 6.4.4.5 Learning from mistakes. Lastly, historical market crashes provide an opportunity for investors to learn from their mistakes. By analyzing their investment decisions during market downturns, investors can identify any psychological biases or emotional reactions that may have influenced their actions. This self-reflection can help investors develop a better understanding of their own investment psychology and make more informed decisions in the future. Conclusion. Learning from historical market crashes is essential for investors looking to navigate future investments successfully. By understanding the causes of market crashes, the role of investor sentiment, and the psychology of panic selling and herding behavior, investors can apply valuable lessons to their investment strategies. Diversification, avoiding herd mentality, maintaining a long-term perspective, implementing effective risk management, and learning from mistakes are all key takeaways from historical market crashes. By incorporating these lessons into their investment approach, investors can better position themselves to weather market downturns and achieve long-term investment success. 7. The impact of media and information on investor psychology. 7.1 The influence of media on investor sentiment and decision-making. The media plays a significant role in shaping investor sentiment and decision-making. With the rise of digital platforms and the 24/7 news cycle, investors are constantly bombarded with information and opinions that can greatly impact their investment choices. This section explores the various ways in which media influences investor psychology and provides strategies for effectively navigating the information overload. The power of media in shaping investor sentiment. Media outlets, including television, newspapers, magazines, and online platforms, have a profound influence on investor sentiment. The way news is presented, the language used, and the tone of the reporting can all sway investor emotions and perceptions. Positive news stories tend to create optimism and confidence, while negative news can induce fear and panic. One of the key ways in which media shapes investor sentiment is through the use of sensationalism. Sensational headlines and dramatic narratives grab attention and generate strong emotional responses. This can lead investors to make impulsive decisions based on short-term market fluctuations rather than long-term fundamentals. Moreover, media coverage often focuses on specific stocks, sectors, or market trends, creating a sense of urgency and fear of missing out (FOMO) among investors. This can lead to herd behavior, where investors follow the crowd without conducting thorough research or considering their own investment goals and risk tolerance. The role of biases in media reporting. Media outlets are not immune to biases, and these biases can significantly impact the information presented to investors. Confirmation bias, for example, occurs when media outlets selectively report information that aligns with their pre-existing beliefs or narratives. This can lead to a distorted view of the market and influence investor decision-making. Another bias commonly observed in media reporting is the availability bias. This bias occurs when media outlets focus on recent events or easily accessible information, leading investors to overestimate the likelihood of similar events occurring in the future. This can result in irrational investment decisions based on short-term trends rather than long-term analysis. The dangers of over-reliance on financial news and analyst recommendations. While staying informed is crucial for investors, over-reliance on financial news and analyst recommendations can be detrimental to investment decision-making. Media outlets often provide conflicting opinions and recommendations, which can confuse investors and lead to indecisiveness or impulsive actions. It is important to recognize that media outlets and analysts have their own biases and interests. They may have conflicts of interest or be influenced by external factors such as advertising revenue or personal investments. Relying solely on their recommendations without conducting independent research and analysis can lead to poor investment outcomes. Strategies for filtering and evaluating information. To navigate the influence of media on investor sentiment and decision-making, it is essential to develop strategies for filtering and evaluating information effectively. Here are some strategies to consider. Diversify your information sources. Relying on a single media outlet can lead to a narrow perspective. Seek information from a variety of sources, including reputable financial publications, independent research firms, and trusted investment professionals. Practice critical thinking. Be skeptical of sensational headlines and narratives. Analyze the underlying data and research supporting the claims made in media reports. Look for balanced and objective analysis rather than overly positive or negative viewpoints. Consider the source. Evaluate the credibility and track record of the media outlet or analyst providing the information. Look for transparency and independence in their reporting. Consider whether they have a vested interest in the investments they are discussing. Focus on long-term fundamentals. Avoid making investment decisions based solely on short-term news or market fluctuations. Instead, focus on the long-term fundamentals of the companies or assets you are considering. Conduct thorough research and analysis to make informed decisions. Maintain a disciplined investment strategy. Develop a well-defined investment strategy that aligns with your financial goals and risk tolerance. Stick to your strategy even in the face of media-induced market volatility. Avoid making impulsive decisions based on short-term news. By implementing these strategies, investors can mitigate the influence of media on their decision-making process and make more rational and informed investment choices. In conclusion, the media has a significant impact on investor sentiment and decision-making. Sensationalism, biases, and conflicting information can all sway investor emotions and perceptions. However, by diversifying information sources, practicing critical thinking, considering the source, focusing on long-term fundamentals, and maintaining a disciplined investment strategy, investors can navigate the influence of media and make more informed investment decisions. 7.2 The role of social media in shaping investment trends. Social media has become an integral part of our daily lives, influencing various aspects of society, including the world of finance and investing. With the rise of platforms like Facebook, Twitter, Instagram, and LinkedIn, individuals now have access to a vast amount of information and opinions that can shape their investment decisions. In this section, we will explore the role of social media in shaping investment trends and discuss its impact on investor psychology. The power of social media in investment decision-making. Social media platforms have revolutionized the way information is disseminated and consumed. Investors now have access to real-time news, market updates, and expert opinions at their fingertips. This instant access to information has both positive and negative implications for investment decision-making. On the positive side, social media allows investors to stay informed about market trends, economic indicators, and company news. It provides a platform for sharing insights, analysis, and investment strategies. Investors can connect with like-minded individuals, join investment communities, and learn from experienced professionals. This democratization of information has empowered individual investors, enabling them to make more informed decisions and participate in the financial markets. However, the abundance of information on social media can also be overwhelming and lead to information overload. Investors may find it challenging to filter through the noise and distinguish between reliable sources and misinformation. The speed at which information spreads on social media can also contribute to market volatility, as rumors and speculation can quickly influence investor sentiment and trigger rapid price movements. The influence of social media on investor sentiment. One of the significant impacts of social media on investor psychology is its ability to shape investor sentiment. Social media platforms provide a space for individuals to express their opinions, share experiences, and discuss investment ideas. These conversations can create a sense of community and influence how investors perceive certain stocks, sectors, or investment strategies. Positive sentiment on social media can create a herd mentality, where investors feel compelled to follow the crowd and invest in popular stocks or trends. This herd behavior can lead to market bubbles and exaggerated price movements, as investors rush to buy or sell based on the prevailing sentiment. Conversely, negative sentiment can fuel panic selling and market downturns, as fear and uncertainty spread rapidly through social media channels. It is essential for investors to be aware of the influence of social media on investor sentiment and exercise caution when making investment decisions based solely on social media trends. Relying solely on the opinions of others without conducting thorough research and analysis can lead to poor investment outcomes. The risks of social media in investment decision-making. While social media can provide valuable insights and opportunities, it also carries certain risks that investors should be aware of. One of the primary risks is the spread of misinformation and fake news. Social media platforms are susceptible to the dissemination of false or misleading information, which can significantly impact investor decisions. Investors should be cautious of pump and dump schemes, where individuals or groups manipulate stock prices by spreading false information to create artificial demand. These schemes often target inexperienced investors who are easily influenced by social media trends. It is crucial to verify information from reliable sources and conduct independent research before making investment decisions. Another risk of social media is the amplification of biases and echo chambers. Social media algorithms are designed to show users content that aligns with their interests and beliefs, creating echo chambers where individuals are exposed to a limited range of perspectives. This can reinforce existing biases and prevent investors from considering alternative viewpoints or challenging their own assumptions. Strategies for navigating social media in investment decision-making. To navigate the influence of social media on investment trends effectively, investors should adopt a cautious and discerning approach. Here are some strategies to consider. Diversify information sources. Relying on a single source of information, such as social media, can be risky. Investors should diversify their information sources by consulting reputable financial news outlets, research reports, and expert analysis. Verify information. Before acting on information obtained from social media, investors should verify its accuracy and credibility. Fact-checking and cross-referencing information with reliable sources can help mitigate the risks of misinformation. Conduct independent research. Investors should not solely rely on social media opinions but should conduct their own research and analysis. This includes studying company fundamentals, analyzing financial statements, and understanding market trends. Practice critical thinking. It is essential to approach social media content with a critical mindset. Investors should question the validity of claims, consider alternative viewpoints, and evaluate the credibility of the sources. Maintain emotional discipline. social media can be a source of emotional triggers, such as fear of missing out, FOMO, or panic selling. Investors should be aware of their emotional responses and strive to make rational decisions based on sound investment principles. Engage in constructive discussions. Participating in investment communities and engaging in constructive discussions can provide valuable insights and diverse perspectives. However, investors should be mindful of the potential for groupthink and should not blindly follow the opinions of others. By adopting these strategies, investors can leverage the benefits of social media while mitigating the risks associated with its influence on investment trends. It is crucial to maintain a balanced approach and make investment decisions based on thorough research, analysis, and a clear understanding of one's investment goals and risk tolerance. In the next section, we will explore the dangers of over-reliance on financial news and analyst recommendations and discuss strategies for filtering and evaluating information in the digital age. 7.3 The dangers of over-reliance on financial news and analyst recommendations. In today's fast-paced and information-driven world, investors have access to an overwhelming amount of financial news and analyst recommendations. While staying informed is crucial for making informed investment decisions, over-reliance on these sources can be dangerous. This section explores the potential pitfalls of relying too heavily on financial news and analyst recommendations and provides strategies for mitigating these risks. The problem with financial news. Financial news outlets, both traditional and digital, play a significant role in shaping investor sentiment and influencing market behavior. However, it is essential to recognize that financial news is often driven by sensationalism and short-term perspectives. News organizations are incentivized to attract viewers and readers, which can lead to the exaggeration of market trends, amplification of fear or greed, and the creation of a sense of urgency. 7.3.1 The impact of bias and sensationalism. Financial news outlets are not immune to bias. Journalists and commentators may have their own opinions and agendas, which can color their reporting and analysis. This bias can lead to the cherry-picking of data, the promotion of certain investment strategies or products, and the creation of a narrative that may not accurately reflect the overall market conditions. Sensationalism is another common issue in financial news. Dramatic headlines and attention-grabbing stories are more likely to attract viewers and readers, but they may not provide a balanced or accurate representation of the market. Investors who rely solely on sensationalized news may make impulsive and irrational investment decisions based on short-term fluctuations rather than long-term fundamentals. 7.3.2 The challenge of market timing. Financial news often focuses on short-term market movements and attempts to predict future trends. However, accurately timing the market is notoriously difficult, if not impossible. Trying to time the market based on news reports or analyst predictions can lead to frequent buying and selling, which can result in higher transaction costs and lower overall returns. The limitations of analyst recommendations. Analyst recommendations are another source of information that investors often rely on. Analysts study companies, industries, and market trends to provide insights and recommendations on specific stocks or investment opportunities. While these recommendations can be valuable, they also have limitations that investors should be aware of. 7.3.3 Conflicts of interest. Analysts are often employed by brokerage firms or investment banks, which may have their own interests in promoting certain stocks or investment products. Conflicts of interest can arise when analysts are influenced by the firms they work for or have personal financial incentives tied to their recommendations. Investors should consider the potential biases and conflicts of interest that may exist when evaluating analyst recommendations. 7.3.4 Accuracy and track record. Analyst recommendations are not always accurate or reliable indicators of future performance. Studies have shown that analysts' predictions are often incorrect or fail to outperform the market consistently. Investors who blindly follow analyst recommendations without conducting their own research and analysis may be exposed to unnecessary risks. Strategies for evaluating financial news and analyst recommendations. While it is important to stay informed, investors should approach financial news and analyst recommendations with a critical mindset. Here are some strategies to help evaluate and filter the information effectively. 7.3.5 Diversify information sources. Relying on a single news outlet or analyst can lead to a narrow perspective. It is advisable to diversify information sources to gain a broader understanding of market trends and opinions. By considering multiple viewpoints, investors can make more informed decisions and reduce the impact of bias or sensationalism. 7.3.6 Conduct independent research. Investors should not solely rely on financial news or analyst recommendations. Conducting independent research and analysis is crucial for understanding the underlying fundamentals of an investment opportunity. By examining financial statements, industry trends, and other relevant data, investors can make more informed decisions based on their own analysis. 7.3.7 Consider long-term fundamentals. Financial news often focuses on short-term market movements, which can create a sense of urgency and lead to impulsive decision-making. Investors should remember that successful investing is typically a long-term endeavor. By focusing on the long-term fundamentals of an investment, such as the company's financial health, competitive advantage, and growth potential, investors can avoid being swayed by short-term noise. 7.3.8 Seek professional advice. While it is important to conduct independent research, seeking professional advice can also be beneficial. Financial advisors or investment professionals can provide valuable insights and guidance based on their expertise and experience. However, it is crucial to choose advisors carefully and ensure that their recommendations align with your investment goals and risk tolerance. Conclusion. Financial news and analyst recommendations can be valuable sources of information for investors. However, it is essential to approach them with caution and critical thinking. Over-reliance on these sources can lead to biased decision-making, impulsive actions, and missed opportunities. By diversifying information sources, conducting independent research, considering long-term fundamentals, and seeking professional advice when needed, investors can navigate the complexities of the market more effectively and make informed investment decisions. 7.4 Strategies for filtering and evaluating information in the digital age. In today's digital age, investors have access to an overwhelming amount of information at their fingertips. With the click of a button, they can access news articles, financial reports, analyst recommendations, and social media discussions about various investment opportunities. However, not all information is reliable or relevant, and it can be challenging for investors to filter through the noise and make informed decisions. In this section, we will explore strategies for filtering and evaluating information in the digital age to help investors navigate the vast sea of data. 7.4.1 Identifying reliable sources. The first step in filtering and evaluating information is to identify reliable sources. With the rise of online platforms and social media, anyone can share their opinions and insights, making it crucial for investors to discern between credible and unreliable sources. Here are some strategies to consider. Established financial news outlets. Stick to reputable financial news outlets that have a track record of providing accurate and unbiased information. These outlets often have experienced journalists and analysts who conduct thorough research before publishing their reports. Industry experts. Look for insights from industry experts who have a deep understanding of the specific sector or company you are interested in. These experts may include renowned investors, analysts, or academics who have a proven track record of success in their field. Regulatory bodies. Check if the information is supported or regulated by reputable financial regulatory bodies. These organizations often provide guidelines and standards for financial reporting, ensuring the accuracy and reliability of the information. Peer-reviewed research. Consider academic research papers and studies that have undergone a rigorous peer review process. These papers are often published in reputable journals and can provide valuable insights into various investment topics. 7.4.2 Analyzing the quality of information. Once you have identified reliable sources, the next step is to analyze the quality of the information provided. Not all information is created equal, and it is essential to evaluate its relevance, accuracy, and bias. Here are some strategies to help you analyze the quality of information. Cross-referencing. Cross-reference the information from multiple sources to ensure consistency and accuracy. If multiple reputable sources are reporting the same information, it is more likely to be reliable. Fact-checking. Verify the facts and figures presented in the information. Look for supporting evidence or data that can validate the claims made. Be cautious of information that lacks supporting evidence or relies heavily on assumptions. Consider the source's motivation. Understand the motivations behind the source of the information. Some sources may have a vested interest in promoting a particular investment or agenda, which can introduce bias. Consider the source's reputation, affiliations, and potential conflicts of interest. Evaluate the methodology. Assess the methodology used to gather and analyze the information. Look for transparency in the research process and consider whether the methodology is sound and reliable. Be cautious of information that lacks transparency or uses questionable methods. 7.4.3 Utilizing technology and tools. In the digital age, technology has provided investors with various tools and platforms to filter and evaluate information more efficiently. Here are some strategies for utilizing technology and tools. News aggregators. Utilize news aggregators that compile news articles from multiple sources into one platform. These aggregators often allow users to customize their news feed based on their interests, ensuring that they receive relevant and up-to-date information. Data analytics tools. Take advantage of data analytics tools that can help analyze large datasets and identify patterns or trends. These tools can provide valuable insights into market sentiment, company performance, and industry trends. Social media monitoring. Monitor social media platforms to gauge investor sentiment and identify emerging trends. However, exercise caution when relying on social media as it can be prone to misinformation and manipulation. Financial analysis software. Consider using financial analysis software that can help evaluate the financial health and performance of companies. These tools often provide comprehensive financial data, ratios, and valuation metrics that can aid in investment decision-making. 7.4.4 Developing a personalized information filtering system. Every investor is unique, and what works for one may not work for another. It is essential to develop a personalized information filtering system that aligns with your investment goals, risk tolerance, and preferences. Here are some strategies to consider. Define your investment criteria. Clearly define your investment criteria, including factors such as industry focus, company size, financial metrics, and risk tolerance. This will help you filter out irrelevant information and focus on what matters most to your investment strategy. Create a watch list. Maintain a watch list of companies or investment opportunities that align with your investment criteria. This will allow you to track and monitor specific investments more closely, filtering out noise from unrelated opportunities. Set up alerts. Utilize alert systems or notifications to stay updated on specific events or news related to your investments. This can help you filter through the vast amount of information and focus on what is most relevant to your portfolio. Regularly review and refine. Continuously review and refine your information filtering system based on your investment experiences and changing market conditions. Stay open to new strategies and tools that can enhance your decision-making process. By implementing these strategies for filtering and evaluating information in the digital age, investors can make more informed and confident investment decisions. Remember, the key is to identify reliable sources, analyze the quality of information, utilize technology and tools, and develop a personalized information filtering system that aligns with your investment goals. 8. The psychology of long-term investing. 8.1 The benefits of long-term investing and compound growth. Long-term investing is a strategy that involves holding investments for an extended period, typically years or even decades. It is based on the principle of compound growth, which allows investors to benefit from the power of time and the compounding effect of returns. In this section, we will explore the numerous advantages of long-term investing and how compound growth can significantly enhance investment returns. 8.1.1 The power of compound growth. Compound growth is a fundamental concept in investing that refers to the ability of an investment to generate earnings, which are then reinvested to generate additional earnings. Over time, this compounding effect can lead to exponential growth in the value of an investment. The longer the investment horizon, the greater the potential for compounding to work its magic. The power of compound growth can be illustrated through a simple example. Let's say you invest $10,000 in a stock that generates an average annual return of 8%. After 1 year, your investment would grow to $10,800. In the second year, you would earn a return not only on your initial $10,000 but also on the $800 in earnings from the first year. This compounding effect continues to snowball over time, resulting in significant growth in your investment. 8.1.2 Time is an advantage. One of the key benefits of long-term investing is the advantage of time. By taking a long-term approach, investors can ride out short-term market fluctuations and benefit from the overall upward trajectory of the market. While short-term market movements can be unpredictable and volatile, the long-term trend of the stock market has historically been upward. Investors who adopt a long-term perspective are less likely to be swayed by short-term market noise and are more likely to make rational investment decisions based on the underlying fundamentals of the companies they invest in. This patient approach allows investors to avoid the temptation of trying to time the market, which is notoriously difficult to do consistently. 8.1.3 Reduced transaction costs. Another advantage of long-term investing is the potential for reduced transaction costs. When investors buy and sell investments frequently, they incur transaction fees, such as brokerage commissions. These costs can eat into investment returns, especially for active traders who engage in frequent buying and selling. In contrast, long-term investors tend to have lower transaction costs because they hold on to their investments for an extended period. By minimizing trading activity, long-term investors can save on transaction fees and preserve more of their investment returns. 8.1.4 Tax efficiency. Long-term investing can also offer tax advantages. In many countries, investments held for more than a year are subject to lower capital gains tax rates compared to short-term investments. By holding investments for the long term, investors can potentially reduce their tax liabilities and keep more of their investment gains. Additionally, long-term investors can take advantage of tax-deferred or tax-free investment accounts, such as individual retirement accounts (IRAs) or 401k plans. These accounts allow investors to grow their investments without incurring immediate tax obligations, providing a powerful tool for long-term wealth accumulation. 8.1.5 Peace of mind and reduced stress. Long-term investing can provide investors with peace of mind and reduce the stress associated with short-term market fluctuations. By focusing on the long-term prospects of their investments, investors can avoid getting caught up in the day-to-day volatility of the market. This long-term perspective allows investors to make more rational and informed decisions, rather than being driven by short-term emotions and market noise. By staying committed to their investment strategy and maintaining a long-term perspective, investors can navigate market downturns with confidence, knowing that their investments have the potential to recover and grow over time. 8.1.6 Building wealth over time. Perhaps the most significant benefit of long-term investing is the potential to build substantial wealth over time. By harnessing the power of compound growth, investors can see their investments grow exponentially, especially when reinvesting dividends or interest. Long-term investing allows investors to take advantage of the long-term economic growth and innovation that drives the stock market. By staying invested in a diversified portfolio of quality investments, investors can participate in the growth of companies and industries over time, leading to significant wealth accumulation. 8.1.7 The importance of patience and discipline. To fully reap the benefits of long-term investing and compound growth, investors must exercise patience and discipline. It is essential to resist the temptation to make impulsive investment decisions based on short-term market movements or the latest investment fads. Successful long-term investors understand that investing is a marathon, not a sprint. They stay committed to their investment strategy, regularly review their portfolio, and make adjustments as needed, but without succumbing to knee-jerk reactions. By maintaining a long-term perspective and adhering to a disciplined approach, investors can maximize the benefits of long-term investing and compound growth. In conclusion, long-term investing offers numerous advantages, including the power of compound growth, the advantage of time, reduced transaction costs, tax efficiency, peace of mind, and the potential to build substantial wealth over time. By adopting a patient and disciplined approach, investors can harness the benefits of long-term investing and achieve their financial goals. 8.2 Overcoming short-term thinking and impatience. In the fast-paced world of investing, it is easy to fall into the trap of short-term thinking and impatience. Many investors are driven by the desire for quick profits and instant gratification, often neglecting the long-term potential of their investments. However, successful investors understand the importance of overcoming these tendencies and adopting a more patient and long-term approach to investing. 8.2.1 The dangers of short-term thinking. Short-term thinking can be detrimental to investment success for several reasons. Firstly, it often leads to impulsive decision-making based on short-term market fluctuations rather than a thorough analysis of the underlying fundamentals of an investment. This reactive approach can result in buying high and selling low, as investors chase short-term gains and panic during market downturns. Secondly, short-term thinking can prevent investors from fully benefiting from the power of compounding. Compounding is the process by which investment returns generate additional returns over time. By constantly buying and selling investments in search of quick profits, investors miss out on the potential for exponential growth that comes with long-term investing. Lastly, short-term thinking can lead to a lack of discipline and consistency in investment strategies. Investors who are constantly chasing the latest hot stock or market trend often find themselves jumping from one investment to another, without giving their strategies enough time to play out. This lack of discipline can result in missed opportunities and subpar returns. 8.2.2 The benefits of long-term thinking. Overcoming short-term thinking and embracing a long-term perspective can have numerous benefits for investors. Firstly, it allows investors to focus on the underlying fundamentals of an investment rather than short-term market fluctuations. By conducting thorough research and analysis, investors can identify investments with strong long-term growth potential, regardless of short-term market volatility. Secondly, long-term thinking enables investors to take advantage of the power of compounding. By staying invested in quality assets over an extended period, investors can benefit from the compounding effect, where their investment returns generate additional returns, leading to exponential growth over time. This can significantly enhance the overall returns of an investment portfolio. Furthermore, adopting a long-term mindset promotes discipline and consistency in investment strategies. Instead of being swayed by short-term market noise, long-term investors stick to their investment plans and strategies, allowing them to ride out market fluctuations and stay focused on their long-term goals. This disciplined approach can lead to more consistent and predictable investment outcomes. 8.2.3 Strategies for overcoming short-term thinking and impatience. Overcoming short-term thinking and impatience requires a conscious effort and the implementation of specific strategies. Here are some strategies that can help investors adopt a more long-term approach to investing. 8.2.3.1 Set clear long-term goals. Setting clear and specific long-term goals is essential for overcoming short-term thinking. By defining your investment objectives and time horizon, you can align your investment decisions with your long-term goals. This clarity of purpose will help you stay focused on the bigger picture and avoid being swayed by short-term market fluctuations. 8.2.3.2 Develop a long-term investment plan. A well-defined and comprehensive investment plan is crucial for overcoming short-term thinking. Your investment plan should outline your asset allocation strategy, risk tolerance, and investment time horizon. By having a plan in place, you can resist the temptation to make impulsive decisions based on short-term market movements and stick to your long-term investment strategy. 8.2.3.3 Conduct thorough research and analysis. To overcome short-term thinking, it is essential to conduct thorough research and analysis before making investment decisions. By focusing on the underlying fundamentals of an investment, such as the company's financial health, competitive advantage, and growth potential, you can make informed decisions based on long-term prospects rather than short-term market trends. 8.2.3.4 Practice patience and discipline. Patience and discipline are key virtues for long-term investors. It is important to resist the urge to constantly monitor your investments and make frequent changes based on short-term market movements. Instead, trust in your investment plan and give your investments time to grow and deliver results. This patience and discipline will help you avoid knee-jerk reactions and stay focused on your long-term goals. 8.2.3.5 Diversify your portfolio. Diversification is a crucial strategy for long-term investors. By spreading your investments across different asset classes, sectors, and geographic regions, you can reduce the impact of short-term market volatility on your portfolio. Diversification helps to smooth out the ups and downs of individual investments and provides a more stable and consistent long-term return. 8.2.3.6 Seek professional advice. If you find it challenging to overcome short-term thinking and impatience on your own, seeking professional advice can be beneficial. Financial advisors can provide guidance and help you develop a long-term investment strategy that aligns with your goals and risk tolerance. They can also provide an objective perspective during times of market volatility and help you stay focused on your long-term plan. Conclusion. Overcoming short-term thinking and impatience is crucial for long-term investment success. By adopting a more patient and long-term approach to investing, investors can avoid the pitfalls of short-term market fluctuations and benefit from the power of compounding. Implementing strategies such as setting clear long-term goals, developing a comprehensive investment plan, conducting thorough research, practicing patience and discipline, diversifying the portfolio, and seeking professional advice can help investors overcome short-term thinking and achieve their long-term investment objectives. 8.3 The role of goal setting and planning in long-term investment success. Setting clear goals and creating a well-defined plan are crucial elements for long-term investment success. In this section, we will explore the importance of goal setting and planning in achieving financial objectives and building wealth over time. 8.3.1 The power of setting goals. Goal setting is a fundamental aspect of any successful endeavor, and investing is no exception. By setting specific, measurable, achievable, relevant, and time-bound, SMART goals, investors can create a roadmap for their financial journey. Goals provide direction, motivation, and a sense of purpose, helping investors stay focused and committed to their long-term investment strategy. When setting investment goals, it is essential to consider both short-term and long-term objectives. Short-term goals may include saving for a down payment on a house or funding a child's education, while long-term goals could involve retirement planning or building a substantial investment portfolio. By clearly defining these goals, investors can align their investment decisions with their desired outcomes. 8.3.2 Planning for success. Once goals are established, the next step is to develop a comprehensive investment plan. A well-crafted plan takes into account various factors, such as risk tolerance, time horizon, and financial resources. It outlines the steps needed to achieve the desired outcomes and serves as a guide for making informed investment decisions. 8.3.2.1 Assessing risk tolerance. Understanding one's risk tolerance is a critical component of investment planning. Risk tolerance refers to an individual's ability to withstand fluctuations in the value of their investments. Some investors may be comfortable with higher levels of risk in pursuit of potentially higher returns, while others may prefer a more conservative approach. Assessing risk tolerance involves considering factors such as age, financial obligations, investment knowledge, and personal comfort with market volatility. By aligning investment decisions with risk tolerance, investors can avoid making impulsive choices driven by fear or greed. 8.3.2.2 Determining time horizon. Another crucial aspect of investment planning is determining the time horizon for achieving financial goals. Time horizon refers to the length of time an investor expects to hold their investments before needing to access the funds. It can vary depending on the specific goal, such as short-term goals that may require funds within a few years or long-term goals that may span several decades. Understanding the time horizon allows investors to select appropriate investment vehicles and strategies. For long-term goals, investors may have a higher tolerance for short-term market fluctuations and can consider investments with potentially higher returns, such as stocks. Conversely, for short-term goals, investors may prioritize capital preservation and opt for more stable investments, such as bonds or cash equivalents. 8.3.2.3 Allocating resources. Investment planning also involves determining the amount of financial resources available for investing. This includes evaluating income, expenses, and existing assets. By assessing their financial situation, investors can establish a realistic investment budget and allocate funds accordingly. It is crucial to strike a balance between investing and maintaining an emergency fund or addressing other financial obligations. Adequate diversification across different asset classes and investment vehicles is also essential to manage risk effectively. 8.3.3 Benefits of goal setting and planning. 8.3.3.1 Focus and discipline. Goal setting and planning provide investors with a clear focus and sense of direction. They help investors stay disciplined and avoid impulsive decisions driven by short-term market fluctuations or emotional reactions. By adhering to a well-defined plan, investors can resist the temptation to deviate from their long-term investment strategy. 8.3.3.2 Long-term perspective. Investing with a long-term perspective is crucial for achieving financial goals. By setting long-term goals and developing a plan, investors can avoid getting caught up in short-term market noise and focus on the bigger picture. This perspective allows investors to ride out market volatility and take advantage of compounding returns over time. 8.3.3.3 Mitigating emotional bias. Emotions can significantly impact investment decisions. Fear and greed can lead to irrational choices, such as panic selling during market downturns or chasing speculative investments. However, goal setting and planning provide a rational framework that helps mitigate emotional biases. By focusing on long-term objectives, investors can make decisions based on logic and analysis rather than succumbing to emotional impulses. 8.3.3.4 Measuring progress. Setting goals and creating a plan also enables investors to track their progress. Regularly reviewing investment performance against established benchmarks allows investors to assess whether they are on track to achieve their goals. If necessary, adjustments can be made to the investment plan to ensure alignment with changing circumstances or market conditions. 8.3.4 Implementing the plan. Once goals are set, and a plan is in place, it is crucial to implement the investment strategy effectively. This involves selecting appropriate investment vehicles, diversifying the portfolio, and regularly monitoring and rebalancing the investments. 8.3.4.1 Selecting investment vehicles. Investors have a wide range of investment vehicles to choose from, including stocks, bonds, mutual funds, exchange-traded funds, ETFs, real estate, and more. The selection of investment vehicles should align with the investor's goals, risk tolerance, and time horizon. Diversification across different asset classes and sectors can help spread risk and potentially enhance returns. 8.3.4.2 Diversification and asset allocation. Diversification is a key principle in investment planning. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce the impact of any single investment's performance on their overall portfolio. Asset allocation involves determining the appropriate mix of stocks, bonds, and other assets based on risk tolerance and investment objectives. 8.3.4.3 Monitoring and rebalancing. Regular monitoring of investments is essential to ensure they remain aligned with the investment plan. Market conditions, economic factors, and changes in personal circumstances may necessitate adjustments to the portfolio. Rebalancing involves periodically reviewing the asset allocation and making adjustments to maintain the desired risk profile. Conclusion. Goal setting and planning are integral components of long-term investment success. By setting clear goals, developing a comprehensive plan, and implementing the strategy effectively, investors can navigate the complexities of the financial markets with confidence and increase their chances of achieving their desired financial outcomes. Remember, investing is a journey, and having a roadmap in the form of goals and a plan can make all the difference in reaching your destination. 8.4 Building a diversified portfolio for long-term wealth accumulation. Building a diversified portfolio is a crucial step in achieving long-term wealth accumulation. Diversification is a risk management strategy that involves spreading investments across different asset classes, industries, and geographic regions. By diversifying your portfolio, you can reduce the impact of individual investment losses and increase the potential for consistent returns over time. 8.4.1 The importance of diversification. Diversification is often referred to as the only free lunch in investing. It is based on the principle that different investments perform differently under various market conditions. By investing in a variety of assets, you can potentially benefit from the positive performance of some investments while mitigating the negative impact of others. One of the main advantages of diversification is that it helps to reduce the overall risk of your portfolio. When you hold a diversified portfolio, the performance of one investment is less likely to have a significant impact on your overall returns. This is because different asset classes tend to have different risk and return characteristics. For example, while stocks may offer higher potential returns, they also come with higher volatility. On the other hand, bonds tend to be more stable but offer lower returns. By combining these assets in a portfolio, you can achieve a balance between risk and return. 8.4.2 Asset allocation. Asset allocation is a key component of building a diversified portfolio. It involves determining the appropriate mix of asset classes based on your investment goals, risk tolerance, and time horizon. The three main asset classes are stocks, bonds, and cash equivalents. Stocks. Stocks represent ownership in a company and offer the potential for capital appreciation. They tend to have higher volatility but also higher long-term returns compared to other asset classes. When selecting stocks, it is important to consider factors such as the company's financial health, industry trends, and market conditions. Bonds. Bonds are debt instruments issued by governments, municipalities, and corporations. They provide fixed income in the form of interest payments and return of principal at maturity. Bonds are generally considered less risky than stocks and can provide stability to a portfolio. Factors to consider when investing in bonds include credit quality, interest rate risk, and the issuer's ability to repay the debt. Cash equivalents. Cash equivalents include short-term investments such as money market funds and treasury bills. These investments provide liquidity and stability to a portfolio. While they offer lower returns compared to stocks and bonds, they can be useful for short-term goals and as a buffer during market downturns. The specific allocation to each asset class will depend on your individual circumstances and investment objectives. A common approach is to determine an asset allocation based on your risk tolerance and then periodically rebalance the portfolio to maintain the desired allocation. 8.4.3 Geographic and industry diversification. In addition to asset allocation, geographic and industry diversification are important considerations when building a diversified portfolio. Geographic diversification involves investing in different countries and regions to reduce the impact of local economic and political events. By spreading investments across multiple countries, you can potentially benefit from global economic growth and reduce the risk of being overly exposed to a single market. Industry diversification involves investing in companies from different sectors of the economy. Different industries perform differently at various stages of the economic cycle. By diversifying across industries, you can reduce the impact of sector-specific risks and take advantage of opportunities in different sectors. 8.4.4 Rebalancing and monitoring. Once you have established a diversified portfolio, it is important to regularly monitor and rebalance your investments. Rebalancing involves adjusting the allocation of your portfolio to maintain the desired asset mix. Over time, the performance of different investments may cause your portfolio to deviate from the original allocation. By rebalancing, you can sell investments that have performed well and buy more of those that have underperformed, bringing your portfolio back in line with your target allocation. Monitoring your portfolio involves keeping track of the performance of your investments and staying informed about market trends and economic conditions. Regularly reviewing your portfolio can help you identify any necessary adjustments and ensure that your investments remain aligned with your long-term goals. 8.4.5 The benefits of a diversified portfolio. A well-diversified portfolio offers several benefits for long-term wealth accumulation. Risk reduction. Diversification helps to reduce the impact of individual investment losses by spreading risk across different assets. This can help protect your portfolio during market downturns. Consistent returns. By investing in a variety of assets, you can potentially benefit from the positive performance of some investments while mitigating the negative impact of others. This can lead to more consistent returns over time. Capital preservation. Diversification can help preserve capital by reducing the risk of significant losses. By spreading investments across different asset classes, you are less likely to be heavily impacted by the poor performance of a single investment. Opportunity for growth. A diversified portfolio allows you to take advantage of opportunities in different asset classes and industries. By investing in a variety of assets, you increase the likelihood of capturing growth in different areas of the market. Flexibility. Diversification provides flexibility in managing your investments. By having exposure to different asset classes, you can adjust your portfolio based on changing market conditions and your investment goals. In conclusion, building a diversified portfolio is essential for long-term wealth accumulation. By spreading investments across different asset classes, industries, and geographic regions, you can reduce risk, achieve consistent returns, and take advantage of opportunities in the market. Regular monitoring and rebalancing are important to ensure that your portfolio remains aligned with your investment objectives. Remember, diversification is not a guarantee against losses, but it is a prudent strategy to manage risk and increase the potential for long-term investment success. 9. The psychology of investment success. 9.1 The importance of discipline and consistency in investment strategies. Discipline and consistency are two crucial factors that play a significant role in achieving investment success. In the world of investing, emotions can often cloud judgment and lead to impulsive decision-making. However, by cultivating discipline and maintaining consistency in our investment strategies, we can overcome these challenges and increase our chances of achieving long-term financial goals. 9.1.1 The role of discipline in investment strategies. Discipline is the ability to stick to a predetermined investment plan, regardless of market conditions or short-term fluctuations. It involves following a set of rules and guidelines that have been carefully crafted based on thorough research and analysis. By adhering to these principles, investors can avoid making impulsive decisions driven by fear or greed. One of the key aspects of discipline in investing is having a well-defined investment strategy. This strategy should outline the investor's goals, risk tolerance, and time horizon. It should also include a diversified portfolio that aligns with the investor's objectives. By having a clear plan in place, investors can avoid making hasty decisions based on short-term market movements. Discipline also plays a crucial role in managing emotions. The market is inherently volatile, and it is natural for investors to experience fear and anxiety during periods of market downturns. However, disciplined investors understand that market fluctuations are a part of the investment journey and do not let short-term emotions dictate their long-term investment decisions. 9.1.2 The benefits of consistency in investment strategies. Consistency is the practice of sticking to a well-defined investment strategy over an extended period. It involves avoiding frequent changes to the investment plan based on short-term market movements or external influences. Consistency allows investors to benefit from the power of compounding and take advantage of long-term market trends. One of the primary benefits of consistency is the reduction of transaction costs. Frequent buying and selling of investments can lead to increased transaction fees and taxes, which can eat into investment returns. By maintaining a consistent investment strategy, investors can minimize unnecessary trading and associated costs. Consistency also helps in avoiding market timing errors. Trying to time the market by buying low and selling high is a challenging task even for experienced investors. Consistent investors understand that it is nearly impossible to predict short-term market movements accurately. Instead, they focus on long-term trends and stay invested for the duration required to achieve their financial goals. Another advantage of consistency is the reduction of emotional decision-making. Emotional decision-making often leads to poor investment choices and can result in significant losses. By sticking to a consistent investment strategy, investors can avoid making impulsive decisions based on short-term market fluctuations or external noise. 9.1.3 Strategies for cultivating discipline and consistency. Cultivating discipline and consistency in investment strategies requires conscious effort and a commitment to long-term goals. Here are some strategies that can help investors in this endeavor. 9.1.3.1 Set clear investment goals. Setting clear investment goals is the first step towards cultivating discipline and consistency. Investors should define their financial objectives, such as retirement planning, education funding, or wealth accumulation. These goals should be specific, measurable, achievable, relevant, and time-bound. Smart. By having well-defined goals, investors can stay focused and motivated throughout their investment journey. 9.1.3.2 Develop a long-term investment plan. A well-crafted investment plan is essential for maintaining consistency. This plan should consider the investor's risk tolerance, time horizon, and financial goals. It should also include a diversified portfolio that spreads risk across different asset classes. By developing a long-term investment plan, investors can avoid making impulsive decisions based on short-term market movements. 9.1.3.3 Stick to the plan. Once an investment plan is in place, it is crucial to stick to it. This requires discipline and the ability to resist the temptation to deviate from the plan during periods of market volatility. Investors should avoid making knee-jerk reactions to short-term market movements and instead focus on the long-term objectives outlined in their investment plan. 9.1.3.4 Regularly review and rebalance the portfolio. While consistency is important, it is also essential to periodically review and rebalance the investment portfolio. Market conditions and personal circumstances may change over time, requiring adjustments to the investment strategy. Regular portfolio reviews can help ensure that the portfolio remains aligned with the investor's goals and risk tolerance. 9.1.3.5 Seek professional guidance. Investing can be complex, and seeking professional guidance can provide valuable insights and help maintain discipline and consistency. Financial advisors can assist in developing an investment plan, provide objective advice during market downturns, and help investors stay focused on their long-term goals. Conclusion. Discipline and consistency are vital attributes for successful investing. By cultivating discipline, investors can avoid impulsive decision-making driven by emotions. Consistency, on the other hand, allows investors to benefit from the power of compounding and avoid market timing errors. By following a well-defined investment plan, regularly reviewing the portfolio, and seeking professional guidance when needed, investors can increase their chances of achieving long-term financial success. 9.2 The role of continuous learning and adaptability in investing. Investing is a dynamic and ever-changing field, influenced by a multitude of factors such as market conditions, economic trends, and technological advancements. In order to navigate this complex landscape successfully, investors must possess a mindset of continuous learning and adaptability. This section explores the importance of these qualities in investment success and provides strategies for developing them. The need for continuous learning. In the world of investing, knowledge is power. The financial markets are constantly evolving, and new information and insights emerge regularly. To stay ahead of the curve, investors must commit themselves to continuous learning. This involves staying updated on market trends, economic indicators, and industry developments. By expanding their knowledge base, investors can make more informed decisions and identify opportunities that others may overlook. 9.2.1 Staying informed. Staying informed is a crucial aspect of continuous learning in investing. Investors should regularly read financial news, research reports, and industry publications to gain insights into market trends and developments. Additionally, attending seminars, webinars, and conferences can provide valuable opportunities to learn from industry experts and network with other investors. By actively seeking out new information, investors can enhance their understanding of the market and make more informed investment decisions. 9.2.2 Embracing technology. Technology has revolutionized the way we access and analyze information. Investors can leverage various tools and platforms to gather data, conduct research, and analyze market trends. Online brokerage platforms offer real-time market data, research reports, and educational resources that can help investors stay informed. Additionally, financial news websites, blogs, and social media platforms provide a wealth of information and insights from experts and fellow investors. Embracing technology and utilizing these resources can enhance an investor's ability to adapt to changing market conditions. The importance of adaptability. Adaptability is the ability to adjust and respond effectively to changing circumstances. In the world of investing, where market conditions can fluctuate rapidly, adaptability is a crucial trait for success. Investors who are adaptable can quickly assess new information, adjust their strategies, and capitalize on emerging opportunities. 9.2.3 Flexibility in investment strategies. Adaptable investors understand that there is no one-size-fits-all approach to investing. They are willing to adjust their strategies based on market conditions, risk appetite, and investment goals. For example, during periods of market volatility, an adaptable investor may choose to allocate a larger portion of their portfolio to defensive assets or adopt a more conservative approach. By being flexible in their investment strategies, investors can mitigate risks and maximize returns. 9.2.4 Embracing change. The financial markets are constantly evolving, driven by technological advancements, regulatory changes, and global events. Adaptable investors embrace change and view it as an opportunity rather than a threat. They are open to exploring new investment avenues, such as emerging industries or innovative financial products. By embracing change, investors can position themselves to benefit from emerging trends and capitalize on new opportunities. Strategies for continuous learning and adaptability. Developing a mindset of continuous learning and adaptability requires deliberate effort and the implementation of effective strategies. Here are some strategies that can help investors enhance their learning and adaptability skills. 9.2.5 Building a diverse network. Networking with other investors, industry professionals, and mentors can provide valuable insights and perspectives. Engaging in discussions, attending investment clubs or forums, and participating in online communities can expose investors to different investment strategies and approaches. By building a diverse network, investors can learn from others' experiences and gain new perspectives on the market. 9.2.6 Seeking professional guidance. Working with a financial advisor or investment professional can provide investors with expert guidance and insights. These professionals have in-depth knowledge of the market and can help investors navigate complex investment decisions. By seeking professional guidance, investors can benefit from the expertise and experience of others, enhancing their learning and adaptability. 9.2.7 Reviewing and reflecting on investment decisions. Regularly reviewing and reflecting on investment decisions is an essential part of the learning process. Investors should analyze the outcomes of their investments, identify successes and failures, and understand the factors that influence their decisions. This self-reflection allows investors to learn from their experiences and make adjustments to their strategies as needed. 9.2.8 Embracing a growth mindset. A growth mindset is the belief that abilities and intelligence can be developed through dedication and hard work. Investors with a growth mindset view challenges as opportunities for growth and are not afraid to step out of their comfort zones. They embrace failures as learning experiences and are willing to adapt their strategies based on new information. By cultivating a growth mindset, investors can continuously improve their skills and adaptability. In conclusion, continuous learning and adaptability are essential qualities for successful investing. By staying informed, embracing technology, and being open to change, investors can enhance their decision-making abilities and capitalize on opportunities. Implementing strategies such as building a diverse network, seeking professional guidance, and embracing a growth mindset can further enhance an investor's learning and adaptability skills. By continuously evolving and adapting, investors can position themselves for long-term investment success. 9.3 The power of positive thinking and visualization in investment success. Positive thinking and visualization play a crucial role in investment success. The way we think and perceive our investments can greatly impact our decision-making process and ultimately determine our outcomes. By harnessing the power of positive thinking and visualization, investors can cultivate a mindset that is conducive to making sound investment choices and achieving long-term financial goals. 9.3.1 The influence of positive thinking on investment decisions. Positive thinking involves maintaining an optimistic outlook and focusing on the potential for success rather than dwelling on potential failures. When it comes to investing, positive thinking can have a profound impact on our decision-making process. Here are a few ways in which positive thinking influences investment decisions. 9.3.1.1 Confidence and risk-taking. Positive thinking instills confidence in investors, allowing them to take calculated risks. When investors believe in the potential of their investments, they are more likely to make bold decisions and seize opportunities that others may overlook. This confidence can lead to higher returns and greater investment success. 9.3.1.2 Emotional resilience. Investing can be a roller coaster ride, with ups and downs that can evoke a range of emotions. Positive thinking helps investors develop emotional resilience, enabling them to navigate through market volatility and setbacks without succumbing to fear or panic. By maintaining a positive mindset, investors can stay focused on their long-term goals and make rational decisions even in challenging times. 9.3.1.3 Attracting opportunities. Positive thinking has a way of attracting opportunities. When investors radiate positivity, they tend to attract like-minded individuals and opportunities that align with their goals. This can lead to valuable connections, access to exclusive investment opportunities, and a network of supportive individuals who can provide guidance and insights. 9.3.2 The power of visualization in investment success. Visualization is a powerful technique that involves creating mental images of desired outcomes. By visualizing success in their investments, investors can program their minds to focus on achieving their goals. Here are a few ways in which visualization can contribute to investment success. 9.3.2.1 Clarifying goals and objectives. Visualization helps investors clarify their goals and objectives. By visualizing the end result they desire, investors can gain clarity on what they want to achieve and create a roadmap to get there. This clarity allows them to make more informed investment decisions that align with their long-term vision. 9.3.2.2 Building confidence and self-belief. Visualization builds confidence and self-belief in investors. By vividly imagining themselves achieving their investment goals, investors can boost their confidence and develop a strong belief in their abilities. This self-belief translates into a positive mindset and the motivation to take the necessary actions to achieve their desired outcomes. 9.3.2.3 Overcoming obstacles and challenges. Investing is not without its challenges and obstacles. Visualization can help investors overcome these hurdles by mentally rehearsing how they will navigate through difficult situations. By visualizing themselves successfully overcoming challenges, investors can develop a resilient mindset and be better prepared to handle setbacks that may arise along their investment journey. 9.3.2.4 Enhancing Focus and Discipline. Visualization enhances focus and discipline in investors. By regularly visualizing their investment goals, investors can stay focused on what truly matters and avoid distractions that may hinder their progress. This heightened focus and discipline enable investors to make consistent and rational decisions, even in the face of market fluctuations or external pressures. 9.3.3 Incorporating positive thinking and visualization into investment practices. To harness the power of positive thinking and visualization, investors can incorporate the following practices into their investment routines. 9.3.3.1 Daily Affirmations. Start each day with positive affirmations related to your investment goals. Repeat statements such as, "I am a successful investor," or "I make wise investment decisions," to reinforce positive beliefs and attitudes towards your investments. 9.3.3.2 Visualization Exercises. Set aside dedicated time each day to visualize your investment success. Close your eyes and vividly imagine yourself achieving your financial goals. Visualize the steps you need to take, the obstacles you may encounter, and how you will overcome them. Engage all your senses to make the visualization experience as real as possible. 9.3.3.3 Surround yourself with positivity. Surround yourself with positive influences that support your investment journey. Engage in conversations with like-minded individuals, read motivational books or articles, and listen to podcasts or videos that inspire and uplift you. By immersing yourself in positivity, you can maintain a positive mindset and reinforce your belief in your investment abilities. 9.3.3.4 Regular reflection and gratitude. Take time to reflect on your investment journey and express gratitude for the progress you have made. Reflecting on your achievements and expressing gratitude for the opportunities you have can reinforce positive thinking and keep you motivated to continue working towards your goals. Conclusion. Positive thinking and visualization are powerful tools that can significantly impact investment success. By cultivating a positive mindset and visualizing their desired outcomes, investors can enhance their decision-making process, build confidence, and overcome challenges. Incorporating these practices into their investment routines can help investors stay focused, motivated, and resilient, ultimately leading to long-term financial growth and success. 9.4 Developing a growth mindset for long-term investment growth. In the world of investing, having a growth mindset is crucial for long-term success. A growth mindset is the belief that one's abilities and intelligence can be developed through dedication, hard work, and continuous learning. This mindset is in contrast to a fixed mindset, which believes that abilities and intelligence are fixed traits that cannot be changed. When it comes to investing, a growth mindset can make a significant difference in how investors approach their decisions and handle challenges. It allows investors to embrace failures as learning opportunities, adapt to changing market conditions, and persist in the face of setbacks. In this section, we will explore the importance of developing a growth mindset for long-term investment growth and provide strategies to cultivate this mindset. 9.4.1 Embracing failure as a learning opportunity. One of the key aspects of a growth mindset is the ability to view failures as valuable learning experiences. In the world of investing, losses are inevitable, and setbacks are a part of the journey. However, instead of being discouraged by failures, investors with a growth mindset see them as opportunities for growth and improvement. By reframing failures as learning opportunities, investors can analyze their mistakes, identify areas for improvement, and adjust their strategies accordingly. They understand that setbacks are not permanent and that they can learn from their mistakes to make better investment decisions in the future. This mindset allows investors to bounce back from failures and continue their journey towards long-term investment growth. 9.4.2 Cultivating a continuous learning mindset. Investing is a dynamic field that is constantly evolving. To stay ahead and achieve long-term growth, investors need to embrace a continuous learning mindset. This involves seeking out new information, staying updated on market trends, and expanding their knowledge and skills. Investors with a growth mindset understand the importance of continuous learning and actively seek opportunities to expand their understanding of the financial markets. They read books, attend seminars, follow industry experts, and engage in discussions with other investors. By staying curious and open-minded, they are able to adapt to changing market conditions and make informed investment decisions. 9.4.3 Setting realistic goals and tracking progress. A growth mindset in investing also involves setting realistic goals and tracking progress. Investors with a growth mindset understand that success in investing is a long-term journey and that it requires patience and perseverance. They set achievable goals that align with their investment strategy and regularly track their progress towards those goals. By setting realistic goals, investors can avoid the trap of chasing quick gains or succumbing to impulsive decisions. They focus on the process rather than the outcome and understand that consistent progress over time leads to long-term growth. This mindset allows investors to stay disciplined and avoid making rash decisions based on short-term market fluctuations. 9.4.4 Seeking feedback and constructive criticism. Investors with a growth mindset actively seek feedback and constructive criticism to improve their investment strategies. They understand that feedback is essential for growth and that it can provide valuable insights into areas for improvement. By seeking feedback from mentors, financial advisors, or other experienced investors, individuals can gain different perspectives and identify blind spots in their investment approach. They are open to constructive criticism and use it as an opportunity to refine their strategies and make better informed decisions. 9.4.5 Cultivating Resilience and Perseverance. Investing can be a roller coaster ride, with ups and downs along the way. Investors with a growth mindset understand the importance of resilience and perseverance in navigating through the challenges. They do not let temporary setbacks discourage them or derail their long-term goals. Instead, they view challenges as opportunities to grow and develop their skills. They remain focused on their long-term investment strategy and stay committed to their goals, even in the face of adversity. This resilience allows them to weather market fluctuations and stay on track towards long-term investment growth. 9.4.6 Surrounding yourself with a supportive network. Developing a growth mindset in investing is not a solitary journey. It is essential to surround yourself with a supportive network of like-minded individuals who share your goals and values. By connecting with other investors, you can learn from their experiences, gain insights, and receive support during challenging times. A supportive network can provide encouragement, accountability, and valuable feedback. It can also serve as a source of inspiration and motivation to continue developing a growth mindset and pursuing long-term investment growth. 9.4.7 Practicing Patience and Delayed Gratification. Investors with a growth mindset understand the importance of patience and delayed gratification in achieving long-term investment growth. They resist the temptation to make impulsive decisions based on short-term market fluctuations and focus on their long-term goals. By practicing patience, investors can avoid chasing quick gains or succumbing to fear and panic during market downturns. They understand that successful investing requires time and discipline, and they are willing to wait for the right opportunities to maximize their returns. 9.4.8 Celebrating Progress and Small Wins. While long-term investment growth is the ultimate goal, investors with a growth mindset also celebrate progress and small wins along the way. They acknowledge and appreciate the effort they put into their investment journey and recognize the milestones they achieve. By celebrating progress and small wins, investors can maintain motivation and momentum. It reinforces the belief that their efforts are paying off and encourages them to continue developing a growth mindset for long-term investment success. In conclusion, developing a growth mindset is essential for long-term investment growth. It involves embracing failure as a learning opportunity, cultivating a continuous learning mindset, setting realistic goals, seeking feedback, cultivating resilience, surrounding yourself with a supportive network, practicing patience, and celebrating progress. By adopting a growth mindset, investors can navigate the challenges of investing, adapt to changing market conditions, and achieve long-term investment success. 10. The Psychology of Investment Mistakes. 10.1 Common investment mistakes and their psychological causes. Investing in the financial markets can be a complex and challenging endeavor. While there are many factors that can contribute to investment success, understanding investor psychology is crucial in avoiding common investment mistakes. In this section, we will explore some of the most common investment mistakes and their underlying psychological causes. 10.1.1 Overconfidence bias. One of the most prevalent psychological biases that can lead to investment mistakes is overconfidence bias. This bias occurs when investors have an inflated sense of their own abilities and believe they can consistently outperform the market. Overconfidence bias can lead investors to take on excessive risks, ignore warning signs, and make impulsive investment decisions. Overconfidence bias is often fueled by past successes or a lack of understanding of the complexity of the financial markets. Investors who have experienced a string of profitable trades may become overconfident in their abilities, leading them to take on more risk than they can handle. Additionally, novice investors who lack experience and knowledge may overestimate their abilities, leading to poor investment decisions. To overcome overconfidence bias, it is important for investors to recognize their limitations and seek objective information and advice. Conducting thorough research, diversifying investments, and consulting with financial professionals can help mitigate the negative effects of overconfidence bias. 10.1.2 Confirmation bias. Confirmation bias is another psychological tendency that can lead to investment mistakes. This bias occurs when investors seek out information that confirms their pre-existing beliefs or opinions while ignoring or dismissing information that contradicts them. Confirmation bias can prevent investors from objectively evaluating investment opportunities and can lead to poor decision-making. Investors who exhibit confirmation bias may only seek out news or analysis that supports their existing investment thesis, ignoring any information that challenges their views. This can lead to a lack of diversification and an overemphasis on certain investments or sectors. Confirmation bias can also lead to a reluctance to sell investments that are performing poorly, as investors may cling to the hope that the investment will eventually recover. To overcome confirmation bias, investors should actively seek out diverse perspectives and challenge their own beliefs. Engaging in critical thinking, considering alternative viewpoints, and regularly reviewing investment portfolios can help mitigate the negative effects of confirmation bias. 10.1.3 Regret aversion. Regret aversion is a psychological bias that can cause investors to make irrational investment decisions. This bias occurs when investors are more concerned about the possibility of regretting a decision than the potential gains or losses associated with that decision. Regret aversion can lead investors to avoid taking necessary risks or to hold on to losing investments for longer than they should. Investors who exhibit regret aversion may be hesitant to sell an investment that has declined in value, fearing that they will regret the decision if the investment eventually recovers. This can lead to a reluctance to cut losses and a failure to rebalance portfolios. Regret aversion can also cause investors to miss out on potentially profitable investment opportunities due to a fear of making the wrong decision. To overcome regret aversion, investors should focus on the long-term goals and objectives of their investment strategy. Setting clear investment criteria and regularly reviewing and adjusting portfolios can help mitigate the negative effects of regret aversion. Additionally, seeking professional advice and guidance can provide investors with a more objective perspective and help alleviate the fear of regret. 10.1.4 Herding behavior. Herding behavior is a psychological phenomenon in which investors follow the actions and decisions of the majority, rather than making independent investment choices. This behavior is driven by a fear of missing out and a desire to conform to the actions of others. Herding behavior can lead to investment bubbles and market inefficiencies. Investors who engage in herding behavior may feel a sense of safety and security in following the crowd, believing that the collective wisdom of the market is more reliable than their own judgment. This can lead to a lack of critical thinking and independent analysis, as investors simply follow the actions of others without fully understanding the underlying fundamentals of the investments. To avoid falling into the trap of herding behavior, investors should focus on their own investment goals and objectives. Conducting thorough research, diversifying investments, and maintaining a long-term perspective can help mitigate the negative effects of herding behavior. Additionally, seeking out contrarian viewpoints and challenging the consensus can provide investors with a more balanced perspective. In conclusion, understanding the psychological causes of common investment mistakes is essential for investors to make informed and rational decisions. By recognizing and addressing biases such as overconfidence, confirmation bias, regret aversion, and herding behavior, investors can improve their investment outcomes and achieve long-term financial success. 10.2 The impact of overconfidence and confirmation bias on investment errors. Overconfidence and confirmation bias are two cognitive biases that can significantly impact investment decisions and lead to costly errors. These biases are deeply rooted in human psychology and can cloud judgment, distort perceptions, and hinder rational decision-making. Understanding how these biases influence investment errors is crucial for investors to avoid common pitfalls and make more informed choices. 10.2.1 Overconfidence bias. Overconfidence bias refers to the tendency of individuals to overestimate their abilities, knowledge, and the accuracy of their predictions. In the context of investing, overconfidence bias can lead investors to believe that they have superior skills or insights that will enable them to outperform the market consistently. This unwarranted confidence can result in excessive risk-taking, failure to diversify portfolios, and a disregard for proper due diligence. One of the reasons overconfidence bias is prevalent in investing is the illusion of control. Investors often believe that they have more control over the outcomes of their investments than they actually do. This belief can lead to an overestimation of their ability to predict market movements and make profitable trades. Overconfidence bias can also be fueled by past successes, where investors attribute their gains to skill rather than luck, leading them to believe they are infallible. The impact of overconfidence bias on investment errors is significant. Overconfident investors may engage in excessive trading, leading to higher transaction costs and lower overall returns. They may also fail to adequately assess and manage risks, leading to unexpected losses. Additionally, overconfidence bias can lead investors to ignore or dismiss contrary information or opinions, which can prevent them from making well-informed decisions. 10.2.2 Confirmation bias. Confirmation bias is the tendency to seek, interpret, and favor information that confirms pre-existing beliefs or hypotheses while ignoring or discounting contradictory evidence. In the context of investing, confirmation bias can lead investors to selectively seek out information that supports their existing views and ignore information that challenges or contradicts them. This bias can create an echo chamber effect, where investors surround themselves with like-minded individuals or sources of information that reinforce their beliefs. Confirmation bias can have a profound impact on investment errors. By selectively seeking out information that confirms their beliefs, investors may miss crucial data or alternative perspectives that could provide a more accurate assessment of an investment opportunity. This bias can lead to a lack of diversification in portfolios, as investors may only consider investments that align with their existing beliefs, rather than objectively evaluating a broader range of options. Confirmation bias can also lead to a reluctance to sell investments that are performing poorly. Investors may hold on to losing positions for longer than necessary, hoping that the market will eventually validate their initial beliefs. This can result in significant losses and missed opportunities to reallocate capital to more promising investments. 10.2.3 The combined impact. The combination of overconfidence bias and confirmation bias can amplify the potential for investment errors. Overconfidence bias can lead investors to be overly confident in their beliefs and predictions, while confirmation bias reinforces those beliefs by selectively seeking out information that supports them. This combination can create a dangerous feedback loop, where investors become increasingly convinced of their own infallibility and disregard contradictory evidence. The impact of these biases can be particularly pronounced during periods of market volatility or uncertainty. Overconfident investors may be more likely to take on excessive risks, while confirmation bias can prevent them from objectively evaluating the potential downsides of their investment decisions. This can result in significant losses and missed opportunities for more prudent decision-making. 10.2.4 Mitigating the impact. Recognizing and mitigating the impact of overconfidence and confirmation bias is crucial for investors to make more rational and informed decisions. Here are some strategies to help mitigate the influence of these biases. Self-awareness. Being aware of one's own biases is the first step towards mitigating their impact. Investors should regularly reflect on their decision-making processes and be open to challenging their own beliefs and assumptions. Seek diverse perspectives. Actively seek out diverse opinions and perspectives on investment opportunities. This can help counter confirmation bias by exposing investors to alternative viewpoints and potential risks they may have overlooked. Encourage dissenting opinions. Surrounding oneself with individuals who challenge one's beliefs can help mitigate the impact of confirmation bias. Encouraging dissenting opinions and engaging in constructive debates can lead to more well-rounded investment decisions. Maintain a disciplined approach. Developing and adhering to a disciplined investment strategy can help mitigate the influence of overconfidence bias. By following a predetermined plan, investors can avoid impulsive and emotionally driven decisions. Conduct thorough research. Engage in thorough research and due diligence before making investment decisions. This includes considering both positive and negative aspects of an investment opportunity and seeking out unbiased sources of information. Regularly review and reassess. Continuously review and reassess investment decisions to ensure they align with changing market conditions and new information. This can help counter the tendency to hold on to investments based on pre-existing beliefs. By actively addressing overconfidence and confirmation bias, investors can improve their decision-making processes and reduce the likelihood of costly investment errors. It is essential to approach investing with humility, an open mind, and a willingness to challenge one's own beliefs to achieve long-term success. 10.3 The role of regret and loss aversion in investment decision regrets. Regret and loss aversion are two powerful psychological factors that play a significant role in investment decision-making. Understanding how these emotions influence our choices can help investors make more rational and informed decisions. 10.3.1 The nature of regret. Regret is a complex emotion that arises when we feel dissatisfaction or disappointment about a past decision or action. In the context of investing, regret often stems from missed opportunities or poor investment choices that result in financial losses. It is a common human tendency to dwell on past mistakes and wonder what could have been done differently. One of the key aspects of regret is that it is a backward-looking emotion. It focuses on the past and can cloud our judgment when making future investment decisions. Regret can lead to a fear of making similar mistakes, causing investors to become overly cautious or hesitant to take risks. This fear can prevent them from seizing new opportunities and potentially achieving higher returns. 10.3.2 Loss aversion and its impact. Loss aversion refers to the tendency of individuals to strongly prefer avoiding losses over acquiring equivalent gains. In other words, the pain of losing money is felt more intensely than the pleasure of making the same amount of money. This bias can lead investors to make irrational decisions driven by the fear of incurring losses. Loss aversion can manifest in various ways in investment decision-making. For example, investors may hold on to losing investments for longer than they should, hoping that the market will turn in their favor and they can avoid realizing the loss. This behavior is known as holding on to losers, and can result in missed opportunities to invest in more promising assets. Loss aversion can also lead to a reluctance to sell winning investments too early. Investors may become overly attached to their successful investments and fear missing out on further gains. This behavior, known as selling winners too soon, can prevent investors from fully capitalizing on their investment's potential. 10.3.3 The impact of regret and loss aversion on decision regrets. Regret and loss aversion can have a profound impact on investment decision regrets. When investors experience regret over a past investment decision, they may be more likely to make impulsive or irrational choices in an attempt to rectify their perceived mistake. This can lead to a cycle of regret and further losses. Loss aversion can also contribute to decision regrets. Investors who are highly loss-averse may be more prone to making conservative investment choices, even if it means missing out on potentially higher returns. This fear of losses can prevent them from taking calculated risks that could lead to long-term growth. Furthermore, regret and loss aversion can create a bias towards inaction. Investors may become paralyzed by the fear of making the wrong decision and end up doing nothing. This can result in missed opportunities for portfolio diversification or capitalizing on market trends. 10.3.4 Managing regret and loss aversion. While regret and loss aversion are natural human emotions, it is essential for investors to manage them effectively to make sound investment decisions. Here are some strategies to help mitigate the negative impact of regret and loss aversion. 1. Learn from mistakes. Instead of dwelling on past investment regrets, focus on learning from them. Analyze what went wrong and identify the lessons that can be applied to future investment decisions. This approach can help investors grow and improve their decision-making skills. 2. Set realistic expectations. Understanding that losses are a part of investing can help manage regret and loss aversion. Setting realistic expectations about the potential risks and rewards of investments can help investors make more rational decisions and avoid excessive emotional reactions. 3. Diversify your portfolio. Diversification is a key strategy for managing risk and reducing the impact of individual investment losses. By spreading investments across different asset classes and sectors, investors can minimize the potential regret associated with any single investment. 4. Focus on the long term. Taking a long-term perspective can help investors overcome the short-term emotional reactions caused by regret and loss aversion. By focusing on their investment goals and maintaining a disciplined approach, investors can avoid making impulsive decisions based on short-term market fluctuations. 5. Seek professional advice. Working with a financial advisor can provide valuable guidance and help investors navigate the emotional aspects of investing. A trusted advisor can provide an objective perspective and help investors make more informed decisions based on their individual financial goals and risk tolerance. Conclusion. Regret and loss aversion are powerful psychological factors that can significantly impact investment decision-making. Understanding how these emotions influence our choices is crucial for investors to make rational and informed decisions. By managing regret and loss aversion effectively, investors can avoid impulsive decisions, learn from their mistakes, and build a more successful investment strategy. 10.4 Learning from mistakes and developing resilience in investing. Mistakes are an inevitable part of investing. Even the most experienced and successful investors have made their fair share of errors along the way. However, what sets them apart is their ability to learn from these mistakes and develop resilience in the face of adversity. In this section, we will explore the importance of learning from mistakes, the psychological factors that contribute to investment errors, and strategies for developing resilience in investing. 10.4.1 The importance of learning from mistakes. Learning from mistakes is crucial for growth and improvement in any aspect of life, and investing is no exception. When we make mistakes in our investment decisions, it is essential to reflect on what went wrong and why. By analyzing our mistakes, we can gain valuable insights into our decision-making process, identify any cognitive biases or emotional influences that may have clouded our judgment, and make adjustments to our investment strategies. One of the most common mistakes investors make is letting emotions drive their investment decisions. Emotions such as fear, greed, and impatience can lead to impulsive and irrational choices. By recognizing these emotional triggers and understanding how they can impact our decision-making, we can develop strategies to manage and control our emotions effectively. Another common mistake is overconfidence and confirmation bias. Overconfidence can lead investors to take on excessive risks or ignore warning signs in the market. Confirmation bias, on the other hand, causes us to seek out information that confirms our pre-existing beliefs and ignore contradictory evidence. By being aware of these biases, we can actively seek out diverse perspectives and challenge our own assumptions, leading to more informed investment decisions. 10.4.2 Developing resilience in investing. Resilience is the ability to bounce back from setbacks and adapt to changing circumstances. In the context of investing, developing resilience is crucial for long-term success. Here are some strategies for building resilience in investing. 10.4.2.1 Embrace a growth mindset. A growth mindset is the belief that our abilities and intelligence can be developed through dedication and hard work. By adopting a growth mindset, we can view mistakes as opportunities for learning and growth rather than as failures. This mindset allows us to bounce back from setbacks, learn from our mistakes, and continuously improve our investment strategies. 10.4.2.2 Maintain a long-term perspective. Investing is a long-term endeavor, and it is essential to maintain a long-term perspective. Short-term market fluctuations and temporary setbacks should not deter us from our long-term investment goals. By focusing on the bigger picture and staying committed to our investment strategies, we can weather the ups and downs of the market and avoid making impulsive decisions based on short-term fluctuations. 10.4.2.3 Diversify your portfolio. Diversification is a risk management strategy that involves spreading investments across different asset classes, sectors, and geographic regions. By diversifying our portfolio, we can reduce the impact of individual investment mistakes and minimize the risk of significant losses. Diversification helps to build resilience by ensuring that our investment portfolio is not overly reliant on the performance of a single investment. 10.4.2.4 Continuously educate yourself. The investment landscape is constantly evolving, and it is crucial to stay informed and continuously educate ourselves. By staying up to date with market trends, economic indicators, and industry developments, we can make more informed investment decisions. Continuous learning also helps us adapt to changes in the market and identify new investment opportunities. 10.4.2.5 Seek professional advice. Seeking professional advice can be beneficial, especially for novice investors or those who lack the time or expertise to manage their investments effectively. Financial advisors can provide valuable insights, help us navigate complex investment decisions, and provide an objective perspective on our investment strategies. However, it is essential to choose a reputable and trustworthy advisor who aligns with our investment goals and values. 10.4.2.6 Practice patience and discipline. Patience and discipline are essential virtues in investing. It is crucial to resist the temptation to make impulsive investment decisions based on short-term market fluctuations or the fear of missing out. By sticking to our investment plan, maintaining a long-term perspective, and avoiding emotional reactions to market volatility, we can build resilience and stay on track towards our investment goals. Conclusion. Learning from mistakes and developing resilience are critical aspects of successful investing. By reflecting on our mistakes, understanding the psychological factors that contribute to investment errors, and implementing strategies for resilience, we can improve our decision-making process and increase our chances of long-term investment success. Remember, investing is a journey, and mistakes are inevitable, but it is how we learn from them and adapt that ultimately determines our success. 11. The psychology of financial planning. 11.1 Understanding the psychological factors in financial planning. Financial planning is a crucial aspect of managing one's personal finances and achieving long-term financial goals. However, the success of financial planning is not solely dependent on numbers and calculations. It is equally important to understand the psychological factors that influence our financial decisions and behaviors. In this section, we will explore the various psychological factors that play a role in financial planning and how they can impact our financial well-being. 11.1.1 The role of goal setting and motivation in financial planning. Goal setting is a fundamental step in financial planning. It provides a clear direction and purpose for our financial decisions and actions. When setting financial goals, it is important to make them specific, measurable, achievable, relevant, and time-bound. SMART. By setting SMART goals, we create a roadmap that helps us stay focused and motivated. Motivation plays a crucial role in financial planning as it drives our actions and behaviors. It is important to understand our underlying motivations for financial planning, whether it is to achieve financial security, provide for our family, or fulfill our dreams and aspirations. By aligning our financial goals with our motivations, we can maintain a high level of commitment and perseverance throughout the planning process. 11.1.2 Overcoming procrastination and impulsivity in financial decision-making. Procrastination and impulsivity are two common psychological barriers that can hinder effective financial planning. Procrastination refers to the tendency to delay or avoid making financial decisions or taking necessary actions. This can lead to missed opportunities and financial setbacks. Impulsivity, on the other hand, refers to making hasty financial decisions without considering the long-term consequences. To overcome procrastination, it is important to break down financial tasks into smaller, manageable steps. By setting deadlines and creating a schedule, we can hold ourselves accountable and ensure that we take consistent action towards our financial goals. Additionally, seeking support from a financial advisor or accountability partner can provide the necessary guidance and motivation to overcome procrastination. To overcome impulsivity, it is important to practice mindfulness and self-control. Before making any financial decision, take a step back and evaluate the potential risks and benefits. Consider the long-term implications of your choices and avoid making impulsive decisions based on short-term emotions or external influences. Developing a habit of conducting thorough research and seeking professional advice can also help in making more informed and rational financial decisions. 11.1.3 The importance of financial education and literacy in planning for the future. Financial education and literacy are essential components of successful financial planning. Without a solid understanding of financial concepts and principles, it becomes difficult to make informed decisions and navigate the complex world of personal finance. By investing in financial education, individuals can gain the necessary knowledge and skills to manage their finances effectively. This includes understanding concepts such as budgeting, saving, investing, debt management, and retirement planning. Financial literacy empowers individuals to make sound financial decisions, avoid common pitfalls, and take advantage of opportunities that can lead to long-term financial success. There are various resources available for financial education, including books, online courses, workshops, and seminars. It is important to continuously update and expand our financial knowledge to adapt to changing economic conditions and financial trends. By staying informed and educated, we can make more confident and informed financial decisions that align with our goals and values. Conclusion. Understanding the psychological factors in financial planning is crucial for achieving long-term financial success. By recognizing the role of goal setting and motivation, overcoming procrastination and impulsivity, and investing in financial education, individuals can develop a solid foundation for effective financial planning. By combining financial knowledge with an understanding of our own behaviors and motivations, we can make informed decisions that align with our goals and lead to a secure and prosperous financial future. 11.2 The role of goal setting and motivation in financial planning. Setting goals and staying motivated are crucial aspects of successful financial planning. Without clear goals and the motivation to achieve them, it can be challenging to make sound financial decisions and stay on track with your plan. In this section, we will explore the importance of goal setting and motivation in financial planning and provide strategies to help you stay focused and motivated on your financial journey. The power of goal setting. Goal setting is the process of identifying specific objectives that you want to achieve within a certain time frame. When it comes to financial planning, setting clear and realistic goals is essential. Goals provide direction and purpose, helping you make informed decisions and prioritize your financial resources. 11.2.1 Setting Smart Goals. To effectively set financial goals, it is helpful to follow the SMART framework. SMART stands for specific, measurable, achievable, relevant, and time-bound. Let's break down each component. Specific. Your goals should be clear and well-defined. Instead of saying, I want to save money, specify how much you want to save and for what purpose, such as, I want to save $10,000 for a down payment on a house within the next 2 years. Measurable. Your goals should be quantifiable so that you can track your progress. This allows you to determine if you are on track or if adjustments need to be made. For example, if your goal is to pay off debt, specify the exact amount you want to pay off and by when. Achievable. Your goals should be realistic and attainable. While it's important to challenge yourself, setting unrealistic goals can lead to frustration and demotivation. Consider your current financial situation and resources when setting your goals. Relevant. Your goals should align with your overall financial plan and values. They should be meaningful to you and reflect what you truly want to achieve. Setting goals that are relevant to your life will help you stay motivated throughout the process. Time-bound. Your goals should have a specific timeframe for completion. This adds a sense of urgency and helps you stay focused. Setting deadlines also allows you to break down your goals into smaller, manageable tasks. By following the SMART framework, you can set goals that are clear, achievable, and meaningful, increasing your chances of success in your financial planning journey. The importance of motivation. Motivation plays a vital role in financial planning as it provides the drive and determination to take action and make necessary changes. Without motivation, it can be challenging to stick to your financial plan and make the necessary sacrifices to achieve your goals. Here are some key factors that contribute to motivation in financial planning. 11.2.2 Identifying your why. Understanding your motivations and reasons for pursuing financial goals is crucial. Take some time to reflect on why you want to achieve specific financial milestones. Is it to provide a secure future for your family, to retire early and travel the world, or to start your own business? Identifying your why will help you stay focused and committed, especially during challenging times. 11.2.3 Visualizing success. Visualization is a powerful tool that can enhance motivation. Take the time to imagine yourself achieving your financial goals. Visualize the emotions, experiences, and benefits that come with reaching those milestones. By regularly visualizing success, you can reinforce your motivation and keep your goals at the forefront of your mind. 11.2.4 Celebrating milestones. Recognizing and celebrating your achievements along the way is essential for maintaining motivation. Break down your goals into smaller milestones and reward yourself when you reach them. Celebrating these milestones will provide a sense of accomplishment and encourage you to keep pushing forward. 11.2.5 Surrounding yourself with support. Having a support system can significantly impact your motivation. Surround yourself with individuals who share similar financial goals or who can provide guidance and encouragement. Joining financial communities or seeking the help of a financial advisor can also provide the support and accountability needed to stay motivated. Strategies for goal setting and motivation. Now that we understand the importance of goal setting and motivation in financial planning, let's explore some strategies to help you set effective goals and stay motivated. 11.2.6 Write down your goals. Putting your goals in writing makes them more tangible and increases your commitment to achieving them. Write down your goals, along with the specific actions you need to take to accomplish them. Keep your goals somewhere visible, such as on a vision board or in a journal, to serve as a constant reminder. 11.2.7 Break down your goals. Large financial goals can feel overwhelming, making it difficult to stay motivated. Break down your goals into smaller, more manageable tasks. This allows you to track your progress and celebrate achievements along the way, keeping your motivation levels high. 11.2.8 Track your progress. Regularly monitor your progress towards your financial goals. This can be done through tracking your savings, investments, or debt reduction. Seeing your progress visually can provide a sense of accomplishment and motivate you to keep going. 11.2.9 Review and adjust. Periodically review your goals and financial plan to ensure they are still relevant and aligned with your current circumstances. Life circumstances and priorities may change, and it's essential to adjust your goals accordingly. Regularly reviewing and adjusting your goals will help you stay motivated and focused on what truly matters to you. 11.2.10 Seek professional guidance. Consider working with a financial advisor who can provide expert guidance and help you stay motivated. A financial advisor can help you set realistic goals, develop a personalized financial plan, and provide ongoing support and accountability. By implementing these strategies, you can harness the power of goal setting and motivation to drive your financial planning efforts. Remember, financial planning is a journey, and staying motivated is key to achieving long-term success. 11.3 Overcoming procrastination and impulsivity in financial decision-making. Procrastination and impulsivity are two common behavioral tendencies that can significantly impact financial decision-making. Both of these behaviors can lead to poor financial outcomes and hinder long-term financial planning. In this section, we will explore the causes of procrastination and impulsivity in financial decision-making and discuss strategies to overcome these tendencies. 11.3.1 Understanding procrastination in financial decision making. Procrastination refers to the act of delaying or postponing tasks or decisions. When it comes to financial decision making, procrastination can manifest in various ways. For example, individuals may delay saving for retirement, putting off creating a budget, or postponing important investment decisions. Procrastination in financial matters can have serious consequences, as it can lead to missed opportunities, increased financial stress, and a lack of progress towards financial goals. There are several reasons why individuals may procrastinate when it comes to financial decision making. One common reason is the fear of making the wrong decision. Financial decisions can be complex and overwhelming, and the fear of making a mistake can paralyze individuals, causing them to delay taking action. Additionally, individuals may procrastinate due to a lack of knowledge or understanding about financial matters. The complexity of financial concepts and the fear of making uninformed decisions can lead to avoidance and procrastination. 11.3.2 The impulsivity trap in financial decision making. Impulsivity, on the other hand, refers to the tendency to act without thinking or considering the long-term consequences of one's actions. In the context of financial decision-making, impulsivity can lead to impulsive spending, taking unnecessary risks, and making hasty investment decisions. Impulsive behavior can be detrimental to financial well-being, as it often leads to poor financial outcomes and prevents individuals from achieving their long-term financial goals. There are various factors that contribute to impulsive financial decision-making. One common factor is the influence of emotions. When individuals are driven by strong emotions such as excitement or fear, they are more likely to make impulsive decisions without considering the long-term consequences. Additionally, the availability of easy credit and the prevalence of online shopping have made it easier than ever to make impulsive purchases, further exacerbating impulsive behavior. 11.3.3 Strategies to overcome procrastination and impulsivity. Overcoming procrastination and impulsivity in financial decision-making requires self-awareness, discipline, and the implementation of effective strategies. Here are some strategies that can help individuals overcome these tendencies. 1. Set clear goals and prioritize. Setting clear financial goals is essential for overcoming procrastination and impulsivity. By clearly defining your financial objectives, you can create a sense of purpose and motivation to take action. Break down your goals into smaller, manageable tasks and prioritize them based on their importance and urgency. This will help you stay focused and avoid getting overwhelmed by the magnitude of the task at hand. 2. Create a financial plan. Developing a comprehensive financial plan can provide a roadmap for your financial journey and help you make informed decisions. A financial plan should include a budget, savings goals, investment strategies, and a timeline for achieving your objectives. Having a plan in place can reduce the likelihood of impulsive decision-making and provide a sense of direction and control over your financial future. 3. Educate yourself. One of the main reasons individuals procrastinate or make impulsive financial decisions is a lack of knowledge or understanding. Take the time to educate yourself about personal finance, investment strategies, and financial planning. Read books, attend seminars, or consult with a financial advisor to enhance your financial literacy. The more knowledge you have, the more confident and empowered you will feel in making informed financial decisions. 4. Practice delayed gratification. Delayed gratification is the ability to resist immediate temptations in favor of long-term rewards. Cultivating this skill is crucial for overcoming impulsivity in financial decision-making. Before making any impulsive purchase or investment, give yourself a cooling-off period. Take the time to evaluate the potential consequences and consider whether the decision aligns with your long-term financial goals. This practice can help you make more rational and deliberate choices. 5. Seek accountability and support. Accountability and support from others can be instrumental in overcoming procrastination and impulsivity. Share your financial goals and plans with a trusted friend, family member, or financial advisor who can hold you accountable and provide guidance. Consider joining a financial support group or seeking professional help if you struggle with managing your finances. Having someone to share your progress, challenges, and successes with can provide motivation and help you stay on track. 6. Break tasks into smaller steps. When faced with a daunting financial task, break it down into smaller, manageable steps. This approach can make the task feel less overwhelming and more achievable. By focusing on one step at a time, you can make progress and build momentum towards your financial goals. Celebrate each small accomplishment along the way to stay motivated and reinforce positive financial habits. 7. Develop self-discipline. Building self-discipline is crucial for overcoming both procrastination and impulsivity. Practice self-control by setting limits on impulsive spending, avoiding unnecessary risks, and sticking to your financial plan. Develop healthy financial habits, such as automating savings and investment contributions, to reduce the temptation to deviate from your long-term goals. Remember that self-discipline is a skill that can be developed with practice and consistency. Conclusion. Procrastination and impulsivity can hinder financial decision-making and prevent individuals from achieving their long-term financial goals. By understanding the underlying causes of these behaviors and implementing effective strategies, individuals can overcome procrastination and impulsivity and make more informed and deliberate financial decisions. Developing self-awareness, setting clear goals, creating a financial plan, and seeking support are key steps towards overcoming these tendencies and achieving financial success. 11.4 The importance of financial education and literacy in planning for the future. Financial education and literacy play a crucial role in the success of individuals in planning for their future. In today's complex and ever-changing financial landscape, it is essential for individuals to have a solid understanding of financial concepts, tools, and strategies. This knowledge empowers individuals to make informed decisions, set realistic goals, and navigate the challenges and opportunities that come their way. 11.4.1 The benefits of financial education. Financial education provides individuals with the knowledge and skills necessary to make sound financial decisions. It equips them with the tools to manage their money effectively, budget their expenses, and save for the future. By understanding concepts such as compound interest, inflation, and risk management, individuals can make informed choices about investing, retirement planning, and debt management. One of the key benefits of financial education is the ability to avoid common financial pitfalls. Many individuals fall into debt or make poor investment decisions due to a lack of understanding of basic financial principles. With proper education, individuals can learn to avoid excessive debt, make wise investment choices, and protect themselves from financial scams and fraud. 11.4.2 Building financial confidence. Financial education not only provides individuals with knowledge but also helps build confidence in managing their finances. When individuals understand financial concepts and strategies, they feel more empowered to take control of their financial future. This confidence allows them to make informed decisions, take calculated risks, and pursue their financial goals with conviction. Moreover, financial education helps individuals develop a sense of financial responsibility. They become more aware of the consequences of their financial decisions and are motivated to make choices that align with their long-term goals. This sense of responsibility fosters discipline and accountability, leading to better financial outcomes. 11.4.3 Enhancing financial decision-making. Financial education enhances individuals' ability to make effective financial decisions. It equips them with critical thinking skills, enabling them to evaluate financial products, services, and opportunities. By understanding the risks and rewards associated with different investment options, individuals can make informed choices that align with their risk tolerance and financial goals. Furthermore, financial education helps individuals develop a long-term perspective when it comes to financial planning. They learn to consider the impact of their decisions on their future financial well-being and make choices that prioritize their long-term goals over short-term gratification. This ability to think strategically and plan for the future is essential for building wealth and achieving financial security. 11.4.4 Navigating financial challenges. Financial education prepares individuals to navigate the challenges and uncertainties that arise throughout their financial journey. It equips them with the knowledge and skills to adapt to changing economic conditions, market fluctuations, and personal circumstances. By understanding the principles of diversification, risk management, and asset allocation, individuals can build resilient portfolios that can weather market volatility and economic downturns. Moreover, financial education helps individuals develop the ability to identify and respond to financial risks. They learn to recognize warning signs of financial trouble, such as excessive debt, overspending, or inadequate savings, and take proactive steps to mitigate these risks. This proactive approach to financial management can help individuals avoid financial crises and maintain financial stability. 11.4.5 Access to financial opportunities. Financial education opens doors to a wide range of financial opportunities. It enables individuals to take advantage of investment options, savings accounts, and retirement plans that can help them grow their wealth over time. By understanding the benefits and risks associated with different financial products, individuals can make informed choices that align with their financial goals and risk tolerance. Furthermore, financial education empowers individuals to explore entrepreneurship and business opportunities. It provides them with the knowledge and skills to start and manage their own businesses, create additional income streams, and build wealth through entrepreneurship. This ability to leverage financial knowledge for entrepreneurial endeavors can lead to increased financial independence and success. 11.4.6 Promoting financial well-being. Financial education is not just about accumulating wealth, it is also about promoting overall financial well-being. It helps individuals develop a healthy relationship with money, manage their financial stress, and achieve a sense of financial security. By understanding the importance of financial planning, individuals can create a roadmap for their future and work towards achieving their financial goals. Moreover, financial education promotes financial resilience. It equips individuals with the knowledge and skills to recover from financial setbacks, such as job loss or unexpected expenses. By having a solid understanding of financial principles and strategies, individuals can bounce back from financial challenges and continue on their path towards financial success. 11.4.7 The role of financial literacy programs. To promote financial education and literacy, various organizations and institutions offer financial literacy programs. These programs aim to provide individuals with the knowledge and skills necessary to make informed financial decisions. They cover a wide range of topics, including budgeting, saving, investing, retirement planning, and debt management. Financial literacy programs can be accessed through schools, community organizations, financial institutions, and online platforms. They often provide resources such as workshops, seminars, online courses, and educational materials to help individuals enhance their financial knowledge and skills. By participating in these programs, individuals can gain the necessary tools to plan for their future and achieve financial success. 11.4.8 The need for lifelong learning. Financial education is not a one-time event, it is a lifelong journey. The financial landscape is constantly evolving, and individuals need to stay updated with the latest trends, strategies, and regulations. By embracing a mindset of lifelong learning, individuals can adapt to changes, seize new opportunities, and continue to make informed financial decisions throughout their lives. In conclusion, financial education and literacy are essential for individuals to plan for their future successfully. By acquiring financial knowledge and skills, individuals can make informed decisions, build confidence, enhance their financial decision-making abilities, navigate challenges, access opportunities, promote financial well-being, and achieve long-term financial success. Through financial literacy programs and a commitment to lifelong learning, individuals can empower themselves to take control of their financial future and create a solid foundation for their financial well-being. 12. The future of investor psychology. 12.1 Emerging trends in behavioral finance and investor psychology. Behavioral finance is a field that combines psychology and finance to understand how human behavior influences financial decisions and market outcomes. Over the years, researchers and practitioners have made significant progress in unraveling the complexities of investor psychology. As we look to the future, several emerging trends in behavioral finance and investor psychology are shaping the way we understand and approach investment decision-making. 12.1.1 Neurofinance, the intersection of neuroscience and finance. One of the most exciting emerging trends in behavioral finance is the integration of neuroscience into the study of investor behavior. Neurofinance seeks to understand the neural processes underlying financial decision-making. By using techniques such as functional magnetic resonance imaging, fMRI, and electroencephalography, EEG, researchers can observe brain activity in real time and gain insights into the cognitive and emotional processes that drive investment choices. Neurofinance has the potential to revolutionize our understanding of investor psychology. By examining brain activity, researchers can identify neural markers associated with risk aversion, loss aversion, and other cognitive biases. This knowledge can help investors and financial professionals develop strategies to mitigate the impact of these biases and make more rational investment decisions. 12.1.2 Robo-advisors and artificial intelligence. The rise of robo-advisors and artificial intelligence, AI, is another significant trend in behavioral finance. Robo-advisors are digital platforms that use algorithms to provide automated investment advice and portfolio management. These platforms leverage AI and machine learning to analyze vast amounts of data and make investment recommendations based on an individual's financial goals, risk tolerance, and time horizon. Robo-advisors have gained popularity due to their ability to remove human biases and emotions from investment decisions. By relying on algorithms, robo-advisors can provide objective and data-driven advice, potentially leading to more consistent and disciplined investment strategies. However, it is important to note that human oversight and intervention are still crucial to ensure the suitability of investment recommendations and adapt to changing market conditions. 12.1.3 Behavioral nudges and choice architecture. Behavioral nudges and choice architecture refer to the design of decision-making environments to influence individuals' choices without restricting their freedom. This concept has gained traction in the field of behavioral finance as a way to encourage individuals to make better financial decisions. For example, default options can be strategically set to guide individuals towards desirable investment choices. By defaulting individuals into retirement savings plans or automatic investment programs, they are more likely to save and invest for the long term. Similarly, framing investment options in a way that highlights potential losses rather than gains can influence risk perception and lead to more conservative investment decisions. As technology advances, financial institutions and policymakers can leverage behavioral nudges and choice architecture to promote positive financial behaviors and improve overall investor outcomes. 12.1.4 Social investing and collective decision-making. The rise of social media and online communities has given birth to a new trend in investor psychology as social investing. Social investing refers to the practice of making investment decisions based on information and recommendations shared by others in online communities or social networks. Social investing platforms allow individuals to connect with like-minded investors, share investment ideas, and collectively make investment decisions. This trend has the potential to democratize investing by providing access to a broader range of investment insights and perspectives. However, social investing also comes with its challenges. The influence of herd behavior and the spread of misinformation can lead to irrational investment decisions. It is crucial for investors to critically evaluate information and exercise independent judgment when participating in social investing platforms. 12.1.5 Environmental, Social, and Governance (ESG) investing. ESG investing is an emerging trend that considers environmental, social, and governance factors in investment decision-making. Investors are increasingly incorporating ESG criteria into their investment strategies, driven by a desire to align their investments with their values and contribute to positive social and environmental outcomes. ESG investing reflects a shift in investor psychology towards a more holistic and sustainable approach to wealth creation. By considering non-financial factors alongside traditional financial metrics, investors can make more informed decisions that align with their personal values and long-term goals. As ESG investing continues to gain traction, it is expected to influence market dynamics and corporate behavior, leading to increased transparency and accountability in the business world. Conclusion. The field of behavioral finance and investor psychology is constantly evolving. Emerging trends such as neurofinance, robo-advisors, behavioral nudges, social investing, and ESG investing are reshaping the way we understand and approach investment decision-making. By embracing these trends and leveraging the insights they provide, investors can enhance their decision-making processes and improve their overall investment outcomes. It is essential for investors and financial professionals to stay informed about these emerging trends and adapt their strategies accordingly to navigate the ever-changing landscape of investor psychology. 12.2 The impact of technology and artificial intelligence on investment decisions. Technology and artificial intelligence (AI) have revolutionized various industries, and the field of finance is no exception. In recent years, advancements in technology and the rise of AI have had a profound impact on investor psychology and the way investment decisions are made. This chapter explores the various ways in which technology and AI have influenced investor behavior and the implications for the future of investing. The rise of robo-advisors. One of the most significant developments in the investment industry is the emergence of robo-advisors. These are digital platforms that use algorithms and AI to provide automated investment advice and portfolio management services. Robo-advisors have gained popularity due to their low fees, accessibility, and ability to provide personalized investment strategies based on an individual's risk tolerance and financial goals. The introduction of robo-advisors has had a profound impact on investor psychology. Traditional financial advisors often rely on human judgment and emotions when making investment decisions. However, robo-advisors eliminate the emotional biases that can cloud judgment and lead to poor investment choices. By relying on data-driven algorithms, robo-advisors provide objective and rational investment recommendations, which can help investors overcome cognitive biases and make more informed decisions. Enhanced data analysis and predictive modeling. Technology has also revolutionized the way investment data is analyzed and interpreted. With the advent of big data and advanced analytics tools, investors now have access to vast amounts of information that can be used to make more accurate predictions and informed investment decisions. AI-powered algorithms can analyze large datasets, identify patterns, and make predictions about market trends and investment opportunities. This enhanced data analysis has had a significant impact on investor psychology. Investors now have access to real-time market information, news, and financial data, which can lead to increased market awareness and a better understanding of investment opportunities. However, the abundance of information can also lead to information overload and decision paralysis. Investors must develop the skills to filter and evaluate information effectively to avoid being overwhelmed by the sheer volume of data available. Algorithmic trading and high-frequency trading. Another area where technology has had a profound impact on investor psychology is in the realm of algorithmic trading and high-frequency trading (HFT). Algorithmic trading involves the use of computer programs to execute trades based on predefined rules and algorithms. HFT takes algorithmic trading to the next level by using powerful computers and high-speed data connections to execute trades in milliseconds. The rise of algorithmic trading and HFT has changed the dynamics of financial markets. These technologies have increased market efficiency and liquidity but have also introduced new risks and challenges. For individual investors, the presence of algorithmic traders can create a sense of unease and uncertainty. The speed and complexity of these trading strategies can make it difficult for individual investors to compete on a level playing field. The role of behavioral finance in technology-driven investing. While technology and AI have undoubtedly transformed the investment landscape, it is essential to recognize that investor psychology still plays a crucial role in decision-making. Behavioral finance, a field that combines psychology and finance, seeks to understand how cognitive biases and emotions influence investment decisions. Technology-driven investing has both positive and negative implications for investor psychology. On the positive side, technology can help investors overcome cognitive biases and make more rational decisions. Robo-advisors, for example, can provide objective investment recommendations based on data and algorithms, reducing the influence of emotions and biases. However, technology can also introduce new biases and challenges. For example, the availability of real-time market data can lead to overtrading and a focus on short-term performance. The speed and complexity of algorithmic trading can create a sense of instability and uncertainty, leading to emotional decision-making. The future of technology and investor psychology. As technology continues to advance, the impact on investor psychology is likely to grow. The integration of AI and machine learning algorithms into investment decision-making processes will become more prevalent. These technologies have the potential to improve investment outcomes by analyzing vast amounts of data, identifying patterns, and making accurate predictions. However, it is crucial to recognize that technology is not a panacea for all investment challenges. Investor psychology will continue to play a significant role in decision-making, and understanding the biases and emotions that influence behavior will remain essential. As technology evolves, investors must adapt and develop the skills necessary to navigate the changing investment landscape effectively. In conclusion, technology and AI have had a profound impact on investor psychology and the way investment decisions are made. The rise of robo-advisors, enhanced data analysis, algorithmic trading, and HFT have all influenced investor behavior and decision-making processes. While technology can help investors overcome cognitive biases and make more informed decisions, it also introduces new challenges and biases. As technology continues to advance, understanding the interplay between technology and investor psychology will be crucial for successful investing in the future. 12.3 The role of neuroscience in understanding investor behavior. Neuroscience, the study of the brain and its functions, has emerged as a valuable tool in understanding investor behavior. By examining the neural processes that underlie decision-making, researchers have gained insights into the cognitive and emotional factors that influence investment choices. This field of study has the potential to revolutionize our understanding of investor psychology and provide new strategies for improving investment outcomes. 12.3.1 The brain and decision-making. The human brain is a complex organ that plays a crucial role in decision-making. It is responsible for processing information, evaluating risks and rewards, and generating emotions. Neuroscience research has shown that different regions of the brain are involved in various aspects of decision-making. One key area of interest is the prefrontal cortex, which is involved in higher-order cognitive functions such as reasoning, planning, and self-control. Studies have found that damage to this region can impair decision-making abilities, leading to impulsive and irrational choices. Understanding how the prefrontal cortex functions can help investors recognize and overcome cognitive biases that may hinder their decision-making process. Another important brain region is the amygdala, which is involved in processing emotions, particularly fear and anxiety. Research has shown that the amygdala can influence investment decisions by modulating risk perception and aversion. By understanding how the amygdala responds to different financial stimuli, investors can better manage their emotions and make more rational choices. 12.3.2 The role of neurotransmitters. Neurotransmitters are chemical messengers in the brain that play a crucial role in regulating mood, emotions, and cognitive functions. Several neurotransmitters have been implicated in investor behavior, including dopamine, serotonin, and cortisol. Dopamine, often referred to as the reward neurotransmitter, is associated with feelings of pleasure and motivation. Studies have shown that dopamine levels can influence risk-taking behavior, with higher levels being associated with a greater willingness to take risks. Understanding the role of dopamine in investment decisions can help investors recognize when their decisions may be driven by the desire for short-term gains rather than long-term success. Serotonin, another important neurotransmitter, is involved in regulating mood and emotions. Low levels of serotonin have been linked to increased impulsivity and risk-taking behavior. By understanding the role of serotonin in decision-making, investors can be more aware of their emotional state and make more rational choices. Cortisol, often referred to as the stress hormone, is released in response to perceived threats or stressors. Research has shown that elevated cortisol levels can impair decision-making abilities, leading to impulsive and irrational choices. By managing stress levels and reducing cortisol release, investors can make more rational and informed investment decisions. 12.3.3 Neuroplasticity and learning. Neuroplasticity refers to the brain's ability to reorganize and adapt in response to new experiences and learning. This concept has important implications for investor behavior, as it suggests that individuals can change their investment habits and overcome biases through deliberate practice and learning. By understanding the principles of neuroplasticity, investors can actively work to rewire their brains and develop more effective investment strategies. This may involve challenging cognitive biases, practicing disciplined decision-making, and seeking out new learning opportunities. By embracing neuroplasticity, investors can continuously improve their decision-making skills and adapt to changing market conditions. 12.3.4 The future of neuroscience in investor psychology. As neuroscience continues to advance, its applications in investor psychology are likely to expand. Researchers are exploring the use of neuroimaging techniques, such as functional magnetic resonance imaging, fMRI, to directly observe brain activity during investment decisions. This could provide valuable insights into the neural processes underlying investor behavior and help identify patterns that predict investment success. Furthermore, advancements in wearable technology and mobile applications may allow investors to monitor their brain activity in real time, providing immediate feedback on their emotional state and decision-making processes. This could enable investors to make more informed choices and manage their emotions effectively. In conclusion, neuroscience offers a promising avenue for understanding investor behavior. By studying the brain and its functions, researchers can gain insights into the cognitive and emotional factors that influence investment decisions. Understanding the role of neuroscience in investor psychology can help investors recognize and overcome biases, manage their emotions, and make more rational choices. As neuroscience continues to advance, its applications in investor psychology are likely to revolutionize the field and provide new strategies for improving investment outcomes. 12.4 Predicting and adapting to future changes in investor psychology. Investor psychology is a complex and ever-evolving field that continues to shape the way individuals make investment decisions. As our understanding of human behavior and decision-making processes deepens, it becomes increasingly important for investors to stay ahead of the curve and adapt to future changes in investor psychology. In this section, we will explore some of the emerging trends and strategies that can help investors predict and adapt to these changes. 12.4.1 The evolution of investor psychology. Investor psychology has come a long way since the early days of financial markets. Traditionally, investors were seen as rational beings who made decisions based on careful analysis of available information. However, research in the field of behavioral finance has shown that human decision-making is often influenced by cognitive biases, emotions, and social factors. Over the years, we have witnessed a shift in the understanding of investor psychology. The field has moved away from the assumption of rationality and embraced the idea that investors are prone to biases and emotions that can impact their investment decisions. This shift has led to the development of various theories and models that seek to explain and predict investor behavior. 12.4.2 The rise of behavioral finance. One of the most significant developments in the field of investor psychology is the rise of behavioral finance. Behavioral finance combines principles from psychology and economics to understand how individuals make financial decisions. It recognizes that investors are not always rational and seeks to explain the systematic biases and errors they make. As we look to the future, it is clear that behavioral finance will continue to play a crucial role in understanding investor psychology. Researchers are constantly uncovering new insights into the cognitive biases and emotional factors that influence investment decisions. By studying these biases and understanding how they impact decision-making, investors can better predict and adapt to future changes in investor psychology. 12.4.3 The role of technology and artificial intelligence. Technology has revolutionized the way we live and work, and the field of investor psychology is no exception. The rise of digital platforms, robo-advisors, and algorithmic trading has transformed the investment landscape. These technological advancements have made it easier for investors to access information, analyze data, and execute trades. Artificial intelligence (AI) is another area that holds great promise for the future of investor psychology. AI algorithms can process vast amounts of data and identify patterns that humans may overlook. By leveraging AI, investors can gain valuable insights into market trends and make more informed investment decisions. However, it is important to note that technology and AI are not without their challenges. As more investors rely on automated systems and algorithms, there is a risk of over-reliance and the potential for herd behavior. Additionally, the ethical implications of AI in investor psychology need to be carefully considered to ensure fairness and transparency. 12.4.4 The influence of neuroscience. Neuroscience, the study of the brain and nervous system, is another field that is increasingly being applied to investor psychology. By examining brain activity and understanding how it relates to decision-making, researchers can gain valuable insights into the underlying processes that drive investor behavior. Advancements in neuroimaging techniques, such as functional magnetic resonance imaging (fMRI), have allowed researchers to observe the brain in real time and identify the neural correlates of financial decision-making. This research has shed light on the role of emotions, cognitive biases, and risk perception in investment choices. As our understanding of the brain continues to grow, so too will our ability to predict and adapt to future changes in investor psychology. By incorporating insights from neuroscience, investors can develop strategies that align with the way our brains naturally process information and make decisions. 12.4.5 Strategies for predicting and adapting to future changes. To effectively predict and adapt to future changes in investor psychology, investors can employ several strategies. 12.4.5.1 Continuous learning and education. Investors should prioritize continuous learning and education to stay informed about the latest research and developments in investor psychology. By understanding the underlying principles and theories, investors can better anticipate and adapt to changes in investor behavior. 12.4.5.2 Embracing technology. Investors should embrace technology and leverage the tools and platforms available to them. By utilizing digital platforms, robo-advisors, and AI algorithms, investors can access real-time data, perform sophisticated analysis, and make more informed investment decisions. 12.4.5.3 Diversification and risk management. Diversification and risk management are timeless strategies that can help investors navigate changing market conditions. By spreading investments across different asset classes and regions, investors can reduce the impact of individual investment decisions and mitigate risk. 12.4.5.4 Emotional intelligence and self-awareness. Developing emotional intelligence and self-awareness is crucial for investors to understand and manage their own biases and emotions. By recognizing their own tendencies and biases, investors can make more rational and objective investment decisions. 12.4.5.5 Seeking professional advice. Investors can also seek professional advice from financial advisors who specialize in investor psychology. These professionals can provide valuable insights and guidance based on their expertise and experience in navigating the complexities of investor behavior. In conclusion, predicting and adapting to future changes in investor psychology is essential for long-term investment success. By staying informed about emerging trends, embracing technology, leveraging insights from neuroscience, and employing effective strategies, investors can navigate the ever-evolving landscape of investor psychology and make informed investment decisions.